So yes guys, so we were talking about Ind AS 37. Let's look at certain questions on that. Question number 1. ABC is an automobile component manufacturer. The automobile manufacturer has a specified delivery schedule and non-adherence to which will entail a penalty. On 31st March, on the reporting date, on 31st March, which is the reporting date, the manufacturer had a delivery schedule for June 2012. However, the manufacturer is aware that he will not be able to meet the delivery schedule in June 2012. Determine whether the entity has a present obligation on 31st March. Guys, when is the delivery falling due? In the month of June. Even though I knew that I cannot meet the delivery schedule, it is a future event. So therefore, the obligation of penalty is a possible obligation. It is not a present obligation. Therefore, in this case, I will not recognize any provision as per Ind AS 37. In this case, there is no present obligation arising from past event as the goods are scheduled to be delivered in June 2012 and there is no delay as on 31st March. Hence, there is no present obligation to pay. Therefore, no present obligation to recognize a provision. Look at question number 2. ABC has an obligation to restore the seabed for the damage it caused in the past. It had to pay 10 lakh cash on 31st March 2013 relating to this liability. ABC management considers 5% as the appropriate discount rate and the time value of is considered to be material. Calculate the amount to be provided on 31st March for the cost of restoring the seabed. Guys, 5% discounting at the end of 2011 you are reporting and the expenditure is incurred to be met on 31st of March 2013. So what should be the appropriate amount at which you have to recognize? You'll have to recognize at 5% discounting for 2 years. Calculate 5% discounting for 2 years. 1 divided by 1.05. First year discount factor is 0.952. Second year discount factor is 0.907. So 0.907 into 10 lakhs is 9,07,000. That should be the amount to be recognized as liability. Present value of estimated dismantling cost or site restoration cost is 9,07,000. That should be recognized. Every year, I'll have to recognize an interest cost. In next year, that is 2011-12, I will recognize 5%, which is 45,351 as interest cost. That next year, again 5%. So this way, I'll make sure that by the end of 2013, I'll get back the 10 lakhs. Every year, the interest cost should be capitalized or should be charged to P&L as finance cost. Marico has an obligation to restore environmental damage in the area surrounding the factory. The expert advice indicates that the restoration will be carried out in 2 distinct phases. The first phase requiring an expenditure of 2 million to remove the contaminated soil from the area, and the second one commencing 3 years later at the end of the first phase to replant the area with suitable trees and vegetation. The estimated cost of replantation is 3.5 million. Marico uses a cost of capital of 10% and the expenditure when incurred will attract a tax relief at the rate of 30%. Marico has not recognized any provision for these on the date of 31st March 2012. Okay. The first phase of cleanup will commence few months in time and will be completed on 31st March 2030. Guys, you are standing on 31st March 2012. First phase will complete on 31st March 2013 and the second phase will be 3 years after the first phase. That is 31st March 2016. Okay. Calculate the provision. Calculate 20 lakhs in the first phase after 1 year. So present value factor of 10% for 1 year. But 2016, that is 4 years of discounting at 10% is 0.683. So calculating based on the provisions based on discount factors of 10%. First year is present value factor of 10,1. Second phase is present value factor of 10,4. Therefore, ultimately, you get the present value as 42,08,500, which should be recognized as a liability on 31st March 2012 itself. Let's look at questions related to income tax. The director of H Limited wishes to recognize a material deferred tax asset in relation to 250 crores of unused trading losses which were accumulated as on 31st March 2011. H has budgeted profit of 80 crores at the end of 31st March 2012. The director had forecasted that the profits will grow at 20% thereafter. However, the improvement in trading profits may occur after the next couple of years to come at the position of break-even. The market is currently depressed and the sale order at the lowest level. H operates in a tax jurisdiction which allows the trading losses can be carried forward to a maximum of 2 years. Analyze whether a deferred tax asset can be recognized or not. Guys, you remember law of prudence? Every time you recognize a deferred tax asset, you have to check for prudence. What is the concept of prudence? Sufficient taxable profits will arise in the future against which the loss can be realized, or the deductible temporary differences can be realized. Here 250 crores of loss, I should understand whether I will get sufficient taxable future profits or no. Very clearly he is saying the director have forecasted that the profits will grow by 20% each year thereafter. However, the improvement in trading profits may occur after the next couple of years to come at the position of break even. The market is currently depressed. Sale orders are at the lowest level in the first quarter of 2012. Therefore, the same period in any previous of 5 years. So therefore, you need to understand that the loss will continue for the next 2 years, and beyond 2 years you cannot carry forward the loss. Therefore, you cannot recognize a deferred tax asset since it is not satisfying your law of prudence. Clear? In relation to the unused tax losses, the carrying value of 0, since the losses have not yet been recognized in books. H, a potential deferred tax asset does arise, but determination is more problematic. The tax base of an asset will be deductible against taxable economic benefits that recover from the carrying value of the asset. When recovering the carrying value of the asset will have no tax consequences, the tax base is 0, which will be equal to carrying value. So very clearly you cannot have any, therefore the contention of the director to recognize deferred tax is not correct. S Limited leased a machine for 5 years period. The present value of lease liability is 120 crores at a discount of 8%. It is recognized as a lease and is recognized as a lease liability and a corresponding ROU asset on the same date, that is on 1st April 2011. ROU asset is depreciated over 5 years on a straight line basis, and the annual lease rental is 30 crores payable starting from 31st of March 2012. Tax law permits tax deduction on the payment of rent. Guys, that is how even Income Tax Act also applies. India's 116 talks about recognition of ROU asset, lease liability and all, but ultimately when you look at your tax purposes, it is only based on the lease rentals paid. Assuming that the tax rate is 30%, explain the deferred tax consequences at the end of 31st March 2012. Guys, by the end of 31st March 2012, what is the carrying value of the ROU asset? 120 crores depreciated over 5 years. That means the depreciation is equal to 24 every year. Correct? 24 reduced from 120, carrying value of ROU asset is 96. What about the lease liability carrying value? Lease liability carrying value is 120 crores plus interest at the rate of 8%. Calculate 120 into 8%, which is 9.6, minus 30 repayment. The ROU lease liability will be 99.6 crores. This is the carrying value. What is the tax base? Absolute round 0. Absolute round 0. So your lease liability and ROU asset net difference is 3.6. 3.6 of lease liability excess, which is the carrying value. Tax base is 0. Therefore, the temporary difference is 3.6. At the rate of 30%, if you calculate, ultimately you will get a deferred tax of 1.08. Now question will be, is this a deferred tax asset or is this a deferred tax liability? You need to understand that your carrying value is greater than your tax base. And this is in the case of a liability. Whenever you have a liability which has a carrying value greater than the tax base, then it should result in a deferred tax asset. So therefore, the temporary deductible temporary differences 3.6 will result in a deferred tax asset of 1.08. Let's look at employee benefits then. Mr. Rajan is working for Infotech Limited. Considering the following particulars, the annual salary of Mr. Rajan is 30 lakhs. Total working days is 300. Leaves allowed according to the company's policy is 10, but the leaves utilized by Rajan is only 8. Though there are 2 unutilized leaves. The unutilized leaves are settled by way of payment and accordingly carried forward for such leaves to the subsequent period is not allowed. So they are encashable, you cannot carry forward. So these are accumulating compensated absences which are vesting in nature, encashable in nature. Compute the total taxable employee benefit for the year 2010-11. Guys, 300 days, his salary is how much? 30 lakhs. Per day, how much salary is he drawing? Per day salary is 30,000. How many days can he take a encashment benefit for? 2 days. 2 days into 30,000. That is total amount of 60,000. So 60,000 rupees should be the encashment provision for accumulating short-term compensated absences which are vesting in nature should be created. So already salary cost is 30 lakhs plus additional 60,000 of provision. So total staff cost or employee benefit expense is 30 lakh 60,000. 20,000. How 20,000? 10,000 only per day. Oh yeah, sorry, I'm sorry. 10,000 per day. 30 lakhs divided by 300 is 10,000 per day. 2 days is 20,000. Provision is 20,000. So total cost is 30 lakh 20,000. I'm sorry guys, the numbers are not visible. I think you will be able to see it. Let's check. 1 second guys. Yeah, now I'm able to see it guys. I hope you can see it as well. Yeah, Mr. Niranjan was working for Infotech Limited and had the following salary. Annual salary is 30 lakhs for last year as well as for the current year. Number of working days is 300 and 300. Leave allowed is 10 days and 10 days. Leave taken last year 7 days. So therefore they could carry forward 3 days of leave. Next year he utilized the entire 13 days of leave. So based on the past experiences, the Infotech Limited assumes that Mr. Niranjan will avail the unutilized leave of 3 days in the next year itself. Infotech Limited intends to record 30 lakhs as employee benefit expense. Answer is wrong because in the current year you will also have to recognize a provision for the carried forward leave. How much is per day leave? Per day cost of staff cost is 10,000. 10,000 into 3 days. How much is the provision to be created? Provision to be created is 30,000 rupees. So therefore in the current year when I recognize 30,000 rupees of provision, so I'll recognize 30 lakhs of salary cost plus 30,000 rupees of provision also. Next year when I recognize, I'll only recognize 2,90,000. Sorry, 29,70,000. How much should be recognized? 10,000 per day. Look at the entries which he recognized. Yeah, first year entry is 30 lakh 30,000 because he is creating a provision. In the next year, I'll reduce it by 30,000 because of the provision which has already been created. So next year, employee benefit expense is 29 lakh 70. Provision for leave encashment is 30,000. Provision for compensated leaves, guys, actually compensated absences to bank 30 lakhs. So these are the entries that you have to record. Look at the next one. Pratap Limited belongs to a shipbuilding industry. Company reviewed its actuarial valuation for the first time for its pension scheme, which revealed a surplus of 60 lakhs. It wants to spread the surplus over 2 years by reducing 20 lakhs by reducing its amount of contribution to 20 lakhs instead of 50 lakhs. So it's recognizing actuarial gain of 60 lakhs by reducing its contribution each year by 30 lakhs each, which is not possible. because actuarial gain or losses should be recognized in P&L, it should be recognized in OCI in the year in which they occur. You cannot reduce the contribution each year. And that will bring us to the end of discussion. Read the answer of question number 8. As per Ind AS 19, any actuarial gain or loss should be recognized in the measurement as a measurement of net defined obligation in the OCI. So in the given case, the amount of surplus on pension scheme of 60 is an actuarial gain, should be recognized as remeasurement in the other comprehensive income and not adjusted to the annual amount of contribution in future periods. The change relating to actuarial valuation for the pension scheme requires a disclosure as per Ind AS 8, and disclosures as per Ind AS 19 should also be made in the financial statements. So that will bring us to the end of discussion relating to questions on Ind AS 12, Ind AS 19 and Ind AS 37. Yes guys, so let's talk about the first standard, that is Ind AS 1. What does the standard deal with? Guys, remember this standard is a very peculiar standard because this does not have a corresponding accounting standard. Now, unfortunately, you might find ICAI very strangely comparing your AS1 and Ind AS 1, but both are completely unrelated. I'll tell you why they are unrelated. Remember, number one, AS1 was dealing with disclosure of accounting policies, while Ind AS 1 talks about presentation of financial statements. Your financial statements cover not just your disclosures and notes to accounts, but it covers your balance sheet, your statement of profitability, statement of changes in equity, your cash flows, and finally your notes to accounts. Within notes to accounts, one of the part is disclosure of accounting policies. So I can put it like this, that your AS1 was a very, very small, tiny part of what we have today in the form of Ind AS 1. So Ind AS 1 has a much larger ambit. Now, what is the significance of Ind AS 1? Is Ind AS 1 so significant? Let me understand. See, in simple sense, I can put it like this, that there was no standard which was particularly dealing with presentation of financial statements. That means if I talk about a particular organization, they could have presented their financial statements in any format. You could have started with equity and liability. Some enterprises could have started with assets. They could have presented non-current assets before. Some people might not even give you a bifurcation between current assets and non-current assets. I do a lot of audits, and when we come across tax audits related to partnership entities, we don't even create a particular format also. All that we do is dump everything into one shot. But that is where Ind AS 1 has laid some significance, because Ind AS 1 comes up and gives you a draft of what could be the presentation under the Ind AS. Now you will say, sir, Ind AS is only applicable to company form of organization. Company's financial statements should be presented as per Schedule 3 of Companies Act. Then why Ind AS 1 all over again? I agree that Schedule 3 is definitely the more comprehensive presentation of financial statements provided to the companies, and the companies need to comply with this particular schedule of the Companies Act. So, but however, you need to understand today's date, Ind AS is only applicable to companies. But sooner or later, you will observe that Ind AS will be applicable to non-corporate entities as well. We're going with the phase-wise adoption. We have only come across 4 phases, which is ending on 2019 itself. So as the years progress, we will find that Ind AS is now applicable to multiple entities, where even probably the non-corporate entities will come into the ambit. Once the non-corporate entities come into the ambit, now you are moving out other than the companies. Companies have Schedule 3. Very good. Super good. Comprehensive schedule for presentation of financial statement. Can you name a similar schedule given under Partnership Act? Can you give a similar schedule given for proprietorship concern? Can you have a similar schedule for cooperative societies? Nothing. You have banking, you have a separate format of financial statements. Insurance, you have a separate format of financial statements, both of which you have covered in your CA Inter, right, or your IPCC. Then comes your companies, where you have Schedule 3. But what about other format of organization? What about other bodies? They should also present financial statements in a particular format. Now, where is that particular format? Nothing is given. That is the reason why Ind AS 1 was introduced. Ind AS 1 does not give you a particular format, but will at least give you the minimum contents to be presented in financial statements. I'll repeat. I said Ind AS 1 does not comprehensively give you the presentation format, but it will give you only the minimum contents in financial statements. That means any enterprise presenting its financial statements as per Ind AS should have this minimum contents as prescribed by Ind AS 1. So therefore, Ind AS 1 in today's regime becomes even more important than what it was before, because Ind AS 1 on today's date is trying to bring out the minimum requirements in presentation of financial statements under Ind AS. So therefore, today's day, standing on the day of 2021, I might not find the standard to be very relevant, because you would come up and say today this Ind AS is only applicable to companies, where the Companies Act already has prescribed Schedule 3. Why do I need this standard? But remember, there will be an increasing significance to the standard once Ind AS starts applicable to non-corporate entities as well. So therefore, let's try to understand what is this minimum content he is talking about, and what is other discussions which are forming part of your Ind AS 1. Yes guys, so your Ind AS 1, what it says is Schedule 3 prescribes a rigid reporting format for a company. Then what is Ind AS 1 talking? It prescribes minimum reporting requirements in presentation of financial statements for any non-corporate entity. Any corporate entity or a company form of organization will continue to follow Schedule 3, but any other form of enterprise, once it comes into the ambit of Ind AS, has to present its financial statements with the minimum contents prescribed under Ind AS 1. The first thing which flashes into my head when I talk about Ind AS 1 is a statement called as explicit unreserved statement of compliance. What is this explicit unreserved statement of compliance, and what is the significance of this paragraph? Guys, this is the first time incorporation of this explicit unreserved statement, and which has to be applied even by companies who are following Schedule 3. What is this? This is a statement given by the management. The management of an enterprise comes out with a statement saying that they have complied with every Ind AS applicable to the enterprise and every paragraph of such Ind AS which is applicable to the enterprise. Therefore, he is giving an explicit statement which has no reservations. Reservation in the sense, that means exception to this paragraph, I've applied the entire thing. Nothing like that. So I'm saying that an explicit unreserved statement of compliance should be made by the management and should be disclosed in your notes to accounts or financial statements. So what does the management give? The management says the financial statements which have been presented have been in compliance with every Ind AS applicable and every paragraph of such Ind AS applicable to the enterprise. This is called as explicit unreserved statement of compliance. Who gives? Management gives. Where do they disclose? In their notes to accounts, they disclose this explicit statement saying that they have complied with every Ind AS and every paragraph of Ind AS which is applicable to the enterprise in preparation and presentation of its financial statements. Clear? So let's read through what it says. Management should provide an explicit disclosure in notes to accounts for an unreserved compliance to the requirements under Ind AS. Management can depart from the compliance. See, whenever a non-compliance is coming up, don't assume that non-compliance is crime. The management is not committing any crime for non-compliance. So if they depart from any non-compliance to the non-compliance to any provisions of Ind AS, if it conflicts with the objective of the financial statement, that means though I give an unreserved statement of compliance in the notes to accounts, I'm saying that the management can depart from the compliance to a particular provisions of Ind AS if they conflict, if they are having a problem with the objective of financial statement. I'll tell you. Let's say I have a borrowing, or let's say I have a billing, a debtor from a particular country which is facing severe inflation. Severe inflation is being observed by such company to whom I have sold goods to. I have denominated the sale in the currency of the receiver or the customer. So according to your Ind AS 21, I have to present the financial statements. Sorry, at the time of presenting of financial statements, such foreign currency debtors have to be restated using the closing rate. But I said severe inflation is there and I'm expecting it to normalize by the time the settlement happens. So let's say today the rate of that currency is, let's say, about 40 rupees per rupee. Sorry, 40 currency per rupee. But that is on severe hyperinflation case. At some point of time, I am assuming that by the time the settlement happens, it will come down to 15 rupees or 16 rupees, per that foreign currency. So what will happen? Instead of reporting at 40 in compliance to Ind AS 21, the management will come up with a statement saying that it looks unreal. It looks unrealistic to measure my customer at that rate because I know that country is suffering from hyperinflation. Therefore, I assume that the settlement could happen somewhere between 15 to 16 rupees. Therefore, instead of translating at 40 rupees using the closing rate, I will give them the translation at 15 rupees or 16 rupees, saying that it is a probable rate at which that settlement could occur. Therefore, in some situations, the enterprise is entitled to depart from the compliance to Ind AS if it conflicts with the objective of financial statements. Objective, you're talking so many times. What is your objective of financial statements? My objective of a financial statements is to present a true and fair view. Is to present a true and fair view of the affairs of the enterprise. A true and fair view of the affairs of the enterprise is the objective of presenting financial statements. Financial statements should be reliable and relevant. Reliable because the figures presented in the financial statement can be relied upon. Relevant. It has to be relevant to make sure that the user of the financial statement is making an economic decision making or a suitable decision making process. So that is the reason why when we say there is a departure is never a crime. You can depart from compliance to Ind AS even after giving an explicit unreserved statement of compliance if it conflicts with the objective of financial statements. So let's move further. What is the objective? Second, guys. Look at this. What are the disclosure requirements? Whenever I present the disclosures or when I present the financial statements, my general disclosures are that the financial statements present a true and fair view, and there's an explicit unreserved statement of compliance to the Ind AS given by the management. But if in case compliance to certain provisions of the Ind AS are conflicting with the objective of presenting a true and fair view, I can depart. Depart means there is a non-compliance to a particular paragraph of the Ind AS. In such case, where there is a departure from Ind AS, I should first disclose what is the title of the Ind AS, what is the particular paragraphs of the Ind AS which I am not complying with, what is the reason for the non-compliance, and finally, what is the quantifiable effect of departure from Ind AS. If I complied with the provisions of Ind AS, then the value of the debtors would be presented at this number. But since I am departing from the compliance and I am presenting debtors at this value, then the difference is appearing in such manner. So this is quantifiable effect of a departure from Ind AS. So what am I saying? In general sense, for any financial statements, I have to present that my financial statements are presenting a true and fair view. And in preparation and presentation of financial statements, the management have complied with every Ind AS applicable, explicit, unreserved statement of compliance to Ind AS. However, if there can be a departure from compliance or there can be a non-compliance to certain paragraphs of Ind AS, if it conflicts with the objective of financial statements to present a true and fair view. If there is a departure as such, if there is a non-compliance as such, then the disclosures which are necessary to be done are name of the Ind AS, the paragraph of the Ind AS which is not complied with, what is the reasons for your non-compliance or departure, and finally, what is the quantifiable effect of the non-compliance to Ind AS. If I would have complied with the Ind AS, then this could be the value. Since I'm not complying, this is the value. The difference of both is the quantifiable effect. If you remember AS1 also told you the same thing. You have to make sure that all the financial statements are prepared in compliance to accounting standards. If the particular standard is not complied with, then you have to give the name of the standard, reason for non-compliance, and quantifiable effect of non-compliance. If quantifiable effect cannot be identified, at least mention that the quantifiable effect cannot be identified. That last part, if it is impractical to present the quantifiable effect, then disclose the fact. That paragraph is not a part of Ind AS 1. What is the significant impact of that? Is that a significant impact which is going to happen? Yes, because it makes a compulsion on the enterprise to present the quantifiable effect. They cannot say that the quantifiable effect is impractical to identify. AS1 was very lenient. He was more lenient, saying that it's okay. Even if you have non-complied with it, then and you cannot identify the quantifiable effect, you can at least disclose the fact that the quantifiable effect is impractical to identify. But Ind AS 1 did not give any such lenience. He said compulsory, if there is a non-compliance, you need to specify what is the quantifiable effect of the departure or non-compliance to the standard. Clear? So it is significantly a much more rigid standard, not as lenient as what AS1 was talking about. Clear? Now, what is the frequency of reporting? Like we always know, it should be at least done once annually. You have to at least make a presentation of financial statements annually. Remember, there was no such restriction under your previous accounting standards. Your previous IGAP never told you what is the frequency of reporting. So Ind AS 1 is coming up and saying that you should present the financial statements at least once annually. At the same time, he said, a shorter or a longer period can be considered if there is a change in the reporting date. What is the change in reporting date and where else do we come across this concept? I'll tell you. We will come across this concept somewhere else as well. So whenever I have, let's say, your enterprise X is presenting the financial statements starting from 1st April to 31st March every year. While let's say Y, entity Y, is following a calendar year, presenting its financial statements from 31st March to 31st January to 31st December every year. Let's say in this case, X has acquired majority shareholding in Y. Immediately I'll understand that there is a parent or a holding company and subsidiary relationship which is established. To facilitate consolidation, let's say this occurred in 2021. This acquisition was affected. So for that year, Y Limited has changed its reporting date. So Y Limited has changed its reporting date. Or reporting period. And it shall now follow financial year instead of calendar year. Therefore, in that year of 2021, therefore, in 2020-21, they presented 15 months financials. Which is starting from 1st January 2020. Instead of ending it on 31st of December 2020, they have extended it to 31st of March 2021. So I'm saying they did not consider 31st of December 2020, but they continued to report up to 31st March 2021 so as to make the financial statements in line with the parent enterprise to facilitate consolidation. In such case, you will observe that the concept of reporting a financial statements annually is being broken. It is not being complied with. So that is the reason why the standard comes out with a statement to say that sometimes a shorter or a longer period can be considered if there is a change in the reporting date. But whenever there is a change in the reporting date and you are presenting a shorter or a longer period than a financial year or an accounting year, in such cases, you have to first disclose the fact that there is a change in reporting date. Number two, there should be a reason for a change in the reporting date. Number three, the fact that the current reporting period cannot be compared with the corresponding previous period. What is this current reporting period cannot be compared with the previous reporting period? Guys, for this year, what is the comparative? My previous year. What is my previous year? 1st Jan 2019 up to 31st of December 2019. If you observe, this is for a period of 15 months, while the previous year comparative was only for is only for 12 months. Can you compare like this? Absolutely no. That's why he's saying that you also have to notify the fact that the previous period, that is the comparative period presented, is only for 12 months and you cannot compare with the current reporting period of 15 months, and this is only a short-term phenomenon. So this is exactly what we are saying. So if you go back to the paragraph, he says you have to disclose the reason along with the fact that there is a change in the reporting date, and at the same time also report a fact that the current period which you have presented, that is for 15 months, is not comparable with the previous reporting period of just 12 months. Clear? So this is my disclosure requirement whenever you are presenting a financial statement for a period shorter or longer than one financial year or one accounting period. Clear? So my reporting should be done at least once annually. However, you can choose a shorter or longer period in case there is a change in the reporting date. And the fact and the reason of the change in reporting date should be mentioned, along with disclosing a fact that your current reporting period, which is drafted for a shorter or a longer period, is not comparable with my corresponding previous period. Clear? What is the minimum content prescribed by Ind AS 1? Like I told you, Ind AS 1 only prescribes the minimum contents to be presented in the financial statements. Though its heading says presentation of financial statements, the more appropriate heading would be minimum contents in presentation of financial statements. Same way, he will give you the minimum contents in the form of the financial statement. So financial statement should bare minimum include a balance sheet, a statement of profitability which includes two parts, P&L and OCI, a statement of cash flow which we deal as per Ind AS 7, a statement of changes in equity, an additional statement compared to what we had under ICAI, and lastly, notes to accounts. These are the 5 basic minimum contents to be presented within the financial statements. Clear? At the same time, while presenting financial statements, certain prominent disclosures should be made. What is the prominent disclosure and why should they be made? A prominent disclosure in presentation of financial statements will help the user understand what is being presented to him. Number 1, name of the reporting entity. Without having a name, ultimately it is useless to even present. Number 2, The user also should be communicated whether the financial statements were drafted on a standalone basis or a consolidated basis. Number 3, I should also present the reporting date and the reporting period. I should be presenting my reporting date along with my reporting period, because the reporting date and reporting period will help me understand whether the financial statements are presented for one full year or a longer period or a shorter period. Number 4, what is the currency in which the reporting has occurred? Now, I have compared Apple figures with Reliance figures. Reliance in rupee, Apple in dollars. Comparable? No. So if I remove the currency from there, ultimately I do not know whether I can compare them or not. That is the reason why a reporting currency should also be disclosed. And don't forget, the most important one, which we forget even when we are solving questions, is the level of rounding off. Sometimes the question is given in lakhs and we forgot to mention that the rupees are in lakhs. We continue to solve the entire problem, but understand the one small thing that you forgot is all to mention that statement that all rupees are in lakhs. Every time you solve a problem, please remember this, that even in your solving of a problem, this last point, the level of rounding off, also should be mentioned. So what am I saying? Name of the reporting enterprise. What is the whether it is being drafted on a standalone basis or on a consolidated basis? What is the reporting date and the reporting period? Reporting currency in which the financial statements are prepared. And finally, what is the level of rounding off? Guys, level of rounding off is given under Companies Act 2013 as well. Okay, where he says if your turnover is less than 100 crores, then you can present to the extent of, if your turnover is less than 100 crores, then you can round off in thousands, in lakhs, or in millions. But if your turnover is greater than 100 crores, then in such cases, your round off can be in lakhs, in millions, or in crores. In lakhs, in millions, or in crores, or if you want, you can present an absolute number also. But remember, presenting an absolute number, having an enterprise of turnover of more than 100 crores would not make the financial statements reliable and relevant. Since I have to make sure that the financial statements are reliable and relevant, I have to choose an appropriate rounding off. Clear? If my turnover is in lakhs and if I round off in crores, then I'll have to present the turnover as 0.00. Not necessary. That's why appropriate level of rounding off is supposed to be identified by the management. So what am I saying? Minimum disclosures to be presented in financial statements, or minimum statements to be presented as a part of financial statements, is their balance sheet, statement of profitability, statement of cash flow, statement of changes in equity, and finally your notes to accounts. Prominent disclosures to be presented on the face of the financial statements is the name of the reporting enterprise, whether the financial statements are presented on a standalone or a consolidated basis, what is the reporting date or reporting period, what is the level of rounding off, and what is the reporting currency. 5 contents, 5 prominent disclosures are necessary to be disclosed as a part of Ind AS 1. Clear? Now let's come to the balance sheet presentation. So from here on, our discussion will go on in what is the content, minimum content in the balance sheet, minimum content in statement of profitability, minimum content in statement of changes in equity, minimum content in notes to accounts. Remember, I will not touch the concept of presentation of cash flows because your statement of cash flows has a separate standard altogether, that is Ind AS 7. Clear? So now we will start looking at what is the basic minimum content in all the 5 basic requirements of your balance sheet. The standard Ind AS 1 talks about, says that at least these 5 contents should be there as a part of your financial statements. That is your balance sheet, your statement of profitability, statement of cash flow, statement of changes in equity, and your notes to accounts. In these 5, except regarding the statement of cash flow, Ind AS 1 talks about the basic minimum content to be presented. So let's see what is the basic minimum content to be presented. In presentation of financial statements, firstly, you need to follow an order of rigidity, unless liquidity is a more realistic understanding of financial statements. What is the order of rigidity or rigidity preference method? A rigidity preference method always indicates that the most rigid asset or most illiquid asset should be presented first. What is the most illiquid asset? What do you mean by liquid or illiquid? Liquid assets are those which can be easily converted into cash. Illiquid assets are exactly the opposite, where it takes substantial period to get converted into cash. So if I talk about the order of rigidity among the assets, then I will say first one is your land, second is your building, third is your machinery, fourth is your furniture, fifth is your vehicles, and so on. Even among current assets, if I talk about, you need to always start with inventory first and then go on with debtors, bills receivable, and the last item to be presented, which is the most liquid, is cash in hand, right? And right above your cash in hand is your cash at bank. Clear? So when you look at order of rigidity, then I can put up like this, saying that I'll have to present the most illiquid asset first and the most liquid asset towards the end. That is rigidity preference method. As far as your liability is concerned, the first liability to be presented as or in the order of rigidity is your long-term loans. Long-term loans is the first thing, and going on, you will have creditors and bank overdraft, which is the most liquid liabilities. Clear? However, he's saying unless I'll follow a rigidity preference method, unless a liquidity basis is a more realistic understanding of financial statements. Then my question is, what is the case where liquidity basis is more realistic understanding? When does a financial statements of an enterprise be presented on liquidity preference method instead of rigidity preference method? This situation appears whenever the going concern of an enterprise is affected. Let's say, for example, there is a major fire accident which occurred. This is a classical example anyone would give whenever they talk about this concept of the going concern being affected. The going concern is severely affected due to a major fire accident which occurred. So what happened? Since the going concern is affected, I don't expect the enterprise to run its operations, but they expect to shut down the operation. When they have taken the decision to shut down, in such cases, rigidity preference method no longer is applicable. I'll have to present the financial statements under liquidity preference method, where exactly reverse of the financial statements under rigidity preference method. That means the most liquid asset should be presented at the beginning, and going forward to the last asset, which is a most illiquid asset, which is generally a land or a building. Clear? Now, sir, always major fire accident. Why can't there be any other case? Okay, let's take any other case where the going concern is severely affected. Let's say I'm into running a professional institute for education on CA, CMA, and CS in a classroom environment. Due to Corona or due to COVID crisis, we have observed that running classroom is absolutely not feasible. There was a huge amount of rent which I was incurring, huge administration cost which I was having. So what I finally decided was I cannot any longer run the operations in this manner. So I'm shutting down this enterprise, and I'm starting a new enterprise which takes my education into an online mode, like the one which we are communicating on. So in such cases, the going concern of the previous entity, which was running classrooms on a face-to-face basis, are no longer in existence, are not feasible to have any existence. Therefore, the going concern is severely affected. In 2019, the government of India has passed a rule saying that a BS4 vehicle is no longer eligible to be sold in the market. Is no longer eligible to be sold in the market after 31st of March 2020. So what happened? Let's say I have a machine which is manufacturing any component of a BS4 vehicle. Then in such cases, if I cannot modify the machine to suit a BS6 variant, or that is pollution control norm variant, then in such cases, my going concern is also severely affected. Clear? So there are multiple situations where the going concern of an enterprise is severely affected. Let's say, for example, I am into a retail store which imports from China furniture and I retail it here. But subsequently, due to whatever crisis that India had with China as a battle, they have stopped all imports from China. Government has already passed an order stopping all imports from China, so I cannot import any further material from China. So what happened ultimately? My going concern got severely affected because my business model itself was basically importing furniture from China and selling it into India. So in such cases, also a going concern can get affected. This concept of going concern getting affected will also see as a part of India's 10 events occurring after balance sheet date. Clear? So what am I saying? As far as presentation of balance sheet is concerned, it should always be presented on rigidity preference method unless liquidity is a more realistic understanding of financial statements. Clear? Now, what is the basic minimum contents in the statement of balance sheet? When I'm presenting a balance sheet, what is the basic minimum content? The minimum content is divided into two categories: assets, equity, and liabilities. Under assets, I should at least show a classification of current and non-current assets. I should at least show a classification of current and non-current assets. Same way, as far as equity and liabilities is concerned, I'll have to present at least three subcategories. One is the shareholder funds, which deals with share capital and reserves. Two is your non-current liabilities. Third one being your current liabilities. Clear? So these are the three important classifications which are minimum requirements as far as presentation of your balance sheet is concerned. So as far as my content of balance sheet is concerned, I'll have to present a current asset and non-current assets within your assets. And under your liabilities and equity, I should present your shareholder funds, your non-current liabilities, and current liabilities. These are basic minimum contents in presentation of balance sheet. Can I present more? You can present more because like I said, India's one is only talking about minimum content. Now, when I use the word current asset and current liability, then the first question that will emerge in my head is, what is a current asset? What is a current liability? If you remember India's 105, where we spoke about non-current assets held for sale, there we explained what is a non-current asset with the help of using the definition of current asset from India's 1. So India's 1 is the primary place where the definition of current and non-current is actually put up. So let's see what is the definition of current assets and current liabilities. Non-current assets and non-current liabilities are not mentioned because non-current assets and non-current liabilities are other than current assets and other than current liabilities. So what is a current asset? What is a current liability? You will come across one very, very important use of a word called as operating cycle. We will first understand what is an operating cycle, and then we will start understanding what is the definition of current asset and current liability. What is an operating cycle? When I use the word operating cycle, operating cycle is starting with purchase of raw material, going into the process of production, time taken for sale of finished goods, time taken for realization from customer, and this converts into cash. Such cash will again be used for purchase of raw material and so on. This is called as an operating cycle. So operating cycle is the time taken for purchase of raw material plus the time taken for conversion of a raw material into finished good, time taken for sale of finished good, time taken for realization from customers, and finally getting converted into cash. So this process or this entire cycle to complete, how many days does it take, is called as one operating cycle. So every company has a different operating cycles. Look at companies like Ratndeep Supermarkets. Look at companies which are into DMart. So what happens? Avenue Supermarkets is DMart. So whenever we look at such kind of companies, the operating cycles are genuinely small. Genuinely, they have a very small operating cycle. Reason being, these are fast moving goods. But if I talk about industries like steel, cement, there's a significant amount of time, because when I have to manufacture steel, I'll have to basically get an ore. So which is called as ignot. Ignot is the ore. So ignot has to be mined. And after mining this ignot, it has to be put through a production process. After entering into a production process, we get special structures of steel. These special structures of steel have to be advertised, have to be marketed, identify a customer, and sell this product to the customer. After the sale is done to the customer, then happens your realization. 90-day credit period, 60-day credit period, or sometimes cash and carry basis. So, and then we ultimately get cash. So going round in this production process, what is the time taken is basically called as an operating cycle. In general sense, I am not standardizing anything. I'm just saying general sense. Operating cycle is always less than 12 months. I am just generalizing it. I am not saying that this is always compulsory. I'm just saying in general sense, an operating cycle should fall within 12 months. Can it have more than 12 months? Yes, sometimes it does happen. But if I cannot identify operating cycle, blindly I'll go with 12 months. But sometimes there are enterprises where the operating cycles happen to be more than 12 months. An enterprise which is into construction of public infrastructure like roads, bridge, etc., it takes significantly more than 12 months. Let's say I am a real estate enterprise into development of residential housing. It does take substantial period of time, and it is definitely more than 12 months. That is why I said it is not general concept. I am not generalizing, but I'm just saying that in most circumstances, your operating cycles are shorter than 12 months. Clear? Now, why is this concept of operating cycles even being coming up? Because in definition of current asset and current liability, he will use this word operating cycle. What is a current asset? The asset is expected to be realized, sold, or consumed within an operating cycle. Then it can be considered as a current asset. Asset which can be sold, inventory. Asset which can be realized is your debtors or bills receivable or advances. Assets which are consumed in the process, which is raw material. Any such asset, if it is expected to be sold or realized or consumed within an operating cycle, it will be considered as a current asset. Debtors, always current asset? No. Sometimes you can have an offered credit period beyond 12 months. Let's say there's a contract which is going on and there's a retention period in the contract. And you said, out of every bill that you give me, I will hold 10% of the bill until the completion of the contract. After the completion of the contract also, after giving a defect-free certificate, then only these funds will be paid. Therefore, it takes more than an operating cycle to pay that amount. In such case, that portion of 10% of the debtor should be classified as non-current. So don't always come up with a logic saying that you'll always have a debtor as a current asset. Not necessary. So asset which are sold, expected, or realized or consumed during an operating cycle or within an operating cycle are current assets. Similarly, current liabilities are expected to be transferred or settled within an operating cycle. Term loans are not expected to be settled within an operating cycle because term loan is for a period of 7 years. But the installment of the term loan, which is expected to be falling due in the next 12 months, can be classified as current liability. It's a 7-year loan. At the end of first year, you need to understand in the second year, there is some payment which I have to do. Therefore, to the extent of the amount falling due in the next year, I can classify that as a current liability, while the remaining part of the term loan will be classified as non-current liability. So liabilities which are expected to be settled or transferred within an operating cycle should be considered as current liability. Assets which are primarily held for the purpose of trade, or liabilities which are primarily held for the purpose of trade. What do you mean by trade? Buy and sell. Why did you get that asset? With the intention to buy or sell. For example, I have a bills receivable and I have a general tendency of discounting my bills. Discounting a bill is nothing but selling the bill to the bank. So that means it is an asset primarily held with the purpose of trade. Same way, I could have a liability also, where I could factor a liability. I could give up a liability on today's date, which I'll have to meet at a later point of time. And today's date, I'm settling it with a particular cash. That is liabilities held for trade. Cash and cash equivalents are always current assets, and demand liabilities are always current liabilities. Cash and cash equivalents. What do you mean? Cash, cash in hand, cash at bank, or any other very liquid investments which can be converted into a cash within 60 days. Any liquid investments which can be converted into cash within 60 days is called as a cash equivalent. Cash and cash equivalents are defined under Ind AS 7. A current liability includes a demand liability. What is a demand liability? There is no particular due date. You are required to pay the amount immediately when there is a demand. I demand you for payment today, you have to make the payment today. When will I demand? My wish. I can demand current year, I can demand next year, I can demand after 10 years. Such kind of demand liabilities should also be considered as current liabilities only. Clear? A bearer check offered is a demand liability. It is supposed to be realized, or it is supposed to be settled immediately when the check is actually presented to us. Clear? Promissory notes payable on demand. So whenever I talk about current assets and current liabilities, I'll define a current asset in 3 parts. An asset expected to be sold, realized, or consumed within an operating cycle. An asset primarily held with the purpose of trade, and cash equivalents. Similarly, liability also defined in 3 parts. A liability which is expected to be settled or transferred within an operating cycle, liabilities held primarily for the purpose of trade, and a demand liability. These can be classified as current assets and current liabilities, and non-current assets and non-current liabilities are any other items of assets and liabilities which cannot be classified under current assets and current liabilities. Clear? And that will bring us to the end of presentation of your financial statements and a balance sheet, or the minimum content of a balance sheet, where you present current assets and current liabilities along with equity shareholder funds as a part of your liability and equities, and your assets will have a current assets and non-current assets. That will bring us to the end of minimum requirements in presentation of balance sheet. Guys, as far as your statement of profitability is concerned, unlike what we have seen earlier under IGAP, here under Ind AS, your statement of profitability is predominantly divided into two parts. One is a statement of P&L and one is a statement of OCI. Both put together is called as total comprehensive income. So certain items will go into the P&L and certain items will go into the OCI. Both put together is called as total comprehensive income, which is TCI. So P&L plus OCI is equal to TCI. Clear? Now, what is the statement of OCI and why did this emerge? Where did we see OCI earlier? When we were discussing about Ind AS 19, where we said Ind AS 19 actuarial gain or loss should be debited or credited to OCI instead of P&L, while current service cost, interest cost, return on plan assets, past service cost, curtailments, settlements, all these items are to be recognized within the statement of P&L itself. But only your actuarial gain or loss is one such item which goes into the OCI. Sir, any other items are there in the OCI? Any revaluation reserve which you create should be created out of the OCI itself. Any FCTR reserve in your Ind AS 21 regarding your foreign currency translation reserve which emerges for your operations, foreign operations, is generally created out of your OCI. There are multiple items which can be transferred to OCI as far as Ind AS 109 is concerned. When we discuss about financial instruments, we will discuss about that. So OCI is rigid. OCI can only include certain items which are already specified by Ind AS 1. You cannot have more items into OCI just because you wish or the management wish to classify them under OCI. So OCI is rigid, while P&L, any other item which should not be covered under OCI should be transferred to P&L. So your statement of profitability is divided into two parts, P&L and OCI. P&L plus OCI put together is called as total comprehensive incomes. Clear? P&L and OCI put together is total comprehensive income. There are certain minimum contents in the P&L, but please remember that word minimum content is not applicable for OCI. Though I have written minimum content, it is contents of OCI which is rigid, fixed. But P&L has certain minimum contents. Revenue from operations, non-operating income. What is a non-operating income? I have been into trade of furniture or steel, but I have certain fixed deposit on which I get interest. I got a tax refund in the previous year. So all these are non-operating incomes. Finance cost, which is your interest cost or borrowing cost, as we have mentioned under Ind AS 23. Impairment, that we have studied under Ind AS 36. Tax expense, which we have dealt under Ind AS 12. A single amount attributable to discontinued operation, profit or loss from discontinued operation, as dealt under Ind AS 105. The share of profit I receive from a joint venture or an associate or a subsidiary. All these are basic minimum contents of P&L. These are basic minimum contents of P&L. Revenues from operation, all non-operating incomes, finance cost, impairments, tax expense, profit or loss from discontinued operation given in a single amount, share of profits from joint ventures, associates or subsidiaries. These are basic minimum contents in the P&L. Any other heading is possible? Yes. You can include as many headings as possible. Administration cost is generally one more heading. Marketing cost is one more heading. Distribution cost is one more heading. Salaries is one more heading. So all these are also other headings, but at least these contents should be predominantly disclosed as a separate line items in the statement of P&L. But I come to OCI, revaluation surplus created as per Ind AS 16, actuarial gain or loss as per Ind AS 19, FCTR amount as per Ind AS 21, or other items related to financial instruments which we will discuss under Ind AS 109. Clear? These are the minimum contents to be presented in the statement of OCI. Both combined is basically giving my total comprehensive income. What is your statement of changes in equity? I skipped one statement. What is that? Statement of cash flows, because I said statement of cash flows is defined as per Ind AS 7. Separate standard is already presented there. Therefore, I'm skipping that. I'll go into statement of changes in equity. Statement of changes in equity is a peculiarly new statement emerging as per Ind AS, because it requires you to present what is the total comprehensive income which emerged out of statement of profitability, and any other retrospective changes which affect the retained earnings resulting from change in accounting policy or errors, which we will deal under Ind AS 8. In the Ind AS 8, the second point regarding statement of change in equity will be dealt with, where there is a retrospective change in retained earnings resulting from a change in an accounting policy or an error. But in general sense, a statement of changes in equity should present a reconciliation for each reserve. Each reserve should present what is the opening balance of the reserve, what is the addition to the reserve in the current year, what is the utilization or deduction from the reserve in the current year, and finally the closing balance of the reserve. Guys, your statement of changes in equity will predominantly be presented in this way. Your reconciliation statement will be presented more or less like this. SOC. Each reserve will become your heading. So sometimes I can have a securities premium, or I can have a P&L, or I can have a general reserve or a capital reserve or my retained earnings, which is nothing but your P&L, and total. It should start with the opening balance of the reserves at the beginning of the year, should be increased by additions during the year, should be added with the additions during the year, should be reduced by utilizations during the year, and finally we'll come to closing balances. This is a reconciliation statement which every enterprise has to present as a part of its statement of changes in equity. They'll have to present each reserve's opening balance and their reconciliation to the closing balance, where there is an addition during the year and there is a utilization. Remember, under retained earnings, the additions during the year are generally in the form of total comprehensive incomes. TCI is an addition. Utilization is in the form of dividend paid, along with CDT, corporate dividend tax. This part of CDT we have already dealt under Ind AS 12, where we said CDT, though is a charge against profit, it should not be presented in the statement of P&L, but it should be presented as an adjustment in other equity. So this is the adjustment in other equity where we record. Clear? So statement of changes in equity should include at least a total comprehensive income, should at least include the retrospective effect in retained earnings resulting from a change in accounting policy or errors in previous years, and then the reconciliation of each reserve has to be presented, where we start with the opening balance and derive the closing balance after adjusting the additions and utilizations during the year. What are the disclosures required as a part of your notes to accounts? In your notes to accounts, I should first start with an explicit unreserved statement of compliance to Ind AS, which we started the Ind AS 1 with. Apart from that, basic company's information should be provided. The company's name is so-and-so, incorporated under so-and-so, having a registered office at so-and-so, and closing its financial statements on 31st March or 31st December each year. So this is the basic company's information which has to be presented. Significant accounting policies adopted in preparation and presentation of financial statements also should be disclosed. the disclosure requirements as per any other Ind AS, like Ind AS 24, Ind AS 108. There are particular disclosures which have to be made, and those disclosures as per the respective applicable Ind AS also should be made as a part of your notes to accounts. Any additional disclosures can also be made as a part of notes to accounts to make the financial statements more reliable and more relevant. So I'm saying notes to accounts is not a compulsory limitation. You can have multiple more disclosures which will make the financial statements more reliable and more relevant. Remember, I'll always start with explicit unreserved statement of compliance to the Ind AS applicable to the enterprise, then giving you the basic information regarding the company on when it was incorporated, what is its objectives and where is the registered office, what are the significant accounting policies it adopts in preparation and presentation of financial statements, any disclosures as required by the respective Ind AS applicable to the enterprise, and apart from this, you can give some additional disclosures which you feel necessary will make the financial statements more reliable and more relevant. Clear? So this is my statement of changes in equity along with notes to accounts, disclosure required there. Always present your financial statements on comparative basis. That means your balance sheet, statement of profitability, cash flow statement, statement of changes in equity should always be presented comparable from the current year to the previous year. However, your notes to accounts need not be prepared on a comparative basis. It is only the current year notes which has to be presented for. Clear? A comparative information is compulsory. You will see a different comparative when we talk about Ind AS 34 interim financial statements. Under interim financial statements, there is a word called as year to date which comes up. So which is absolutely a different concept. But when I'm talking about Ind AS 1 presentation of financial statements, which should be prepared at least once annually, in such case, the current year amounts should be compared with the previous year figures for balance sheets, statement of profitability, statement of cash flow, and statement of changes in equity. While the notes to accounts need not be presented on comparative basis, last year notes is unnecessary. Only the current year information should be presented in notes to accounts. The principles which we follow in preparation and presentation of financial statements. The concept of accrual, the concept of going concern. If there is a compliance to going concern, then there is no disclosures necessary. But in case there is a non-compliance, then your financial statement should be presented on liquidity basis. Balance sheet has to be presented under liquidity preference method. Along with that, you also have to disclose why the company has presented the financial statements on liquidity approach and what is the fact which has actually affected the going concern of the enterprise. Materiality is also a principle which we have to consider in presenting financial statements, because you need to make the financial statements reliable and relevant. Relevant is what I'm talking about here. Relevant means all unnecessary small immaterial items should not be presented, to make sure that the financial statements are way too elaborate and therefore it creates a lot of confusion. This same materiality concept has also been applied under Ind AS 108. If the number of reportable segments, there is no limitation. But if it exceeds 10, then the management should understand what is the reasonability of the segments being reported. So therefore, materiality is not just applied in Ind AS 1, it is also applied in other cases as well. When I talk about materiality, fundamentally two types of materiality will be coming up. Quantitative materiality and qualitative materiality. An enterprise like Reliance, having a turnover of 4.5 lakh crores, 4.5 lakh crores is a huge amount, has a small item as winning from lottery for 1,000 rupees. I round off in crores, then itself the 1,000 rupees became immaterial. Should I actually consider it as material? Yes, it should be considered as material. Though it is not quantitatively material, it is qualitatively material, because the nature of transaction is not in line with the objectives of the enterprise. Clear? Quantitative materiality is based on the volume of the transaction, while qualitative materiality is based on the nature of the transaction. Clear? Offsetting. Guys, this concept of offsetting comes in Ind AS 12, whether a deferred tax asset and a deferred tax liability can be offset. You will also get under financial instruments where a financial asset and a financial liability can be offset. Remember, whenever the concept of offsetting comes into picture, the rules of offsetting are laid down very simple. Number one, they should be legally enforceable for offset. That means the asset and liability can be offset legally. For example, I have a deferred tax asset emerging from unabsorbed depreciation. I have a deferred tax asset emerging from unabsorbed depreciation. I have a deferred tax liability related to a capital gain. Is it legally enforceable for set off? Can a capital gain deferred tax liability be adjusted against unabsorbed depreciation under PGBP? Not possible. Therefore, it is not legally enforceable for the deferred tax asset and deferred tax liability to be set off. So, therefore, you cannot offset. Is legal enforceability the only condition? No. He said the entity intends to settle the items on net basis. If the entity intends to offset the items and present it on net basis, then only the enterprise can show so. Okay. So accrual basis, going concern, materiality, offsetting. These are the four things that we have discussed as a part of principles in financial statements. Clear? And that will bring us to the end of discussion on Ind AS 1, where we talk about presentation of financial statements, where the standard prescribes the basic minimum content of financial statements. Corporate enterprises should follow Schedule 3, but any non-corporate entity, if it is adopting Ind AS, should present its financial statements in compliance to Ind AS 1. Clear? Yes, guys. So now let's look at the concept of your Ind AS 10, which deals with events occurring after balance sheet date. What are these events occurring after balance sheet date and how is it significantly affecting your financial statements? Events occurring after balance sheet date are all such events which occur after the date of your balance sheet but before the date on which the financial statements are adopted by the board of directors. So the board of directors have to first call for a board of directors meeting and adopt the financial statements which were drafted. So between the date of balance sheet up to the date on which the financial statements are adopted, whatever transactions happen or whatever events occur, they should be considered as events occurring after balance sheet date. What is the significance? Balance sheet is already drafted, it's already closed. So that is where he says, if there is a material event which occurs, then such material events have to be classified between an adjusting and a non-adjusting event. What is a material event and what is a non-material event or immaterial event? A material event is one which affects the decision making of a user. A user who is accessing your financial statements, if it affects his decision making process, then you can call it as a material event. All immaterial events are such events which have occurred but will not significantly affect the decision making of the user. They are called as immaterial events. Now, what is the significant concept here where I talk about adjusting and non-adjusting events? But remember, guys, this standard predominantly talks about adjustments and also talks about certain exceptions. The exceptions are the ones where serious testing has to be done, and even your ICAI in your examinations has laid a greater emphasis as far as these kind of exceptions are concerned. So let's see what are these adjusting events and non-adjusting events and also what are the exceptions. So from the balance sheet date up to the date on which the financial statements are adopted or approved by the board of directors or a similar body. What are adjusting events? A condition which is existing on the balance sheet date, further evidence which is received after the balance sheet date is called as adjusting event. Clear? It is called as adjusting event. What is a non-adjusting event? No such condition is existing on the balance sheet date is called as a non-adjusting event. Let's try to understand with the help of an example. Let's say for suppose we come across a situation like this. There is a fire accident which occurred on 1st of March. By 31st of March, I've still been dwelling under this pressure of fire accident. I've been trying to salvage things from the fire accident. On 15th of April, the enterprise has gone for filing for an insolvency or a winding up petition. So what happened? The event occurred before the balance sheet date. Condition which led to the insolvency was existing on balance sheet date, but the further evidence was only received after the balance sheet date. These are called as adjusting events. While a non-adjusting event is one such where there is no condition. That means fire accident occurred on 10th of April and the insolvency was also filed after 10th of April. Therefore, both the events and the condition is existing after the balance sheet date. In such cases, they are non-adjusting. Clear? Whenever I talk about an adjusting event, it should be adjusted in my books of accounts. That means I'll have to recognize the transaction in my books even though the event has occurred after the balance sheet date. Let's say there is a customer to whom I've sold goods in the month of February. And the customer had a credit period of 60 days. That means he could make the payment in April. I am presenting such customer as a debtor in my books of accounts. Unfortunately, there was a fire accident which occurred in his premises on 20th of March and he has filed for a winding up on 15th of April. So exactly by the time the amount fell due, I realized that this customer is not going to make the payment. As on 31st March, he did not file for insolvency, but there were conditions were still existing which led to his insolvency. So in such cases, if the condition was existing, but I got the evidence of his insolvency only in April, I'll have to recognize a bad debt in my books as on 31st March itself. As on 31st March itself, I will either create a provision or I'll write off the debtor completely as bad debt. Clear? While I talk about non-adjusting events, no such transaction has to be adjusted. You don't need to make any changes in your books of accounts. But if there is a material event which occurred and it is non-adjusting in nature, you have to at least disclose to make sure that the user knows that such a material event has actually occurred. Clear? But if it is immaterial, no such disclosure is necessary, no recognition or no adjustment in books of accounts. Guys, this part should be under non-adjusting events. The arrow mark is slightly wrong. Should have started with non-adjusting events, no adjustment in books of accounts, but disclose if it is material, ignore if it is immaterial. What are exceptions? The first exception is regarding proposed dividend. A dividend is proposed by the board of directors. After it gets proposed by the board of directors, it goes into the AGM. In the AGM, all the shareholders will vote, and after the resolution is voted in favor, then the dividend becomes payable. From the date of resolution, within 30 days, the amount of dividend should be paid to the shareholders. This is the sequence of event. If an entity made a profit during the current period, there is a liability existing for payment of dividend. There is a liability for payment of dividend to shareholders already existing on balance sheet date. However, I know that the liability arises only if the resolution is passed in the AGM. Remember guys, a resolution might be declined in the AGM also. For example, the shareholders are crying saying that why are you declaring such a low amount of dividend? I want a higher amount of dividend. In such case, the resolution is not passed. In such case, I will have to make sure that I call for another AGM with a revised resolution regarding passing of the dividend, and the AGM has to resolve for passing the dividend resolution. But let's say for suppose in the AGM, the management says we are not interested in declaring dividend, but since you people are insisting, we are declaring. But however, we want to see your reaction. All the shareholders said, no problem, sir. You don't have to declare 40% dividend, give 20% dividend, that is sufficient. Then the resolution can be passed in the same AGM itself. Reduction of dividend can be passed in the same AGM, but increase in the dividend from the proposed dividend should be passed in the adjourned AGM. So this dividend becomes a liability only in the AGM. Until then, it cannot be a liability at all. Therefore, proposed dividend should not be disclosed or should not be presented as a liability. proposed dividend should only be disclosed in your board of directors report, in your notes to accounts, unless and until the AGM has passed a valid resolution. Once the AGM has passed a valid resolution, your dividend becomes a liability. Clear? So proposed dividend concept is eliminated. This has helped us a lot as CA final students because there were so many adjustments and consolidation which now you don't have to learn because proposed dividend by itself has been removed. Clear? Now, one more adjustment, non-adjusting event which has an exemption is a long-term arrangement, a long-term loan arrangement. Let's say, for suppose, to understand this, I'll take an example, guys. Let's say, for suppose, I have 100 crore long-term loan from SBI. Okay. As per the terms of the contract, he put a condition saying that this is fundamentally for 10 years loan, long-term loan, right? 10 years. But he put a condition saying that if there is a default, by the enterprise, in 3 EMIs, then the long-term loan gets converted into a demand liability. Then the long-term loan gets converted into a demand liability. This is exactly what the terms of the long-term loan were. I took a 100 crore loan from SBI for 10 years, but the condition was you should not default for 3 EMIs. If you have defaulted for 3 EMIs, then the long-term loan gets converted into a demand liability. This is what he said. I said, fine. Exactly, COVID came into picture, and from 1st of April 2020 up to 31st December 2020, I have not paid, or there is a default of loan. Default of EMI. Therefore, what happened? Therefore, as on 31st March 2021, which is your balance sheet date, 31st March 2021, this long-term loan is now becoming a demand liability. That means it should get classified under current liabilities instead of non-current liability. Okay. Let's say, for suppose, subsequent to the balance sheet date, I have an arrangement on 15th of June 2021 where SBI restructured the loan. What he restructured there was whatever default loans or default and EMIs are there, the default EMIs of 9 months starting from 1st April up to 31st December were added to the loan. So he's saying you pay it over the loan term. I will make sure that I restructure the loan in such a way that the defaulting EMI gets added to the long-term loan. If such an event has occurred after the balance sheet date, this date should be considered as an adjusting event, even if it is occurring after the balance sheet date or even after the board of directors have already accepted or adopted your financial statements. After the approval of board of directors, also if you get such a condition, you will have to make sure that it should be considered as an adjusting event. Question will be why? Why is that so? Because on 31st March 2021, you will show it as a demand liability since you have defaulted in the material conditions of the loan. But immediately in the next financial year on 31st March 2022, it again becomes a long-term loan and being presented as non-current liability. So comparability is not there, and there's a confusion in the head of the user whether this loan is a current liability or a non-current liability. To eliminate this confusion, he came up with a strategy saying that whenever there is a long-term loan which is payable on demand due to breach of conditions of the borrowing and the restructuring of a borrowing and the terms of the borrowing after the balance sheet date, and where in such a way that the demand loan converts into a long-term liability, it should be considered as an adjustment in adjusting event on the balance sheet date, even if such a restructuring happens after the date on which the financial statements were approved by the board of directors. Clear? This is my second exemption regarding long-term loan arrangements. The third and the last adjustment is regarding going concern, where the going concern of an enterprise is severely affected as on the balance sheet date, then it should be considered as an adjusting item even if the condition was not existing on the balance sheet. Such condition was not existing on balance sheet date, but it has severely affected my going concern. In such cases, it has to be considered as an adjusting item. What is the adjustment? An adjustment where all the balance sheet should be prepared under liquidity preference method. My assets should be measured at realizable values and liabilities should be measured at settlement values, and this is the adjustment regarding affecting of going concern. Whenever the going concern of an event of an enterprise is affected, forget about adjusting and non-adjusting event, forget about whether the condition was existing on balance sheet date. You have to compulsory consider it only as an adjusting event, where I'll present my financial statements in such a way that the assets are presented at realizable values and liabilities are presented at settlement values. And that will bring us to the end of discussion on Ind AS 10. Clear? Events occurring after balance sheet date. There are two simple standards that we're going to discuss from here. First one being Ind AS 8. Ind AS 8 discusses about accounting policies, accounting errors, and accounting estimates. What are these accounting policies? What are these estimates? And what are these errors? Now, first thing, when I talk about a policy is basically like you're valuing inventory on a FIFO basis. It's an accounting policy for us. You can also adopt a weighted average basis for valuation of inventory. So selection between FIFO or weighted average is an accounting policy of the enterprise. What is an accounting estimate? If you remember in Ind AS 16, there were three determinants of depreciation that we have considered: cost, estimated residual value, estimated useful life. So these are estimates which you prepare or which you make in preparation of financial statements. When I have a provision as per Ind AS 37, there should be a reliable estimate of the provision being made. So even there we have come across the word estimate. Who makes an estimate? It is the management which makes an estimate. So sometimes the estimate which the management already made might have a certain change. Why could there be a change? Because circumstances change, situations change. It made me believe that there's a change in the estimate. Let's say, for example, I believe that my bad debts could average about 5% of my total debtors. Okay, it could average about 5% of my total debtors. But there was a COVID crisis which came in and which made sure that my bad debts are not 5% but could be estimated at about 11%. So what happened? The estimate which was earlier made at 5% has now become 11%. So these are change in accounting estimates. Then what are errors? Errors is a mistake that we have done in the previous set of financial statements. For example, there was a cost which was incurred towards construction of a particular building. But unfortunately, by not considering that as a building cost, I might have actually treated it in the P&L, or I have debited it to the P&L instead of capitalizing the cost, which is an evident error. Instead of capitalizing the cost, you have basically made a principal error of treating it as a revenue expenditure. So which is also resulting in certain errors. So rectification of these errors should also be handled in some standard. That is where Ind AS 8 comes into picture. Remember guys, Ind AS 8 picks up a very critical concept of presenting three balance sheets. There are certain instances where we require to present three balance sheets, or basically there are two instances where we present three balance sheets. Now what are those instances? Why do they emerge? And what are these three balance sheets that we have to present? That is our concept of discussion as we progress into Ind AS 8. Let's see what Ind AS 8 talks about. Ind AS 8 talks about accounting policies, their change in accounting estimates, and change in accounting policies, estimates, and errors. What is an accounting policy fundament? Accounting policy is set of accounting principle, basis, conventions, rules, and practices which are adopted in preparation and presentation of financial statements. If you remember, AS1 also had a similar definition of accounting policies. They are set of accounting principles which are applied in preparation and presentation of financial statements. Similarly, even your Ind AS 8 is coming out with a definition saying that accounting policies are set of accounting policies are accounting principles, basis, conventions, rules, and practices which are adopted in preparation and presentation of financial statements. Who has to select an accounting policy? Accounting policy selection is the responsibility of the management. The management chooses or selects which one is a more appropriate policy than the other. Okay, for example, my value of inventories is significantly changing in the past. Let's say petroleum prices. There is a significant change in petrol and diesel prices over the past, and such kind of value of petrol or diesel is in my inventory. In such cases, the accounting policy of the company, the management should decide to be FIFO basis. My inventory should be valued on FIFO basis because the latest value of inventory should be actually represented as an asset so that you don't have an averaging of cost. So selection of accounting policies is a responsibility or vested with the management. Clear? Now, management can select whatever they want. No, the management should select accounting policy in such a way that the financial statements presented by adopting these accounting policies present a true and fair view of the financial position and performance of the enterprise. I'm saying yes, management can select, but the management selection should be based on the fact that the financial statement should present a true and fair view of the financial position and performance of the enterprise. Remember, so while selecting the accounting policy, the management should believe that selection of a certain accounting policy will give you a better presentation to the financial statements based on which they have to select the accounting policy. Clear? Now, as we progress from here on, what are the factors that should be considered in selection of accounting policies? Like I told you, the prima facie criteria is to present the financial statements with true and fair view. But the factors which the management should consider while selecting the accounting policy is to make the financial statements more reliable and relevant. So whenever I select an accounting policy, such selection of accounting policy should have the underlying objective of making my financial statements reliable and relevant. When do you say a financial statements are presenting information which is reliable? If the source of information which is utilized in presentation of financial statements, they faithfully represent the financial performance and the position of the enterprise. That means the source of information which I have considered, it faithfully represents the financial position and performance of the enterprise. Like I told you, the inventory valuation. If the inventory value is changing significantly, then it is always better to go with FIFO basis, because FIFO gives you a better valuation of inventory under changing valuation terms. In such a case, you have to make sure that I'm presenting faithfully the financial position and financial performance only if the inventory is valued on FIFO basis. That is to make the financial statements more reliable. What do you mean by relevant? It is relevant to the user to make economic decisions based on the financial statements drafted. Information presented in the financial statements is helping the user in economic decision making. Then you can say that these financial statements are relevant. Guys, timeliness of the information is very important to determine relevance, because if I have a certain disclosure being made in the current financial year which belongs to 3 years before, it is not going to be relevant because the time has already elapsed. That is the reason why relevance has to be understood in the sense that the information presented is timely in nature. That's why if you remember in days 10, when we talk about events occurring after balance sheet date, even non-adjusting items, if they are material, they should be disclosed. Why are you disclosing? I am disclosing such events even though they are non-adjusting, because they are material, because they make the financial statements more relevant for the user to take appropriate decisions on. Clear? So whenever I select accounting policies, my underlying principle for the management is to present financial statements with a true and fair view, to make sure that those financial statements are reliable and relevant. When do I say the financial statements are reliable? If they use information which faithfully represents the financial performance and position. When do you say that they are relevant? Then the information presented in the financial statements is helping the user in making economic decisions. What about a change in an estimate? A change in estimate is possible because let's say when I start my CA final preparation, I pass my CA inter, I'm sitting down with CA final preparation, I'll say, see, inter went off somehow I passed it, but CA final focus will be different. So let us look at 60, 60, 60, 60 in all 8 subjects. First subject, that is my first estimate, okay? First subject, my preparation started. I understood that the first subject was tend to be a little more easier than I thought. I thought, why 60? I think I can score a 70 here. Change in estimate. Second subject came in. Third subject came in. Your auditing subject came in. Auditing subject, I started reading. I felt every paragraph is the same. I'm talking about my situation, okay? I'm not generalizing, okay? There might be an auditing faculty who might be very offended with what I say, but I felt more or less all the paragraphs were talking about the same thing. Substantive and compliance procedures, true and fair view. So everything was almost looking the same. So I said 60 is not possible here. Let us target 45. 40 is too much of a margin, okay? So 45 is fine. So what happened? Again, there's a change in accounting estimate. I went and wrote the exam, estimate changed. When I actually got the result, estimate changed. So whenever this happens, estimates are changing based on time, based on situation. Because estimates always require a degree of judgment by the management. So in preparation of financial statements, there are a lot of accounting estimates which are applied. An estimate in provision for bad debt, an estimation and provision for taxation, an estimate for identifying the present value of defined benefit obligation under Ind AS 90, an estimation regarding estimated residual value, an estimate regarding estimated cost of dismantling, an estimate regarding estimated useful life. So many estimates have kept on coming. Every estimate, the management applied certain judgment. A management has applied certain judgment. Every judgment I make, today there is a match between India and Pakistan, let's say. I make an estimate that India is going to win this match by chasing the match by at least six wickets. Now, in making this estimate, I have certain assumptions, assuming that Pakistan is not going to put up a very big total. The judgment which I made was based on the fact that I find that in the recent past, the performance of India was much better than the performance of Pakistan. Therefore, there are certain judgments which I am making based on certain assumptions. So therefore, whenever an estimate is made, it requires certain judgments based on certain assumptions. Such assumptions and such judgments based on which a management estimate is valued should be disclosed in your notes to accounts. Accounting estimate uses a degree of management judgment, and the assumptions made in arriving at those estimates should be disclosed in my notes to accounts. Can the estimate change? Yes. If the estimate is changed and it affects only the current year, then you simply recognize in the P&L. But if the estimate is changing even the estimates made in the presented in the previous financial statements, I will not restate the previous financial statements. A change in accounting estimate should only be given a prospective effect. So from the date of change in estimate, I'll only look at the subsequent form. Under Ind AS 16, one question which we have seen was a change in the estimate regarding dismantling cost. Whenever there was a change in estimate of dismantling cost, I never changed the previous year depreciation. I never changed the previous year provision. From the date of the change, I will recalculate the present value of the decommissioning cost and I will incorporate it into the cost of the asset in such a way that my subsequent period finance cost on the provision and also my subsequent period depreciation changes. So to the extent it affects the previous period, I will not make any restatement. I will only apply the effect of the change in estimate on a prospective basis from the date of change. But to the extent they affect the future periods, yes, it affects the future period. I'll have to disclose it in my notes to accounts. Clear? Now comes the most important part. This is where I have a lot of discussion because we come across a concept of retrospective restatement here. So we talk about change in accounting policy. Guys, accounting policy should be consistently applied over various accounting periods. However, though you have a consistency principle, there can be a change in accounting policy. What are the reasons for the change in accounting policy? A change in accounting policy can arise due to two reasons. One, the change is required by the Ind AS. Earlier, I was adopting Ind AS 17 for leases, but now Ind AS 17 is replaced with Ind AS 116. Automatically, I'll have to change the accounting policy for recognition of leases where Ind AS 116 have to be incorporated, where I start recognizing ROU asset. So all these changes have to be made with respect to the change in Ind AS. That is the first reason for change in accounting policy. Second reason for change in accounting policy is where the management believes that a change in accounting policy will give me a better presentation of financial statements, making my financial statements more reliable and relevant. What is this? Until last year, my oil prices, petrol and diesel, were not changing so significantly. They have always been traded between 70 to 75 rupees. So I adopted weighted average cost model. But due to COVID or subsequent due to fiscal deficit that we are suffering in India, the taxes on this particular diesel and petrol prices have gone up. And since the barrel rate of oil is also going up in the open market, there is a significant change in the petrol and diesel prices because governments are not ready to cut down on the taxes. Why? Because fiscal deficit. The total revenue of India is 22 lakh crores. 22 lakh crores is the total revenue of India. But the budget projects an expenditure of 35 lakh crores. That means there is a deficit of 13 lakh crores. Now, where will they finance this 13 lakh crores out of? They'll have to finance it out of disinvestment policies or by raising taxes. So that is exactly what is happening. I'm not supporting any particular thing, but I'm saying that is how the dynamics of finance actually work. Let's say my financial commitment is 1 lakh per month, but I have only a salary of 65,000 per month. Then this 35,000 has to be financed out of something. What do? Take a loan, right? Or do something else, do an additional activity, or I work 2 shifts a day, or I work on a part-time basis somewhere. So something has to be done to increase the revenues of your personal growth. Same thing with the company, with the government as well. So my petroleum and diesel prices started growing and they became so badly that today they are almost touching 90 to 100 rupees. So what happened? Instead of adopting a weighted average cost, I felt it was more appropriate for today's date to appropriate a FIFO, to identify a FIFO basis for valuation of inventory. So there is a change in the value of inventory. There's a change in the accounting policy. Why did you change? Because the management believed that a change in accounting policy is going to give a better presentation to my financial statements. It is going to make my financial statements more reliable and more relevant. So this is the second reason. First reason, I have nothing to do with it. Ind AS changed, so I changed. Statute changed, so I changed. Number 2, I changed because I feel that this change will make my financial statements more reliable and more relevant. Will give a better presentation to my financial statements. These are the two reasons why I can change an accounting policy. What happens when I change an accounting policy? Accounting estimate, very simply you said, always apply it on a prospective basis, so no effect on the previous period. Current year changes you recognize in P&L. Future period changes you disclose in notes to accounts. Simple, over. But when I talk about change in accounting policy, it will have a significant impact. If the first reason is a reason for your change in accounting policy, that means there is a change in the statute or there is a change in the another Ind AS, then in such cases I will apply something called as transitional provisions. You remember Ind AS, when Companies Act 2013 was brought in, Schedule 2 came in 2014 onwards. Due to change in Schedule 2 depreciation, there was a significant difference in the carrying value of assets of each enterprise, because of which the Companies Act has come out with some transitional provisions attached to Schedule 2. If you remember recently when Ind AS 116 came in for leases, then also he has proposed some transitional effect starting from 1st of April 2019. So these transitional changes are necessarily stated within the Ind AS or the statute itself. So whenever there's a change in accounting policy, pursuant to a change in the statute or pursuant to a change in Ind AS, then the change in Ind AS accounting policy should be given effect to with respect to the provisions of that particular standard. These are called as transitional provisions. Clear? Every new standard comes in, it will always propose some transitional effects. So those transitional effects should be complied with. Most important is the second one. When you changed an accounting policy, because the management was of a view that a change in accounting policy gives a better presentation to the financial statements. In that situation, there is a significant amount of discussion that has to go in. First change, I simply said, whenever there is a change as per the statute, then apply transitional provisions as given by the statute or the Ind AS. But it is due to a change in the opinion of the management that the change in accounting policy gives a better presentation and makes the financial statements more reliable and more relevant. In such case, there has to be a retrospective application. What do you mean by retrospective application? Retrospective application means apply the change in accounting policy from the date on which the transaction first occurred to the enterprise. Apply the change in accounting policy as on the date on which the transaction first occurred to the enterprise. Inventory valuation policy you changed, so you have to change the accounting policy from the date on which first transaction regarding inventory has occurred. First time when you issued inventory for production. Sir, 35-year-old enterprise, my first inventory issued was 35 years back. From then, FIFO I followed. Now I'm following weighted average. Suddenly a change in accounting policy. You're asking me to give an effect of this change from 35 years back. Is it possible? Is it practical? Retrospective application should be given for the change in accounting policy from the date on which the transaction first occurred to the enterprise. This has a lot of impracticality. If it occurred only 1 year back or 2 years back, it is fine. But the organization has a history of 50 to 60 years, and the first transaction of similar nature occurred 60 years back. From where will I give such change? It is impractical. That is why he says, apply the change from the beginning of earliest period reported. Apply the change of accounting policy retrospectively, but not from the first date on which the transaction has occurred, but from the date on which, from the date of beginning of the earliest period reported. Let's understand what this is. Let's say, for example, my enterprise X Limited was established in 2010. Okay. I had an inventory valuation which was on FIFO basis, which was effective from 2010 itself. Okay, FIFO basis you have been followed. Now let's say this was 2010. Okay, this is 1st of April 2020. Financial statements ending on 31st of March 2021. Somewhere around here during this financial year, my inventory valuation has changed. Inventory valuation at weighted average cost, WAC. I've changed from FIFO to weighted average cost. So what is the provision saying? Since you have changed to weighted average cost, based on the management's contention that it gives a better presentation to my financial statements, making my financial statements more reliable and more relevant, I'll have to apply this change with respect to 2020. With respect to 2020, on the date on which the transaction first occurred. Date on which transaction first occurred. This is called as retrospective application. Retrospective application of change in accounting policy. But he is saying if this is impractical, if impractical, then instead of doing this, I can give an effect to from the beginning of the earliest period reported. What is the beginning of earliest period reported? Current year is 1920. Previous year, earliest period reported starting from 1st April 2019, ending on 31st March 2020, always presented on a comparative basis. So earliest period reported is 1920. Beginning of earliest period reported from the beginning of earliest period reported. When if it is impractical to apply the retrospective application of the change in accounting policy from the date on which the transaction first occurred, in such case I will change or I will give an effect to such change in accounting policy from the date of the from the beginning of the report, the earliest reporting period, that is 1st April 2019. Clear? In this case, the effect of change as on 1st April 2000, effect of change, first one, as on 1st April 2019, effect of change in the financial year 2019-20, and effect of change in financial year 2020-21. Whenever there is an effect of change as on 1st April 2019, whenever there is a change with respect to 1st April 2019, in such cases, the effect of change on 1st April 2019 should be recognized in retained earnings. Recognized in retained earnings. whatever effect happened due to restatement of 1920, we'll have to restate the financial statements of 1920. Similarly, I will restate financial statements even for the financial year 2020-20. In this case, my P&L or cash flow statement or statement of changes in equity, these on a comparative basis should be current year versus previous year, where I will compare 2020-21 to the restated previous year 2019-20. I will compare it with the restated previous year 1920. But when I talk about the balance sheet, this is where the most important logic lies. Balance sheet, when I have, instead of presenting only two balance sheet dates as comparatives, where I'll compare 31st March 2021 compared with 31st March 2020, here I will add one more, which is 1st April 2019, that is the beginning of previous year in which the change in accounting policy was given effect to. If this is my current year and this is my restated previous year which is compared with, then I'll have to give an effect or I have to present even the beginning of financial year, the date of retrospective application. The date on which the change in accounting policy was retrospectively applied. The date at the beginning of the earliest period, reported, that is 1920's beginning date, 1st April 2019. So in this case, I'll have to present not just two columns in the balance sheet, I'll have to present the third column in the balance sheet as well. Let's look at what the PDF says. Change in accounting policy for the year 2018-19 has to be given effect from 1st April 2017. Assume that such a change has occurred at the beginning of earliest period reported. Guys, remember this language you will come across even under Ind AS 33 when we talk about shares issued for nil consideration, where there is a change in number of shares without commensurate change in enterprise resources. Remember, the language will be the same. Application 1st April 2017, that is the beginning of the previous period, previous financial year. Cumulative effect up to 1st April should be recognized in retained earnings. 2017-18, the previous year, should be restated to ensure comparison with the current year 2018-19. So in comparatives, current year of 2018-19 should be compared with the restated previous year of 2017-18, and the date of transition should be the extra column which is applied. That is a date on which we gave a retrospective application to the change in accounting policy. Clear? So what are we saying? We said we can change an accounting policy, though accounting policy should be consistently applied over various accounting periods. But the reason for change in accounting policy can only be due to two reasons. One, there's a change in the statute or the Ind AS, or the management is of an opinion that a change in accounting policy makes my financial statements more reliable and relevant, making them better presentation of financial statements. Whenever there's a change in accounting policy with respect to a change in statute or Ind AS, apply transitional provisions given in the statute or Ind AS. But if in case I'm changing it due to the change in opinion of the management, then I have to give a retrospective application. What is retrospective application? The date on which such transaction first occurred should be the date on which I will start applying this change in accounting policy. If it is impractical, then at least give a retrospective application to a change in accounting policy from the beginning of the earliest period reported. beginning of earliest period reported is nothing but the beginning of the previous year. Clear? This is the concept, a very important concept which deals with change in accounting policy and where we require to present 3 balance sheet dates instead of 2 balance sheet dates, and which requires a restatement of the previous year, restatement of P&L in the last year, restatement of cash flow statement in the last year, restatement of statement of changes in equity in the last year, and also requires the restatement of the balance sheet of the last year. And along with the last year's balance sheet, we'll also have to present the third balance sheet, which is at the beginning of the day, which is the date of retrospective application of change in Ind AS. Clear? Yes, guys, since we are done with accounting policies, let us go with errors. What is an error? Error results from an omission or a material error that occurred in the previous years. Let's say, for example, a material error occurred in the previous year. What do? I'll correct the error in the previous year itself. My correction of the error will occur in the previous year itself. Therefore, in the current year, when I'm presenting the comparatives, I will compare current year with the restated or corrected previous year. After the error gets corrected, the previous year restated previous year figures should be presented as comparative. But let's say the error was not previous year, it was prior to the previous year. That means, let's say today current year is 2020-21. My previous year is what? 1920. Error occurred in 1920, then I will correct it in 1920 and I'll restate 1920 so that it is a comparable figure for 2020-21. But let's say error did not occur in 1920, error occurred in 2010-2011. Then what will happen? Then I'll have to rectify the error from the date on which the error first occurred. That means 2021 onwards. So 2011 onwards. So 2010-11, 11-12 get restated, 12-13 gets restated, 13-14 gets restated. Like that, I have to restate 10 financial years. Man, 10 financial years impractical, sir. So what we'll do? If impractical, then rectify at the beginning of earliest period reported. The same way how you have applied for accounting policies, same way you will apply even for errors also. Instead of rectifying the error from the date on which the error actually occurred, since it is way too long back, 10 years is already passed by, I will rectify the error with respect to the beginning of the previous year. Beginning of previous year is again 1st April 2019. Clear? The effect of the error, rectification of the error, should be adjusted in my retained earnings. Very similar to what we have done in accounting policy. Whatever accounting policy is there is retrospectively applied from the beginning of the previous year, and the cumulative effect of that application should be charged to retained earnings. Here also, rectification of an error, whatever happens at the beginning of the earliest period reported, that effect should be charged into my retained earnings. Clear? So even in the case of comparatives, I'm sorry, one second. So in this case also, as far as the comparative is concerned, current year should be compared with the restated previous year and also will be compared with the date on which the error is given effect to. So that means again 3 balance sheets should be given: current year, previous year, beginning of previous year. So therefore, if I go with the same logic of what we have seen earlier, this will be the same case. Error occurred on 15th of August 2010. On this day, error occurred. While closing your financial statements for the current year on 31st of March 2021, the error was identified. So what can you do? First way of doing it is rectify the error from the date on which actually it occurred. Like this, I can rectify error. Or if this is not possible, what can I do? Or I will rectify the error from the beginning of the earliest period reported. That means my earliest period reported current year starting from 1st April 2020, last year starting from 1st April 2019. So I will rectify the error from the beginning of earliest period reported. Beginning of earliest period reported. Clear? So this is exactly how it happens. So whenever we come across such kind of situations where the error has occurred or been identified, then you have to rectify the error from the date on which the error first occurred. If that is not possible, then I'll rectify the error from the date on which, from the date of beginning of earliest period reported. In that case, my current year, which is 2020-21, which is the current year, has to be compared with 2000 or corrected after rectification. Corrected 2019-20 should be compared with, this is the previous year, should be compared with beginning of previous year, 1st April 2019. As far as the balance sheet is concerned, again 3 balance sheets should be prepared. That 1/4/2019 is the date on which the error is rectified. Date on which error is rectified. And whatever effect is there on 1st April 2019, effect of rectification of error should be transferred to retained earnings. The effect of rectification of error should be transferred to retained earnings. On 1st April 2019. Clear? This is the concept of errors, and that will bring us to the end of this standard in days 8, where we talk about accounting policies, accounting estimates, and accounting errors. Now let's get into the standard of Ind AS 20. Ind AS 20 discusses about government grants and government assistance. While government grants should be accounted for, government assistance should be disclosed. Only disclosure is necessary. First of all, what is a government grant and what is a government assistance? Government grant is specifically available to an enterprise. It is particularly given to a particular enterprise. And these are grants which are given either in monetary nature, cash, or non-monetary nature in the form of a kind. Let's say the government as a program, I have set up a plant for waste management plant. An e-waste management plant was set up. So this e-waste recycling plant which I've set up, the government said they will give me 40% of the machinery cost or setup cost, which will be reimbursed. ICAI, which was set up in Hyderabad, Telangana government has given them 50% of whatever is the cost of setting up ICAI there. So could be with respect to the land, also could be with respect to the construction, everything they reimburse 50%. These are monetary grants. Non-monetary grants. ICAI has been allotted a land in financial district of Hyderabad at free of cost. So that is a non-monetary grant. That means a piece of land has been allotted towards ICAI. So these are non-monetary or monetary grants which are available or which are given particularly to a enterprise. It was given to ICAI, not to any other organization. This benefit was given to ICAI and not to anyone else. So these are specific to an enterprise which are called as government grants. But government assistance is not of any particular nature. It is given to a class of enterprises. Let's say, for example, a pharma hub was set up by a state government. As a part of setting up pharma hub, they have also provided a sewage treatment plant which is run by the government and managed by the government. That sewage treatment plant is available to be used by every enterprise which is established or set up in that pharma hub. So what happened? It is a government assistance, no government grant is involved. So treatment of sewage, which is directly connected to a sewage treatment plant, which is managed and set up by the government, is a pure form of government assistance. This kind of government assistance has to be disclosed, has to be only disclosed. Clear? Now, what are these government grants? How do I account for it? and what is a government assistance and what are the disclosures which are necessary is what we have to discuss. First, let us understand what is a government. Government refers to a state government or a central government or a local body or a international body. So it refers to any government agency as well. So government refers to government, state government or central government agencies and similar local bodies or national or international bodies. What is a government assistance? It is an action by the government designed to provide specific economic benefits to an entity or a range of entities qualifying a certain criteria. So certain criteria, if it is satisfied to this enterprise or to any other group of enterprises, if I make certain government assistance available, that should be considered as government assistance. Now, how do I recognize a government grant? I will recognize a government grant when it is reasonably certain. I will recognize a government grant when it is reasonably certain. What is reasonably certain? That I will receive the grant and the conditions attached to the grant are complied with. The entity will comply with all the conditions attached to the grant and the grant will be received. If this is reasonably certain, then you can start recognizing the government grant. Let's say the government has given a piece of land as a non-monetary grant to us. Put a condition saying that for the next 10 years, all the semi-skilled and unskilled workers, 70% should be given to the local people. So therefore, it is reasonably certain that the enterprise will satisfy this criteria of giving semi-skilled and unskilled jobs only to the local people. If it is reasonably certain that the grant will be received, then you can recognize the grant. There are two types of accounting approaches in a government grant. However, only one approach is actually given by your Ind AS 20. This approach is called as income approach. What is income approach? According to income approach, any government grant received should be transferred to P&L proportionately over the period for which the conditions attached to the grant are expected to be satisfied. You need to provide employment of skilled and unskilled workers of at least 70% of total workforce to the local people for the next 10 years. Therefore, whatever government grant I receive, I will allocate it to P&L proportionately to the credit of P&L over the next 10 years. So, I will proportionately allocate the government grant received to the credit of P&L for the period over which the conditions attached to the grant are expected to be satisfied. What is a capital approach? Directly the grant can be credited to capital reserve. This approach is not recognized by Ind AS 20. Ind AS 20 completely revolves around the concept of income approach itself. So credit the P&L proportionately over the period for which the conditions attached to the grant are expected to be satisfied. Recognition of government grant, like I told you, when it is reasonably certain that the enterprise will comply with the conditions attached to the grant and the grant is receivable. And it is reasonably assured that the grant will be received. Now, what if I have received a grant for past compliance? That means I have already complied with the conditions, and as a resultant of the past compliance, I am receiving a grant today. If you have given an employment to the local people for 70% of unskilled and semi-skilled laborer, then you are entitled to a grant on today's date. So therefore, this grant is a result of past compliance. In such cases, an entire amount of grant should be credited to P&L. However, by crediting it to P&L, you are also supposed to give a disclosure saying that the expenditure to meet the to comply with the conditions of the grant was already met in the past and was already debited to the P&L. Clear? This is also income approach, because what is the income approach saying? Credit the P&L proportionately over the period for which the conditions attached to the grant are expected to be satisfied. Conditions attached to the grant are already satisfied and now I am receiving the grant. In such case, directly credit it to the P&L, but also disclose the fact that the expenditure for satisfying the conditions attached to the grant were already debited to P&L earlier. Clear? What is this concept of forgivable loan? Forgivable loans means simple logic. Loan waiver scheme. always a very famous election slogan given by most political parties is your forgivable loan. A forgivable loan means a particular loan will be waived off if certain conditions are met. If I am recognized as a small and medium enterprise and if my loan outstanding is less than 10 lakhs, then the loan will be waived off. So, or sometimes where there could be a concessional loan as well. But first, looking at the forgivable loan, I will recognize the loan outstanding as an income in the P&L if the conditions attached to the grant are already met. So whatever is the loan outstanding, that loan outstanding amount, I will directly put it to the P&L if the conditions attached to the loan waiver have been met. What if the loan is granted at concessional rate? Is there a government grant even in this? Market rate of a loan is 12%. Government is giving you loan under NABARD for agricultural purposes at only 4%. Then there is an 8% of discount. So this 8% of discount should also be recognized as government grant. Then what is a government grant? The government grant is equal to the amount of the loan minus the loan measured at effective interest rate. Now, can you give me an example regarding this? Check here. If the loan granted is 1 lakh and the market rate of interest is 10%, while I was granted a concessional rate of interest at only 5%. This amount is repayable after 5 years at the end with interest payable at the end of each year. So each year 5% on 1 lakh is 5,000. You discount it using present value factors at 10%. At the end of 5th year, I'll pay out 1 lakh, which also you discount it at 10%. If you identify like this, the loan valued at effective interest rate is only 80,950. But what is the actual loan granted? 1 lakh. So 1 lakh minus 80,950, 19,050 rupees shall be considered as government grant as a consequence of loan offered at concessional rate. So whenever loan is offered at a concessional rate of interest that is lower than the market rate of interest, the amount of government grant is equal to the amount of loan minus the loan amount measured at effective interest rate. This 19,050 rupees of government grant should be allocated to the credit of P&L over 5 years. That is a period for which the loan shall be repaid. Clear? Non-monetary grant. After initially when the Companies Act has come in and when Ind AS was introduced, there was only one single treatment of government grant which is given in non-monetary nature. Non-monetary grants should always be measured at fair value. The asset given free of cost should be measured at fair value and the credit should be given to deferred government grant account. This asset measured at fair value should be depreciated and this deferred government grant account should be credited to P&L over the useful life of the asset. Clear? This is called as income approach in alternate 1. But subsequently, the company's Ind AS Amendment Rules 2018 came in. When 2018 amendment came in, starting from 1st April 2018 onwards, there is a second alternative which is proposed, where it says grant received can be reduced from the value of the asset. If the asset is given free of cost, then the asset can be measured at nominal value. So this alternate 2 has emerged only from 1st April 2018. It did not appear before 2018. Until 2018, we had only one way of accounting for it. The asset should be measured at fair value and the government grant should be credited to deferred government grant account. This deferred government grant kept on crediting to P&L over the estimated useful life of the asset. But when alternative 2 came in 2018 onward, 1st April 2018 onwards, he said alternatively you can take another approach where he says you can directly reduce the amount of grant from the value of the asset, or if the asset is given free of cost, recognize the asset at nominal value. This is the only change which happened in government grants Ind AS 20 as on 1st April 2018 due to a change or an amendment in Companies Ind AS Rules Amendment 2018. Remember this amendment very carefully because this amendment has already been tested once. Presentation of government grants. An asset which has received a government grant is received against an asset. There is no distinction. I'll show such asset along with other assets for which there is no government grant received. As far as deferred government grant is concerned, I'll have to present it under current as well as non-current liability. To the extent I will recognize in P&L in the next year or in the next 12 months, I'll recognize it as current liability. To the extent it will reverse after 12 months, I'll recognize it as non-current liability. In P&L, either the government grant can be credited to P&L or can be reduced from relevant expense. Whenever there is a refund of government grant, why does the refund of government grant arise? Because the conditions attached to the grant are not fulfilled. If the enterprise failed to meet the conditions attached to the grant received initially will be refundable. Whenever there is a refund of a government grant, then in such cases, something should be debited, but credit should be to bank. Now, what should be debited? To the extent I have a deferred government grant as a liability, to that extent, reduce the deferred government grant account. If there is furthermore of refund is 100 rupees, deferred government grant account is only 60. So deferred government grant account 60, P&L 40 to bank. Now question comes up, sir, why P&L? Why P&L? Because remember, deferred government grant was earlier credited to P&L. But now when there is a refund of grant, I'll have to debit the P&L. Clear? So reduce the debit the deferred government grant account to the extent it is available. Balance if a refund you need, then make sure that you debit the P&L. What is government assistance? The inflow of assistance which cannot be measured in monetary terms. I'm not able to measure it in money terms. I just received it free of cost, so I'm using it. What is the value of it? I have no idea. Pipeline was already laid down for sewage treatment. I've attached my drainage pipe to that and I kept on sending it. So sewage treatment plant was provided by the government. What is the monetary benefit? I have no idea. Such items will be categorized as government assistance. Such government assistance should be provided either to the enterprise specifically or to a group of enterprise to which it belongs. Any enterprise set up in the pharma hub is entitled to use the facility of sewage treatment plant. May not be specific to your enterprise, but is specific to all other enterprises which are established in the pharma hub. Any enterprise which is set up outside the pharma hub is not eligible to take the benefit of this. General public infrastructure like roads being laid, electricity being provided, water connections being given, these cannot be considered as government assistance. Here, where should I disclose? Notes to accounts. What should I disclose? What is the nature of government assistance we receive? How much extent you receive? And what is the duration for which the government assistance is available? Nature of government assistance, sewage treatment plant, extent of government assistance. So many metric tons of sewage has been treated by the government grant, by the government sewage treatment plant free of cost. What is the duration? It is available for the next 33 years of lease. This is called as government assistance disclosure. Government assistance is where the inflow cannot be measured in monetary terms, no money terms. It is specifically provided to me, my enterprise, or to a group of enterprises to which I belong to. It is not general public infrastructure. General public infrastructure like roads, electricity are not considered as government grant. And that will bring us to the end of discussion on this standard, which deals with government grants under Ind AS 20. Yes, guys. So we will start discussing about a very important standard called as Ind AS 34. Deals with something called as interim financial statements. What is this interim financial statements and why is it so important? An interim period for which a financial statements are prepared is governed under the standard Ind AS 34. What do you mean by an interim period? Any period which is shorter than an annual financial statements or shorter than an annual period is called as interim period. Annual period is generally for 12 months. So if I prepare financial statements for a period shorter than 12 months, then it should be considered as interim period. So you could prepare financial statements on monthly basis or quarterly basis or half yearly basis. These financial statements will be called as interim financial statements. Now, which act expects an enterprise to prepare an interim financial statement? Now, one is the company could voluntarily prepare interim financial statements, or If it has to be a particular statute, then your SEBI listing agreement for any listed enterprise will require you to present financial statements on either quarterly basis or half yearly basis. Quarterly basis for all those enterprises which have their equity instruments listed in stock markets. For any enterprise where the debt securities are listed, you'll have to present financial statements on half yearly basis. So these are enterprises which are required statutorily to present financial statements on interim basis. And such kind of enterprises have to go as per the presentation given under Ind AS 34. Ind AS 34, just like Ind AS 1, talks about the minimum requirements of financial statements. Guys, nowhere under Ind AS 34, it will prohibit you from presenting a full set of financial statements as you prepare at the end of each year. Nowhere Ind AS 34 will prohibit you from doing that. But Ind AS 34 says, look at the timeliness of information. Look at the effort that you put in to generate a full set of financial statements. To cut down on the effort, to reduce the time taken, we will propose a condensed set of financial statements. We present to you a condensed set of financial statements. Condensed set means in brief. If I have a complete standard in 30 pages, I'm trying to cover it as a part of your fast track session in probably an hour or 1.5 hour time. That is concise. So the same way, condensed set of financial statements is a brief version of your full set of financial statements. Clear? So this is what Ind AS 34 talks about. It talks about the minimum requirements to be presented as a part of interim financial statements. Again, I'll repeat, nowhere the standard prohibits an enterprise from presenting its full set of financial statements at the end of each interim period. However, with keeping in view the effort it takes and the time it takes in presenting a full set of financial statements, Ind AS 34 comes out with a condensed set of financial statements. What are this condensed set of financial statements? Let's see. A condensed set of financial statements has a basic minimum components of a condensed balance sheet, a condensed statement of P&L, a condensed statement of changes in equity, a condensed cash flow statement, and selected explanatory notes. It is not condensed notes to accounts, it is selected explanatory note. Now, the intention of Ind AS 34 is to provide an update to the complete set of recent annual set of financial statements. However, Ind AS 34 does not prohibit or does not discourage an entity to publish a complete set of financial statements as described under Ind AS 1 in lieu of condensed set of financial statements. However, because of timeliness of information, it is always suggested to go for a condensed set of financial statements. What is this condensed set? Condensed set of financial statement means in the condensed balance sheet, condensed statement of profitability, condensed statement of changes in equity, condensed cash flow statement. In these 4 statements, at least the headings and subheadings, as they were included in the most recent annual financial statements should be presented. At least the headings and subheadings as were presented in the most recent annual financial statements should be presented in interim financial statements. Clear? However, additional line items can be introduced to avoid any mishandling of facts. If a particular line item, if avoided or if not provided in the interim financial statements, could give a misleading results in the interim period, then such line items should be included. Clear? And along with that, you don't have to give a separate complete notes to accounts. It is sufficient for us to disclose only the material facts as a part of your selected explanatory notes. Clear? How do I present a comparative of this? Whenever I present financial statements for an interim period, then the comparatives should be provided like this. The end of the current interim period balance sheet should be compared with the comparative period of the preceding financial year. So, however, remember guys, whenever I talk about a balance sheet, the end of the current interim period should be compared with most recent annual financial statements. That means, let's say I'm preparing it for Q3 in 2020-21. Q3 is ending on 31st December 2021. Sorry, 2020. it has to be compared with the balance sheet on most recent annual balance sheet date, that is 31st March 2020. So 31st December 2020 should be compared with 31st March 2020 as far as the balance sheet is concerned. However, when I come to P&L, I'll present 4 columns in the balance sheet. 4 columns in the P&L. What are the 4 columns? Current interim period, Q3 of 2021, comparable with Q3 of 1920. At the same time, year to date. What is year to date? Year to date means from the beginning of the current reporting period until the end of the quarter. That means starting from 1st April 2020 up to 31st December 2020 is called as year to date. Cumulative current year to date until the end of the quarter compared with preceding year to date until the quarter. That means what? Current year starting from 1st April 2020 up to 31st December 2020 compared with 1st April 2019 to 31st December 2020. Clear? This is called as year to date. Your cash flow statement and your statement of changes in equity should always be presented only on year to date basis. You will not present it for quarter. It should always be on year to date. So when I'm presenting Q3 statement of changes in equity or Q3 cash flow statement, then it should be starting from 1st April 2020 to 31st December 2020 compared with the comparable period in the previous year, that is 1st April 2019 to 31st December 2019. Clear? For an entity which has a seasonal revenue. Guys, what is seasonal revenues? Seasonal revenue means for a particular season, there's a high demand. During other seasons, there is a particularly low demand. Let's take for the example your air conditioners. During the period starting from March up to August, you will have a significant increase in the demand. But however, subsequent to August, when you start touching the periods of September, October, November, December and Jan, you'll find that the air conditioner sales will try to fall much below the normal level. So that means these are seasonal revenues. Whenever you have seasonal revenues, financial information of 12 months up to the end of reporting date and cumulative information of the previous 12 months in the past period will be more useful to identify. For example, if I am presenting the financial statements of Q3 for such a kind of enterprise, which is highly seasonal in nature, then in such cases, for 31st December 2020, my financial statements will be considering last 12 months. So 1st January 2020 to 31st December 2020. Comparable previous year should be 1st January 2019 to 31st December 2019. This is only possible when the enterprise has seasonal business, highly seasonal business. Air conditioner is a bad example of seasonal business, guys, because today air conditioners are being used throughout 365 days. Disclosures on compliance to Ind AS. There shall be no disclosure unless and until there is a non-compliance. If there is a non-compliance, then the fact should be disclosed. Change of any estimate during the interim period, it should only be given on a prospective basis. So last year interim period should not be restated. If an estimate of an amount reported in the interim period is changed significantly during the final interim period of the financial year, but a separate financial report is not published, then that final interim period, the nature and amount of the change in estimate shall be disclosed in the notes to annual financial period for that year. That means last interim period should not be restated. Same thing we have seen even in the case of Ind AS 8, when we talk about a change in accounting estimate, should always be given a prospective effect. Same set of accounting policies as we have adopted under annual financial statements should be adopted even in interim financial statements, except when there is a change in the accounting policy from the most recent annual financial statement. Sometimes it does happen that you change an accounting policy in the current year, and during that quarter, if you are presenting your interim period, you'll have to change the accounting policy. Clear? Measurement of interim period should always be made on year-to-date basis, and the amount reported in the previous interim period are not retrospectively adjusted. However, the nature and the amount of significant changes is disclosed. Guys, interim period also has to be restated. If you cannot restate the preceding year, preceding interim period, then at least you have to signify the amount and the nature in and disclose those items. Revenues received seasonally or cyclically. Such revenues should not be anticipated, should not be deferred. That means you cannot allocate it over the entire 12 months because they're seasonal revenues. You have to recognize it as revenue in the same period in which they arise. Same is the case even with cost. Cost also, if it is an unseasonal cost, that means it is not an insurance premium. Insurance premium is paid for entire 12 months. So you can evenly spread it over the entire interim periods. But sometimes certain costs cannot be anticipated or deferred. If they cannot be anticipated or deferred, you cannot defer it over the different interim periods. Restatement of accounting policies. We have already seen whenever there is a change in accounting policies, even your prior period financial statement should be restated unless it is impractical. That's it, guys. We don't have too much of discussion under Ind AS 34, but one simple logic you remember under Ind AS 34, you have certain questions regarding measurement of tax during interim period. Most of your questions in ICAI are predominantly regarding measurement of tax expense during a particular interim period. And remember, whenever I talk about measurement of tax for a particular interim period, it should be based on average rate of tax. What is your average rate of tax? We have already discussed average rate of tax when I was talking about Ind AS 12. When there is a slab rate of tax, we apply average rate of tax. Similarly, in Ind AS 34, for us to recognize tax expense during an interim period, we will have to recognize it on the basis of average rate of tax. What is average rate of tax? Total tax expense of the previous year divided by total taxable income into 100 is average rate of tax. Using that rate, I will apply it on quarterly incomes or your interim period income to identify what is the tax expense during the current reporting period. Clear? This is the concept which has been tested. I have included certain examples also regarding that. So let's look at certain questions regarding the standard. So these questions will give you a better understanding. If you want to solve more questions, then you will have to make sure that you're taking more questions from the ICAI study material. But remember, study material is a Bible. You cannot go here and there from study material. Stick to study material. That will always give you a better idea. Okay. Study materials, model test papers, revision test papers. These are your core material which should form part of your preparation. Now, some author's material has 100 questions, 150 questions. You need to understand that you are solving this particular problems for clearing the exam. So, exam conducted by ICAI, material from ICAI is the best. Clear? Let's look at the first question here. XYZ is into manufacturing of tractor parts and mainly supplying components to the original equipment manufacturer. The company does not have any subsidiary, joint venture or associate. During the preparation of financial statements for the year ended 31st March, the accounts department is not sure about the treatment and presentation of the below mentioned matters. The accounts department has approached you to advise in the following matters. So look at the matters that he's asking you. He's asking you to advise him on that. So XYZ is manufacturing tractor parts mainly for supplying to the original equipment manufacturer. There are qualifications in the audit report of the company with reference to two Ind AS. Guys, whenever you have qualifications regard to Ind AS, what do? The company has to still give an explicit unreserved statement of compliance. But along with that, if there is a departure from the Ind AS, they have to mention what is the name of the Ind AS and the paragraphs of the Ind AS that they are departing from or they are not complying with. What is the reason for their non-compliance? And what is the quantifiable effect of non-compliance to certain paragraphs of Ind AS. So there are qualifications in the audit report. Then please make sure that you present an explicit unreserved statement, but at the same time also tell them that certain paragraphs of Ind AS are not complied with. Give your reasons for non-compliance and also give a quantifiable effect of non-compliance. Clear? Is it mandatory to add the word standalone before each component of financial statements? Yes, because we clearly said under Ind AS 1 that they have to prominently present whether the financial statements of the enterprise are presented on a standalone basis or on consolidated basis. Therefore, it is necessary to add the word standalone before each component of the financial statement. Company is an Indian company and it's preparing its financial statements in rupee. Is it necessary to write the financial statements that the financial statements are presented in rupee? Absolutely yes. Because we clearly said they have to prominently disclose the reporting currency and the level of rounding off as well. The company is having a turnover of 180 crores. Company wants to present absolute numbers. Because of the tax audit purpose, the company related filings and other internal purposes, company always needs figures and absolute numbers. Absolutely fine. You have an option to either choose absolute numbers or you can either round off. Guys, very latest yesterday, we have a change in Companies Act which makes rounding off compulsory. But all those who are writing exams in this May and November 2021, you people don't have to bother about it. Clear? But rounding off is optional until yesterday. The company had sales transactions with 10 related parties during the previous year. However, during the current year, there is no transaction with respect to 4 related parties out of the aforesaid 10 related parties. Hence, the company is of a view that it is not required to disclose transaction with these 4 related parties because these transactions there is no transaction in the current year. Guys, remember you always present financial statements on comparative basis. So even though there is no transaction in the current year, they had transactions in the previous year. Therefore, they have to be presented as comparable. Clear? So let's see. First answer. Yes, the company, an entity whose financial statements comply with Ind AS should make an explicit unreserved statement. The entity shall not describe the financial statements as complying with Ind AS unless they comply with all the requirements. No. Should the company disclose that mandatorily add the word standalone? There he says, no, it is required for the financial statements that they are individual financial statements of the company. So just say that they are individual, that is sufficient. You don't have to add the word standalone. Now, looking at the third part where he asked us, should I present rupee or not? Yes, you have to display the presentation currency prominently on the face of the balance sheet. Can I present in absolute numbers? Yes, it is mandatory for requirement under division 2. Third one, what about the related parties? No, as I expect that the Ind AS permits or requires otherwise, the entity shall present comparative information in respect to the previous period for all amounts reported in the current financial statements. Therefore, an enterprise shall include comparative information for narrative and descriptive information which is relevant for understanding the current reporting period. Clear? Look at question number 2 then. The company XYZ is into construction of a turnkey project and has an operating cycle to be 18 months. The company has certain trade receivables and trade payables which are receivable or payable within a period of 12 months from the date of reporting date on 31st of March 2012. In addition, the following items and transactions took place during the financial year. The company has some trade receivables which are due after 15 months from the date of balance sheet. So the company expects that the payment will be received within the operating cycle. Guys, when the payments are expected to be realized within the operating cycle, they should be classified as current assets. The company has some trade payables which are due for payment after 14 months from the balance sheet date. The trade payables fall within the period of operating cycle, though the company does not expect that it will be able to pay these payables within the operating cycle because of the nature of business is such that generally the project get delayed and the payments to customer also get delayed. Guys, whether you are actually making the payment or not is irrelevant. If the amount falls due, that is sufficient. It is expected to be paid within 14 days. For 14 months is sufficient for us to call it as current liability. The company has been awarded a contract of 100 crores. As per the terms of the contract, the company made a security deposit of 5% of the contract value with the customer of 5 crores on 31st March 2012. the contract is expected to be completed within 18 months time. The aforesaid deposit is refundable back after 6 months from the date of completion of the contract. Guys, look at this. This contract, after the completion of the contract, he is giving you 6 months time to refund the money. 18 months is the contract completion time, though that means it is 24 months in total. Therefore, this cannot be classified as current. It should be classified as non-current asset. The company has certain contracts to third parties and has received a security deposit of 2 crores, which are repayable on completion of the contract. But if the contract is cancelled before the contract term of 8 months, it becomes payable immediately. However, the company does not expect the cancellation of the contract. Since the company does not expect the cancellation of the contract and the contract term is 18 months, and after completion of 18 months, this amount is refundable. Therefore, it is a non-current liability. Look at regarding the trade payables. The company wants to present trade payables as current despite the fact that these receivables are 15 months time. Does the decision of presenting the same as current asset correct? Answer is yes. Why? Because the operating cycle is 18 months. Yes, but additionally the company also need to disclose the amount that are receivable within 12 months and after 12 months on the reporting date. What about part B? The company wants to present trade payables as non-current despite the fact that they fall due within an operating cycle. Does the decision of presenting them under non-current correct? Answer is no, because they are payable within an operating cycle. They fall due within an operating cycle. Therefore, they have to be presented under current liabilities only. Security deposit can be presented as current. No, the security deposit should be presented as non-current because it is repayable after 24 months. Can the security deposit of 2 crores taken from the company from the contractors be presented as non-current? No, because they fall due immediately after 18 months. Therefore, they have to be complete, that is within an operating cycle. Therefore, they have to be presented as current. Now, let's look at interim financial statements. The production overheads of the financial year are 10,000. Normal expected production for the year after considering the planned maintenance and normal breakdown and also considering the future demand of the product is 2000 metric tons. Guys, fixed production overheads is 10,000. Normal production is 2000. Therefore, per metric ton, what is the fixed overheads allocated? 5 rupees. It is considered that there is no quarterly or seasonal variation. Therefore, normal expected production of each quarter is 500 metric ton. Fixed production overhead per quarter is 2500. How 2500? 500 into 5 rupees, exactly 2500. But the actual numbers which are achieved are 400 metric tons, 600 metric tons, 500 and 400 metric tons. In this case, how do you present? Guys, always we measure it at 5 rupees per metric ton. Therefore, first quarter, it will be 2000. Second quarter, it will be 3000. Third quarter, it will be 2500. And last quarter, it will be 2000. For 100 metric tons, which is lower than where the normal production is less than the normal production, that 100 metric tons into 5 rupees, 500 rupees is underabsorbed overheads. Such underabsorbed overhead should be charged to P&L. Since there is no cyclical or seasonal variation, normal expected overheads of each quarter of 500 rupees per month, production overheads per quarter is 2500. Fixed production overhead should be allocated per unit of production in each quarter will be 5 rupees per metric ton. So 5 rupees per metric ton is 2000, 3000, 2500 and 2000. Underabsorbed overheads of 500 rupees will be straightforward charged to P&L. ABC Limited manufactures automobile parts. ABC Limited has a net profit of 20 lakhs in third quarter of 2011. Following adjustments were made while computing net profit. Bad debts of 1 lakh incurred during the quarter. 50% of bad debts have been deferred to next quarter. Guys, these are not supposed to be deferred. See, these are not cyclical costs. These are not expected to be deferred even in the annual financial statements. If it is not expected to be deferred in annual financial statements, you are not supposed to defer it in interim financial statement. So the entire 1 lakh should be reduced in computing the profit of the current quarter. How much did he not consider? 50% profit, 50% bad debt he did not consider, that is 50,000. Therefore, 20 lakhs which is already existing should be reduced by 20 lakhs minus 50,000 rupees of bad debts which are deferred should not be deferred. So your net profit of the current year should be reduced by 50,000. An additional depreciation of 4,50,000 has resulted due to a change in method of depreciation. Guys, change in method of depreciation 4,50,000 should be considered in the current quarter. An exceptional loss of 28,000 incurred in the third quarter. 50% of the exceptional loss has been deferred to the next quarter, which is not possible. So minus 14,000. Next one. 5 lakhs expenditure on administrative expenses pertaining to the third quarter are deferred to the fourth quarter, which will have more sales. Therefore, fourth quarter is debited by higher expenditure. These expenditure are uniform throughout all quarters. So this kind of deferral is not possible. So again reduce the 5 lakhs. So therefore the answer is 14 lakh 36,000. Check the last answer. Answer is 14 lakh 36,000. That should be the profit to be reported during the interim period of the third quarter. Entity reports quarterly and earns 1,50,000 pre-tax profits in the first quarter, but expects to incur a loss of 50,000 at the end of each remaining quarter. So next 3 quarters he'll get 50,000, 50,000, 50,000 loss. First quarter he got 1,50,000 profit. So what is the expected total profit at the end of the year? 0. Correct? It is 0 towards the end of the year. The entity operates in a jurisdiction where the average rate of tax is 30%. The management believes that since the entity has 0 income in the year, its income tax expense will be 0. Well, is it correct or not? If not, calculate tax expense as per Ind AS 34. Guys, remember guys, his intention is absolutely wrong. You have to measure it based on average rate of tax. So in the first quarter, I'll recognize a tax expense of 1,50,000 into 30%, which is 45,000. For the next 3 quarters, when the enterprise is making a loss of 50,000, I will recognize a negative tax expense of 15,000. So 45,000 tax expense in Q1 minus 15,000 tax expense in Q2, Q3 and Q4. Ultimately, tax expense will become 0. This is how I present it. 45,000 in first quarter, second, third and fourth quarter, negative 15,000 of tax expense has to be recognized in each quarter. Look at questions on Ind AS 8. A carpet retail outlet sells and fits carpets to general public. It recognizes revenue when the carpet is fitted, which on an average is 6 weeks after the purchase of a carpet. It has decided to subcontract the fitting of carpets to self-employed fitters. It now recognizes revenue at the point of sale of carpet itself. So what is happening here? I am only selling the carpet. I am only fitting the carpet. Immediately after fitting the carpet, which averagely takes 6 weeks, I used to recognize the sale of carpet. But now I am taking a decision of giving it to self-employed fitters. I will recognize revenue at the point of sale of carpet itself. Can the change in recognizing revenue a change in accounting policy? Absolutely no. It is only a change in circumstances which is requiring you to change a revenue recognition procedure, but there is no change in accounting policy whatsoever. So no retrospective amendments. ABC Limited received a demand notice on 15th of June for an additional amount of 28 lakhs from the excise department on an account of higher excise duty levied by excise department compared to the rate at which the company was creating a provision and depositing the same of the transaction related to 2011-12. The financial statements of 2011-12 were approved on 10th August. In July 2012, that is much before the date on approval, the company has appealed against the demand of 28 lakhs. The company is expected that the demand will be settled for 15 lakhs only. Show how the event bearing the financial state will have an effect on financial year 2011-12. Whether these events should be considered as adjusting events or non-adjusting events. Look at the evidence. The demand notice arised only on 15th of June and he has gone on appeal in July itself. So the financial statements are adopted on 10th of August. Ultimately, these transactions have occurred after the balance sheet date, but before the date on which the financial statements are approved by the board of directors. So therefore, these are events occurring after balance sheet date. Are they adjusting or non-adjusting in nature? The liability for payment of excise is existing on the date, but you have calculated it at a different rate, while the excise department is expecting a different rate from you. Therefore, this cannot be considered as an adjusting item. It should be considered as a non-adjusting, it should be considered as an adjusting item because the liability for payment of excise was existing even on the balance sheet date. Therefore, what do? Recognize a provision for 15 lakhs because that is the rate at which he is expecting to settle the demand. So create a provision for 15 lakhs as on 31st March. Events after reporting dates, favorable or unfavorable, that occur between the date of reporting date and the date on which the financial statements are approved by the board of directors and by the corresponding approving authority. In such case of both the entities are issues, those which provide evidence and those which are indicative of conditions. For the instant case, the demand notice has been received on 15 June, which is between the end of the reporting period and the date of approval. Therefore, it is an event after the reporting date. This demand for certain amount has been raised because of a higher rate of duty levied by excise department in terms of goods which are already manufactured during the reporting period. Therefore, the condition was existing on 31st March as the goods were manufactured on the reporting date on which the additional excise duty has been levied. Therefore, this should be considered as an adjusting event. So therefore, the books of accounts have been adjusted to the extent of Ind AS 37 principles by creating a provision to the extent of 15 lakhs. Regarding government assistance, ABC is a government company and is a first-time adopter of Ind AS. As per the previous gap, the contribution received by ABC Limited from the government, guys, it's a government company receiving a grant from the government which holds 100% shareholding in ABC in nature of promoter's contribution have been recognized in capital reserve and treated as a part of shareholder funds in accordance with AS 12. State whether a similar treatment of promoter's contribution as per Ind AS 12 is also permitted under Ind AS 20. Guys, Ind AS 20 will never talk about promoter's contribution. We only spoke about two types of grants, which is a monetary grant and non-monetary grants. No capital contributions by promoters will be considered as a grant. So since it is the promoter who is giving it to the government and who holds 100% share, it should be considered as an amount received from the promoter and recognized in the statement of changes in equity. Under other equity only I will recognize it. I will not bring it to the P&L. You cannot apply any provisions of Ind AS 20 in this case because Ind AS 20 does not talk about promoter's contribution. Government received a grant of 10, A Limited received a grant of 10 lakhs from the local government in 2010-11-12 as a subsidy for selling goods at a lower price to a lower income group population in particular area for 2 years. A Limited account for the grant as income in 11-12. While accounting for the grant in the year 11-12, A Limited is reasonably assured that all the conditions will be complied with. Be careful. A Limited is reasonably assured that all the conditions attached to the grant will be complied with. However, in the year 2015-16, A found that they did not comply with the conditions. Therefore, the notice of refund of grant has been served on it. A Limited has contested but lost in the case, and therefore the grant is repayable. How will A Limited reflect the repayment of grant in its financial statements? Guys, earlier I credited to P&L. Now since there is a refund of grant, I'll have to debit the P&L. Rainbow Limited is carrying on various projects for the company has been received government assistance or in the process of receiving the same. The company has two grants, 1 lakh rupee each, relating to ongoing research and development projects. The first grant relates to Clean River project, which involves research into the effect of various chemical waste from the industrial area in Madhya Pradesh. However, no major steps have been completed by Rainbow Limited to commence. No major step have been taken by Rainbow Limited to commence the research as on 31st March. Guys, since no major step has been taken, as of now, I will transfer this 1 lakh received to deferred government grant. As and when the research continues, I'll keep on crediting it to P&L. The second grant relates to commercial development of new equipment that is used for manufacture eco-friendly substitute for existing plastic products. Rainbow Limited is confident about the technical feasibility and financial viability of the new project, which will be made available for sale in the market starting from April 13. In September, due to floods one of the factory, the entire production was lost and Rainbow was shut down for a period of 3 months. State government announced a compensation package to all manufacturing entities affected due to floods. As per the scheme, Rainbow is entitled to a compensation based on the average of previous 3 months sales prior to the floods, which the company is required to submit an application on or before 30th June. The financial statements of Rainbow are adopted on 31st of May. So therefore, they have not even submitted an application up to 30th June. The financial statements are already adopted on 31st of May itself. Suggest accounting treatment of 2 grants and the flood related compensation. First grant regarding Clean River project, they did not undertake any activity till now. So what do? Involving research of various chemicals, 1 lakh is unconditional as no details relating to the refund have been mentioned. Even though the research has not started or any major step has been completed, the research, yet the grant will be recognized immediately in the P&L because there is no conditions attached to the grant. It's an unconditional grant. Alternatively, in case the grant is conditional, I don't know if it is conditional, then the grant will be recognized in the books as expenditure, over the period for which expenditure will be recognized. Okay, so he's giving you both alternatives. If you treat it as unconditional grant, credit it to P&L. But if you treat it as conditional grant, then expenditure has not been incurred on research phase. So transfer it to deferred government grant. Later on, when expenditure is incurred, you can credit it to the P&L. Second grant regarding development of eco-friendly alternative depreciable asset. As per the information given, the equipment is available for sale from April 2013 onwards. Hence, at the time the grant relates to the construction of the asset should be initially recognized as deferred income. The deferred income should be recognized as income into the P&L over the useful life of asset. Flood related compensation. The Rainbow Limited has already submitted, was not able to submit before 31st of May. So therefore, although the floods happened in 2011, loss was incurred. The entity should recognize the income for the government grant when the application is submitted and approved by the government. Since in 2011, the application is not submitted, then therefore Rainbow should not recognize the grant income as the amount of grant is not receivable. It is not receivable as on 31st of March. That will bring us to the end of our questions for your day. Yes, guys. So let's start our discussion with Ind AS 41. Ind AS 41 is Ind AS 113. Guys, Ind AS 113 is a very typical standard because Ind AS 113 never had any corresponding standard in your IGAP. Like you said, AS 10 comparable to Ind AS 16, AS 26 comparable to Ind AS 38, AS 28 comparable to Ind AS 36. So on, we had a comparable standard at every point of time. But when we come across this concept of Ind AS 113, we do not have a comparable standard under IGAP. So fundamentally, what is the reason? The reasons are very simple. The reason is that this standard, even under IFRS, has only started application from 1st of April 2013. Even under IFRS, this standard started its application from 1st April 2013 only. Prior to that, we never had anything related to fair value measurement, even as per your IFRS. Now, there are multiple places we kept on talking about fair value. Can you tell me where did we use fair value? If you start with Ind AS 16, we said whenever there is an asset which is acquired through a government grant, then it should be measured at fair value. An asset which is acquired by exchange of another asset should be measured at its fair value. Where multiple assets are acquired in a single transaction, then they have to be measured at fair value. Guys, however, certain standards did tell you how the fair value has to be ascertained. But in day 16, when he used the word fair value, he really did not define how the fair value should be ascertained. So that is the reason why you need to understand why this standard Ind AS 113 becomes important. Ind AS 113 is important because these standards of Ind AS 16 did not explain on how to determine fair value. But if you remember impairment recoverable value is higher of your value in use or fair value less cost to sell. How to determine fair value? Determination of fair value we have seen in detail, where there's a binding sale agreement, where there's an active market, bid price has to be considered. So many discussions that we had around determination of fair value for the purpose of Ind AS 36, which deals with impairment. However, there are a lot of standards which does not discuss about how to determine fair value. If you remember Ind AS 2 inventory, he clearly tells you how to determine fair value. But all other standards, Ind AS 109 uses a lot of fair value concepts where the determination of fair value has not been explained on how to determine fair value. So Ind AS 113 becomes very important to us. But at the same time, remember, Ind AS 113 will never tell you when to determine fair value. Because when to determine fair value is as per the respective standard. Ind AS 16, Ind AS 38, Ind AS 40, lot of other standards, Ind AS 109, where we talk about determination of fair value. If you remember even Ind AS 105, it should be measured at lower of carrying value or fair value less cost to sell. How to determine fair value? Not discussed as per that standard. So therefore, whenever we came across those standards where it was emphasizing on fair value, but the determination of fair value is not being explained under that particular standard, we'll have to root back to Ind AS 113 and see how to determine the fair value. That's why I told you the standard Ind AS 113 will never talk about when to determine fair value. So then what does Ind AS 113 talk about? When you don't even say where is the standard applicable, he simply says the standard shall apply wherever the word fair value has been used. That's it. Then what is the objective of this standard? This objective of the standard is to particularly determine how to determine fair value. How to determine fair value is what is the objective of the standard. When to determine fair value is not discussed as per the standard. So broadly, if I want to classify or divide the standard into three parts, then I can classify them into three parts. Number one, what is the definition of fair value? Number two, framework for determination of fair value. Number three, disclosures necessary for fair value. Guys, all the three have enough discussion to go around because definition of fair value is important. At the same time, the crux of the standard lies in framework for determination of fair value. But then the new edition of your notes to accounts is on disclosures relating to fair value. Guys, with a very, very important and a compulsory concepts of disclosures which have to be analyzed in this case. So let's see, where do we start the standard? We start the standard by discussing what is the scope of the standard, where I told you that the term fair value on when to use it or when to use this particular standard Ind AS 113 is not discussed as a part of Ind AS 113. What we discuss as a part of Ind AS 113 is only how to use the word fair value, how to determine fair value. So the scope of the standard is broken down into three parts. One is the definition of fair value. Second one is a framework for determination of fair value. Third one is the disclosures. Clear? So as we progress, we need to first understand breaking down what is the definition. Now you tell me, what do you understand by fair value? Let's say, for example, I wanted to sell my mobile phone. Okay, my mobile phone has become old, so I wanted to sell it. Me and my friend were walking together somewhere, and suddenly I told him, dude, I want to sell my mobile phone. He looked at the mobile phone and he said, "Arey, dude, this is 3 years old mobile, man. What are you people still using it? You have looked at my mobile phone? This is last month launched." So I asked him, yeah, even I wanted to buy that mobile only. Yeah. So what do you think the price I could get from this? And he said, probably about 10,000 maximum. So I said, okay. I stopped there and I told him, give me 10,000, I'll give you this mobile phone. He said, no, I never had an intention to buy it. I'm just quoting from what I can believe that could be the determination of fair value. So your belief of determination of fair value cannot determine the fair value at all. It is your friend's contention that the mobile phone could basically yield 10,000 rupees. That is his determination of fair value. Now let's say I have a lot of memories attached to this mobile phone. I have a lot of memories which are attached to this mobile phone. There's a lot of sensitive data like my passwords which are saved in this mobile phone. So if I lose this mobile phone, then if someone is returning it back to me, I am ready to give him 20,000 rupees also, because that is my assessment of fair value. So fundamentally, when you talk about fair value, is such a sensitive concept that it keeps on changing based on who is perceiving that fair value. Who is perceiving that fair value? I'll give you the best example. I was disposing a particular piece of land in February 2019. I disposed that piece of land in February 2019 and they quoted me 25,000 rupees per square yard. I sold it, immediate requirements of fund, and I came out. In the same area, since I was attached to that area, born in that particular area, I wanted to look at an alternate property after 6 months. And now I asked them, what is the value of this property now? They said it is 35,000. So that means when you go to sell the property, there's a different price which is quoted. There's a different price which is quoted when you wanted to buy the property. Why going up to land? Look at your currency. Your currency, let's say you're traveling abroad and you wanted to buy dollars from a foreign exchange. So when you went to that, Western Union or some other money exchange and you wanted to buy dollars, he has quoted me, let's say 75 rupee 18 paise. I bought $1,000 with the help of my money, quoted at 75 rupees 18 paise, and I bought those $1,000. My trip was completed. I was still left out with $100. I went to the same place and I gave it back to him. I said, give me back my 75 rupees 18 paise. He said, I'm sorry, sir. That is our selling price. Our purchase price is not the same. Our purchase price is only 73 rupee 40 paise. So what is happening? The value at which he is selling the currency is not the same value at which he buys the currency. If you remember, SFM logic, bid price and ask price, always there is a difference, right? So whenever we talk about such kind of logics, we need to come about what is the fair value. Should I take the bid price or should I take the ask price? So that is fundamentally where the discussion goes into what is the fair value and what is the definition of fair value. When I talk about definition of fair value, my fair value can be defined like this. The price at which an asset can be sold or a liability can be transferred. Guys, if you observe, I'm talking about selling the asset. I'm talking about transferring the liability. Did I say a price at which the asset can be purchased or a liability can be acquired? Did I say this language? That means what? I am not looking at purchase price. I'm looking at sale price for determination of fair value. That's why it is called as exit price. Your transaction price is called as entry price. Your transaction price is entry price. The price at which we want to sell it is called as exit price. So fair value is an exit price. It is not an entry price or a transaction price. So a price at which an asset can be sold or a liability can be transferred between market participants in an orderly transaction on a measurement date. So I'll repeat what I said. I said fair value is an exit price. That is a price at which an asset can be sold, an asset can be disposed, or a liability can be transferred between market participants in an orderly transaction on a measurement date. Now let's try to understand what is this market participant, who is this market participant, what is an orderly transaction, and what is a measurement date. First, let me explain what is a measurement date. Fair value is always determined for a particular date, not for a particular period. Net profit for the period of financial year 2020-21 is so and so. That is net profit for a period. Fair value for the financial year 2021 is so and so, not possible. Fair value should be determined with respect to a particular date. Fair value with respect to 31st March 2021 is so and so. So there I'm emphasizing upon what is the date on which the fair value is determined, because their fair value might depend or might differ from one date to the other, might differ from one date to the other. So that is particularly why I say that fair value is related to a measurement date, is based on a particular date on which you measure it. I don't represent fair value for a period. Fair value during March is so and so. No. Fair value as on 31st March is so and so. So always fair value is determined with respect to the measurement date. It is never a measurement period. Clear? So I explained the last part. Let's come above. What do you mean by market participants in orderly transaction? Guys, market participants in simple sense are nothing but buyers and sellers. They are nothing but buyers and sellers. But these buyers and sellers which I am talking about, there are certain essential criteria to be met to call them as market participants. What is this essential criteria to be met to be called them as market participants? Remember, I'll call them as market participants only when there is a willingness to transact. That means the buyer wants to buy, seller wants to sell. Only in such situation I can call it as a market participant. Just like I gave the example. My friend said that this mobile phone could be sold for 10,000. When I asked him, pay me 10,000, I'll give you the mobile phone, he stopped. He said, no, I have no intention to buy. So that means there is no willingness to transact. But for a market participants in determination of fair value, there should be a willingness to transact. Number one. Number two, they should be knowledgeable. What do you mean by knowledgeable? Sir, high IQ levels, sir. GK, amazing, sir. Sir, this guy in his 5th class got 99 percentile, sir. Claps for it. Can I call him as knowledgeable person? Let's say, for example, you are selling a technology-based software product to me. I am a technologically impaired fellow. I have no idea about technology. But I thought your advanced technology is what you're selling. So I wanted to buy it. You cannot call me as a knowledgeable buyer. Because when I call a knowledgeable party, then he should know what the asset can do and what the product cannot do. They should know what the product can do and what the product cannot do. I'll tell you. I don't know how many of you came across this, but there's something called as telebrands, right? There are a lot of advertisements which keep playing on the television. There's a sauna slim belt, huge advertisement, half-an-hour advertisements they play. You put up a sauna slim belt. I find those advertisements very fascinating here. Okay, very fascinating. So there's a person who actually puts up the sauna slim belt, keeps watching the television. Later on, after half an hour, he'll remove it and automatically he has a 6-pack abs. Or for a girl, she has a complete flat belly. Looking at that, I bought it. I bought it so many times. I bought it, I put it, I thought I'll also slim down, but it never happened. So that means I am not a knowledgeable buyer. Had I had the knowledge that you cannot get a flat belly or you cannot lose fat in that particular sauna model, then I can be called as a knowledgeable buyer. Yoko height increases. You wear this under your shoe, automatically you will increase by 2 to 3 inches. Very good. I applied it 2 to 3 inches. Okay, for me it is not necessary, but if someone else wanted to grow height, they applied it. They were not able to grow height. So that means my intention to buy the product is basically assuming that the product has an ability to increase my height. It has an ability to increase my height. But unfortunately, it did not. When mutual fund advertisements come in, to make sure that the market participants are knowledgeable, he gives a last disclaimer. Mutual funds are subjected to market risk. So please read the offer document carefully before investing. I read it very slowly, but they'll read it very fast. That is to make sure that the buyer or the people who are subscribing to the mutual fund policy is aware that not always that the mutual fund gives you a profit. Clear? So fundamentally, you need to understand that when I say a market participant, these market participants are knowledgeable. There should be a willingness to transact and they are knowledgeable parties. Remember, knowledgeable parties. I drank Complan to become taller, stronger, sharper. 3 things he included. Nothing happened. So these are advertising campaigns. I buy Boost, I drink Boost and start smashing every boundary thinking I'm Virat Kohli or Sachin Tendulkar. Is it possible? Just because the advertisement is played by Virat Kohli or Sachin Tendulkar does not mean that you can also bat like them. Now, they did not just drink Boost and come to the match to score so many runs. There was so much effort which happened in before they got into the ground, which is never showed as far as their advertisement is concerned. The advertisement just shows that they drink Boost, come and slam centuries out there. So therefore, you need to understand a knowledgeable buyer is that one who knows what he's buying. He knows that the product has these limitations. He knows that the product can be used like this. I buy Boost because I like the taste of it. I am not expecting myself to become as good as a Virat Kohli or Sachin Tendulkar in cricket. So that makes me a knowledgeable buyer. That makes me a knowledgeable buyer. Clear? So principal market participants are buyers and sellers. I'll discuss about buyers and sellers, but come down below. They're knowledgeable. They're knowledgeable because they can identify the assets and liabilities being transacted. They know for what purpose the asset can be used and what are the restrictions from the use of the asset. There is a willingness to transact. What do you mean by willingness to transact? I am not under any stress to transact. I need immediate funds. So I need immediate funds. So I sold off the asset even at a less than fair value, because that is a necessity for me. I was under a stress to transact. I was forced to transact. I was forced to transact. I never had an intention to sell. That there was so much of political pressure around me that I was forced to sell that particular good. I was forced to sell that piece of land. So that is not a willingness to transact. Willingness to transact appears only when the buyer has an intention to buy. At the same time, the seller also has an intention to sell. Clear? They are independent parties. What do you mean by independent parties? That means buyer and seller are not related to each other. If they are related to each other, then the relation can influence the price. Had it been to an outsider, I might have actually asked you for a higher price. But since you are my friend, I'm giving it to you at so and so price. You cannot consider it as a fair value because they are not independent parties. They are related parties who are entering into a transaction. Clear? So a market participant is a buyer or seller who is knowledgeable, who has a willingness to transact, and the buyers and sellers are independent. There is nothing which is influencing the price of the transaction. Clear? When I say buyers and sellers, I am looking at principal market or most advantageous market. What is this principal market or most advantageous market? I need to understand. Buyers and sellers, for the purpose of determination of your fair value, are such market participants who are in a principal market or the most advantageous market. Let me tell you. If I can determine fair value with respect to a principal market, then I don't have to look at most advantageous market. But if I cannot determine what is a principal market, then I'll have to determine fair value in the most advantageous market. What is a principal market, first of all? A principal market is where the largest volume of transactions of similar nature have occurred. Largest volume of similar nature transactions have occurred. I have a share on Infosys. That share of Infosys is traded both on BSE as well as NSE. Out of both, I find that NSE has recorded more volume than BSE. Then in such cases, NSE should be considered, or National Stock Exchange should be considered as my principal market and not the Bombay Stock Exchange. Clear? So principal market is a market in which the highest volume of similar transactions have occurred. Highest volume has occurred. That should be considered as principal market. What is most advantageous market? A most advantageous market is a market, by name itself it is suggesting, which maximizes the price which I get by selling the asset or minimizes the price which I have to pay to transfer a liability. Clear? So what is a principal market? A principal market is a market in which the highest volume of similar transactions have occurred. If I can determine fair value with respect to a principal market, then I will not consider most advantageous market. But if principal market cannot be identified, then in such cases, I will have to identify fair value with respect to most advantageous market. Clear? Let's see. If principal market exists, then determine fair value based on principal market. If principal market does not exist or you cannot identify the principal market, then determine the fair value with respect to most advantageous market. Now let's understand this principal market and most advantageous market with the help of an example. Look at this. A principal market is a market in which highest volume of similar transactions have occurred. Look at the example which I have given you. Let's say there is a dealer in securities and there is a retailer like you and me. If you look at on a current date, there are so many IPOs which are going on. If I have to subscribe to a particular IPO, my limitation of sum invested in an IPO is maximum 2 lakhs. That's it. But to a dealer, they can buy how much ever they want. Because retailer has a particular restriction. Retailer can only trade in retail markets. But dealer has two options. He can purchase from interdealer market, sell it in retail market to maximize his profit. Because in general sense, interdealer markets where high volumes are traded, the price is very little or price is slightly lower. But in retail markets, generally the price is much higher. Look at your Ratndeep. What is the profit that Ratndeep makes? Ratndeeps directly buy from the distributors where the high volumes are transacted. Like you and me, they don't buy one single coffee packet. They'll go there to buy hundreds of coffee packets at one single shot. The price at which he can buy each coffee packet is much lower from the distributor than the price which he offers me when I enter his store. Therefore, that difference is his profit margin. Same way, a dealer has an access to the interdealer market as well as a retail market. In the interdealer market, the volumes transacted are very high, but the value at which the transaction as normally occurs in an interdealer market are slightly lower. But look at retailer. A retailer in a retail market, the volumes are generally lower, but the value at which the transaction has occurred is slightly higher. In this particular given example, if I think from a dealer's perspective, I am trying to determine the fair value for a dealer, then which market will I choose? If I choose retail market, then the value will be higher. But I cannot choose retail market. I'll only have to choose interdealer market because the principal market is a market in which highest volume of similar transactions are traded. Highest transactions of similar transactions, highest volume of similar transactions have occurred. Therefore, for a dealer, interdealer market becomes a principal market and he will determine fair value of the securities held based on the price at which they are quoted in interdealer market. Even though he knows that at retail market he can sell it at a higher price, I will determine fair value only with reference to my principal market, which is the interdealer market. But think from the retailer's perspective, the same securities which the dealer held, same securities are even held by even the retailer. But retailer, since he does not have an access to the interdealer market, has only access to retail market, he will consider his retail market as the principal market. And he will value his securities at fair value based on the price quoted in the retail market, which is slightly higher. Therefore, the same units of share in Reliance Industries held by the dealer and the same units of shares held by a retailer in Reliance Industries will be valued at a different price. Sir, commodity same, sir. It is share in Reliance. Yes. But remember, who is holding it is very important. and what markets he has an access to. Since it is a share of Reliance does not mean that the fair value is common everywhere. It is not similar to every enterprise. That is why you need to understand that what is the concept of principal or a most advantageous market. Let's say there are multiple markets. Multiple markets are there. I have a commodity. What commodity? Let's say I have a pen. A pen which can be sold in Hyderabad, the same pen can be sold in Bangalore, the same pen can be sold in Delhi, the same pen can be sold in Mumbai, the same pen can be sold in Kolkata, the same pen can be sold in Chennai. In this case, if I try to determine what is the principal market, I may not be able to determine, because the demand for pen is almost similar in every place. I cannot really come up with a logic that the highest volumes are traded at so and so place. It is not possible. Therefore, I'll have to consider that the principal market cannot be determined. I cannot identify what is the principal market. Looks like everything is principal market and there are so many principal markets for me. In such situation where I cannot determine the principal market, I will have to determine what is the most advantageous market, and the fair value should be determined based on the most advantageous market. That means what? The market price, a market in which the value of the commodity is the highest, the value of the commodity is the highest, should be called as the most advantageous market. So what is principal market? It is a marketplace in which highest volume of similar transactions have occurred. Highest volumes of similar transactions have occurred. I've given you an example as well. But if I cannot determine a principal market, then I will determine fair value with respect to a most advantageous market. What is a most advantageous market? A marketplace which maximizes the money which I receive from sale of an asset or minimizes the money which is paid to transfer a liability is called as most advantageous market. It maximizes the return from sale of asset or minimizes the amount required to be paid for transfer of liability. Remember, whenever I determine the most advantageous market and the price in the most advantageous market, then I'll have to make sure to determine the most advantageous market, I will have to reduce both the transaction price and transportation cost. Let's say, for example, today I'm standing in Hyderabad. I could have sold the product in Hyderabad without incurring any transportation cost at 10 rupees. However, I had to pay the commission agent, let's say 50 paise. Therefore, the fair value in this particular market is 9.5. I could collect 9.5 from sale of asset in Hyderabad. But I say, why in Hyderabad? If I go to Bangalore and sell the same commodity, then I could realize 12 rupees there. However, 2 rupees I will incur only in transportation, and there is a commission of 1 rupee out there. Therefore, 12 minus 2 rupees transportation minus 1 rupee of commission, net amount I will receive after reducing your transportation and transaction cost is only 9. So though I could have sold it at 12 rupees in Bangalore, but only 10 rupees in Hyderabad, Hyderabad is the most advantageous market, because in determination of a marketplace of which is more advantageous, you need to reduce both the transportation cost as well as the transaction cost. Clear? But that is only for determination of most advantageous market. But when I determine fair value in that market, transaction cost should not be eliminated. You should only eliminate the transportation cost. Clear? So why did this concept come in? Because I told you market participants are buyers and sellers who are existing in the most advantageous market or the principal market. Which one first priority? First priority, I will determine fair value with respect to principal markets only. But if principal market cannot be determined or cannot be identified, then I will determine fair value with respect to most advantageous market. What is a principal market? A principal market is a market in which highest volumes of similar transactions have occurred. Then what is the most advantageous market? If I am not able to identify a principal market, I will determine fair value with respect to most advantageous market. Most advantageous market maximizes the return from sale of asset or minimizes the amount required to be paid for transfer of a liability. In determination of most advantageous market, I'll have to make sure that the price of the product has to be reduced by both transaction price and transportation cost. I'll have to adjust the market price in the most advantageous market by both transportation cost and transaction cost in determination of most advantageous market. But when I determine fair value, I should not reduce the transaction cost. I am only supposed to adjust for the transportation cost. If I sell it in Hyderabad, I could have sold it at 10 rupees. If I can sell it in Bangalore, then from here to Bangalore, this much transportation cost will be incurred and I can sell the product in Bangalore at a certain price. So the price at which you can sell in Bangalore minus the cost to transport the good should be considered as fair value. Transaction cost should not be eliminated in measurement of fair value. Clear? So until now, what we have discussed under the standard in days 113 is about what is the market in which I have to determine fair value and who are market participants and what is an orderly transaction. That means only the definition of fair value has been covered so far. But like I told you, the standard is divided into three parts: definition of fair value, framework for determination of fair value, and third one is your disclosures. So the first part is done where I try to define a fair value, where I told you that fair value is an exit price, the price at which you can sell an asset or transfer a liability between market participants on a measurement date. So this part is already over. Now let's look into the next concept of what is the fair value and how do I determine a fair value. In determination of fair value, the standard proposes three techniques. Now, someone will come up and ask me, which technique should I follow? Should I follow any of those techniques or should I follow only one particular technique? I'll tell you. Let's cover first of all, what are these three techniques in determination of fair value? First one, it's called as a cost approach. What do you mean by cost approach? Cost approach of determining fair value is the cost of purchasing the asset on today's date minus the obsolescence of the asset. For example, I have used a vehicle for 2 years. Applying a cost approach, I can determine the fair value. If I have to buy the asset today, then the asset would have costed me 10 lakhs. But since I already used it for 2 years, there is certain amount of obsolescence. So 2 years depreciation is reduced at the rate of 20%. Therefore, basically about 2 lakhs each year, 4 lakhs is reduced. And finally, the fair value of that particular vehicle is 6 lakhs. This is called as cost model. A cost model of determining fair value involves replacement cost of the asset reduced by the obsolescence of the value of the asset. That is called as fair value of an asset by applying a cost approach. Similarly, one more approach which I follow is called as income approach. Income approach is a very famous approach as far as your non-marketable securities are concerned. Let's say shares of a private limited company. Shares of Flipkart for 70% of controlling interest was acquired by Walmart at, I don't remember the valuation, a whooping valuation. When WhatsApp was acquired by Facebook, everyone was looking at WhatsApp and they said, what nonsense is this valuation? When everyone looked at Instagram being acquired by Facebook at a certain valuation, even we were surprised at how did they determine the value. Was Instagram a listed security? Did you know the fair value of Instagram per share from the market available? Absolutely no. WhatsApp, did it have anything like that? Nothing. The shares were not traded. I cannot identify the value of the share. Therefore, they apply something called as income approach. Income approach is very simple, as good as value in use under Ind AS 36. Ind AS 36, when we discuss about value in use under impairment, what do? I'll try to estimate what are the future cash flows generated from the asset, and such future cash flows should be discounted to the present value. This approach was called as value in use under Ind AS 36. Same logic I'll apply in determination of fair value under income approach. Income approach is a present value of future cash flows arising from the use of the asset or from settlement of the liability. This is basically called as income approach in determining the fair value. The last approach is called as market approach. Market approach is basically determining fair value with respect to or with reference to the quoted market price in active market. Their quoted market price in active market will be considered in determination of fair value. I have a share of Infosys. How do I determine fair value? Income approach? Not necessarily. Why? The share is already listed on BSE and NSE. You go to your Google, search for value of the share of Reliance, automatically he'll give you the value per share. That means the value of the share is determined with reference to the fair value already existing in active markets. Already existing in active market. This is called as market approach. Let's say I have a share of a technology based company. For me, the competitor is Infosys. Infosys is listed. I am unlisted. So what I said was, instead of income approach, let me take the fair value of Infosys only and adjust it for certain changes. Since Infosys is a market traded entity or it is freely traded in the active market, let's say there is a restriction for me. Since I am a private limited entity, I will discount the share price of Infosys by 20% and say that this is the market price of my company. If both Infosys and my company are of a similar size or similar nature, similar debt equity ratio, everything is similar, just the fact that they are listed and I am unlisted. So since I am unlisted, then there is a restriction on transfer of shares. Immobility is there of my share. Therefore, I applied a discount of 20% on market share of Infosys and I tried to determine what is the fair value of my share. In such case, I can also determine fair value as per your market approach. These are the three approaches by which you can determine the fair value of any asset or a liability. Cost approach, replacement cost minus obsolescence. Number 2, income approach, present value of future cash flows arising from use of the asset or settlement of a liability. Market approach, the quoted market price in active market for a similar good adjusted for some changes. Either way, I can determine fair value. Now, question comes up, what if? For a particular good, I can determine fair value under cost approach. I can also determine under income approach. I can also determine under market approach. Then which fair value should I consider? In such cases, the value or the technique which has to be relevant should be based on the fact that they have to they have to maximize the use of market observable inputs and minimize the use of unobservable inputs. What do you mean by this? Market observable inputs are those inputs which I can freely access from the market. What can you freely obtain from the market? Any market price of a share which is listed in BSE or NSE is an observable input. Your rate of discounting, which is the fair value of time value of money, RF factor, which is the rate of government bond, observable inputs. So these are market observable input. I can easily use the market to identify what is the input. These are called as observable inputs. The money that I will derive from the future use of asset, active market cannot determine. I will have to estimate. I'll have to estimate by using the asset. Next year I'll get so much. Year 2 I'll get so much. Year 3 I'll get so much. This is a market estimate. But understand, I did not pick up any input from the market. These are called as unobservable inputs. You cannot observe from active market. So whenever you are trying to apply a particular technique of determining fair value, we'll always have to apply the fair value we have to apply the technique which uses the maximum market observable inputs and minimum unobservable inputs. Clear? So which is more relevant depends on the asset. Depends on the asset where you can say which is more relevant in determination of fair value. I am not saying cost model is more relevant, income approach is more relevant, or market approach is more relevant. I'm saying I'm leaving it to you. You can choose either of these three approaches in determining fair value, but the approach which has to be selected, which has to be elected for determination of fair value should maximize the market observable inputs and minimize the unobservable inputs from the market. Clear? But remember, there are two circumstances or two such items for which I do not use either of these three approaches. There are two particular items for which I do not use cost approach, income approach, or market approach. My determination of fair value is as per some other techniques altogether. What are the two items? Non-financial assets and financial liabilities. Non-financial asset. What is a non-financial asset? Land, building, furniture, plant and machinery, vehicle. These are non-financial assets. Stock, non-financial asset. But remember, when I talk about financial assets, they are debtors, cash and bank, bills receivable. All these are financial assets. Investment in securities, financial asset. So, non-financial asset should not be determined based on cost approach, income approach, or market approach. The standard Ind AS 113 prescribes a different approach for determination of fair value of a non-financial asset. Similarly, the standard Ind AS 113 also determines fair value of a financial liability in a complete different approach where the value of cost approach, income approach, and market approach are not necessary to be applied. So what are these two exceptions, and how do I determine fair value for these two exceptions, that is regarding a financial liability and a non-financial asset. Let's look at financial liability first. Whenever I talk about a financial liability, determination of a financial fair value of, guys, definition of financial liabilities we will discuss when we are talking about Ind AS 109 under Ind AS 32, where the definitions will be categorically given. So forget about what is the definition, but remember, anything which can be settled in cash is a financial liability. Creditor, financial liability. Bills payable, financial liability. Your loans, financial liabilities. So all these are financial liabilities. So with respect to a financial liability, I will apply a different technique, and I will not apply income approach, cost approach, or market approach in determination of fair value. For a financial liability, first see if quoted market price are available for such financial liability. If quoted market price is available, then your fair value is equal to the quoted price. Fair value is equal to quoted price. But if in case I come across a situation where the quoted market price is not available, in such case, and I will assume that then in such case, I will assess whether the financial liability which I have is held as a financial asset by another enterprise. Guys, this you will understand under Ind AS 109. Or I'll give you a basic example. My creditor is my financial liability. Yes. If it is a creditor in my books, then I might be sitting as a debtor in someone else's books. So that is exactly what we are saying. Whether it is held as a financial asset by another enterprise. If it is held as a financial asset by another enterprise, then the fair value of the financial liability is equal to the fair value of the financial asset. Clear? If there is no active market, not held as a financial asset by another enterprise, then in such cases, I will determine fair value based on the maximizing the use of observable inputs from the market and minimizing the use of unobservable inputs from the market. Clear? So I'm saying 3-step hierarchy. First categorization or first priority to active market. If there is an active market which exists, then determine fair value based on quoted market price in the active market. If active market is not available, then I will see whether the financial liability which I have is held as a financial asset by another enterprise. If it is held as a financial asset by another enterprise, then the fair value of the financial liability is equal to the fair value of the financial asset. But if in case I cannot determine even in this manner, then I will determine fair value by maximizing the use of observable inputs and minimizing the use of unobservable inputs. Here, this is the first exception to the techniques of valuation, where we have a complete different techniques in determination of fair value of financial liability. The second exception is regarding a non-financial asset. Non-financial asset determination of fair value should be highest and best use. The fair value of a non-financial asset like a land or a building or a plant and machinery or a vehicle or furniture should be determined based on highest and best use. What is highest and best use? If a particular land can be put up for multiple purposes, each purpose I'll have to assess what is the cost and the benefit. If the cost benefit is highest in one such application, then that value should be considered as my fair value. I have a piece of land, I can use it for parking, I can lease out that land, I can I can manufacture, I can construct a building on that and lease it out. So many ways I can use the land. Under each such use, determine what is the highest cost minus benefit. The purpose for which the cost benefit is the highest should be considered as a fair value. Remember, in determination of highest and best use, I will not consider the restrictions of the entity. The entity cannot lease out the premises. It is the entity's objective. Objectives of the entity has clearly restricted them to lease out a particular premises. I will not consider this restriction. The asset itself cannot be leased. The local authority has already given me a GO saying that this land or this particular surrounding areas, this survey number land cannot be leased. Then that is a restriction of the asset. The restriction of the asset should be considered in determination of fair value, but the restriction of the entity should not be considered in determination of highest and best use. Fair value is not entity specific. It is specific to the asset. That's why restrictions of the entity to use the asset in a particular manner should not be considered in determination of highest and best use. However, if the asset itself has a restriction that it cannot be used in a particular manner, then I should not consider that particular use as highest and best use. Therefore, I am coming out with a statement saying that fair value is asset specific and it is not entity specific. In determining highest and best use of multiple purposes for which an asset can be used, I'll have to assess three conditions. First one, is it physically possible for the asset to be used in that particular manner? Number two, is it legally permissible to be used in a particular manner? Third one, is it financially feasible for me to use the asset in that particular manner? Three things I'm talking about. I'm saying, is it physically possible to use the asset in that particular manner? Is it legally permissible to use the asset in such manner? Third one, is it financially feasible to use the asset in a particular manner? Considering these three, I will determine multiple uses of the asset. Out of the multiple uses of the asset, the use which gives me the highest and the best use should be considered as a fair value. Let's say the asset cannot determine highest and best use. I cannot determine so many purposes for which the asset can be used. It is not possible. In such case, current use is highest and best use. In such case, current use of the asset should be considered as highest and best use. So what am I saying? You cannot apply cost approach, income approach, or market approach, which is your techniques in determination of fair value, to a non-financial asset. In the case of non-financial asset, the fair value should be determined based on highest and best use. So if the asset can be used for multiple purposes, I'll have to assess each of such purposes and determine under which use is the asset deriving its best value or the highest value, and such value should be considered as fair value. In assessing these multiple purposes for which the asset can be used, I should consider the restrictions on using the asset in a particular manner. But the restrictions of the enterprise to use an asset in a particular manner should not be considered. Therefore, I am coming up to say that restrictions of the entity should not be considered, but the restrictions of the asset to be used in a particular manner should be considered in determining its highest and best use. So I've derived a sentence saying that fair value is specific to an asset and it is not specific to an enterprise. It is asset specific, not entity specific. While determining multiple purposes for which the asset can be used, I'll have to assess three things. Is that use physically possible? Is it legally permissible? Is it physically possible, legally permissible, or financially feasible? If I cannot determine multiple uses of the asset, then in such case, the current use can be considered as highest and best use. Clear? These are the two restrictions or two exceptions to techniques of determining fair value. What were the techniques in determining fair value? Cost approach, income approach, market approach. Which approach should I apply? I will apply an approach which maximizes the market observable inputs and minimizes the use of market unobservable inputs. However, there is an exception with respect to financial liabilities and non-financial assets. With respect to financial liability, I will see first of all, my first priority is whether there is an active market which exists. If there is an active market for the financial liability, then the quoted market price will be considered as my fair value. If active market does not exist, then see if the financial liability of my enterprise is held as a financial asset by another enterprise. If it is held as a financial asset by another enterprise, then determine fair value of the asset, and such fair value of the financial asset should be considered as fair value of financial liability. If you cannot determine market price of the financial liability with respect to active market, Neither you can determine fair value with respect to financial asset of another enterprise. In such case, I will determine fair value by maximizing the market use of observable inputs and minimizing the use of unobservable inputs. The second exception was regarding non-financial asset, where under non-financial asset I'm saying you cannot have you cannot apply income approach or cost approach or your market approach, but instead I will determine fair value based on highest and best use of this. In determining highest and best use, the entity based restrictions for use of the asset should not be considered. But if the asset itself is restricted to be used in a particular manner, such restriction should be considered in assessing the highest and best use. That's why we say the fair valuation for a non-financial asset is asset specific and not entity specific. In determining multiple uses of the asset, each enterprise has to assess three things: whether the use is physically possible, whether it is legally permissible, and whether it is financially feasible. If you cannot determine multiple uses of a non-financial asset, then in such case, the current use of the asset, currently the asset is used for a particular purpose, should be considered as highest and best use. Clear? Yes, guys, now that we have determined what is a fair value and we have understood the techniques in determination of fair value and two exceptions in determination of fair value, for which I cannot apply income approach, cost approach, or market approach, we have covered this concept. So far we came across definition of fair value. It is an exit price, the price at which you can sell the asset or transfer a liability between market participants in an orderly transaction on a measurement date. That was the definition. And we have seen techniques of measurement of fair value, income approach, cost approach, and market approach, and two exceptions to it with respect to financial liabilities and non-financial assets. Now, I'll come to the most important part, and I will tell you why I call this as a most important part is the disclosure. Why is disclosure so important? Like I told you, fair value by itself, by nature, is subjective. If you observe, when I determine fair value as per income approach, it is a present value of discounted cash flows arising from the use of the asset or transfer of a liability. Very good. How do I determine those cash flows? Did he come up and say? Did Ind AS 113 here explain us how do I determine those cash flows? At least Ind AS 36, when I determine value in use very clearly he defined their cash flows from continuing use of the asset minus cash outflows which are necessary to generate those cash inflows plus terminal cash flows from sale of asset at the end of its useful life. Should not consider financial cash flows, should not consider tax, and should not consider any future planned restructuring cost, any increase in cash flows due to future restructuring cost. All these very clearly, categorically he has given. Even regarding the discount rate, there was specific discussion which we had under Ind AS 36. So value in use, where I had such a significant discussion, such an elaborate discussion on, here nowhere when I came up with your income approach, I never told you how to determine those cash flows. So that means there is a lot of subjective factor. You might determine fair value using those three approaches in a different manner. I might determine the fair value of the similar good in a different manner. That is why I'll say even if Ind AS 113 has come in, it is only determining framework for determination of fair value. It is not ascertaining the fair value. It is only saying you have to determine fair value in this way. That's it, over. How do I determine the fair value in that particular manner is defined. But exactly this is the way that you have to determine the fair value is not given. So therefore, since it is subjective, I think the user should know. I think it is very valid for the user to know what is the fair value. Correct? You're communicating it the fair value. Let's say I have a share in Infosys held as investment in my enterprise. I took the quoted market price from NSE or BSE and I represented the fair value in my financial statements. Similarly, a piece of land was acquired or was actually given to me as a government grant. I took the most recent transaction price in that particular area, based on which I determined what is the fair value of the land. But there was a restriction given by the government that you cannot sell the land. So since I cannot sell the land, then I have done some adjustments to it, saying that the fair value should be reduced by 30% because I cannot transfer the land. Now, so many adjustments you have done and determined what is the fair value of that particular land. I also had investments in our unlisted enterprise where I adopted an income approach to determine what is the fair value. Or I have applied a market approach to look at a similar company which has a quoted market price. I made certain adjustments and I determined the fair value of the unlisted enterprise. Now, if I communicate to the user the shares in Infosys, the shares in an unlisted enterprise, the value of land, all these three are fair values presented in the financial statements. Is it sufficient? Don't you think the user should know to what extent he can rely on those fair values? He knows that fair value is subjective, but he can say, I can always say that the fair value of investment in Infosys is the most reliable. The fair value of the land is less reliable. And the fair value of the unlisted securities, where I have used maximum unobservable inputs, is the least reliable fair value. Don't you think this has to be communicated? If I don't communicate this, then the user might have a different intention of fair value and you could have a different contention of fair value. That is the reason why the Ind AS disclosures on Ind AS 113 is very important, where he will try to communicate to the user which fair value is more reliable, which fair value is less reliable, and which fair value is least reliable among those fair values which are presented in financial statements. This is given by a fair value hierarchy. What is a fair value hierarchy? Fair value hierarchy is basically determined or basically defined to explain to the user what is the degree of reliance, what is the degree of certainty that he can apply to each fair value which is determined in the financial statements. So I have applied fair value in my financial statements in multiple places, which is more reliable, which is less reliable, which is least reliable, is given in the form of fair value hierarchy. That is the reason why we come up with level 1, level 2 and level 3 hierarchy. Remember, most reliable fair values are level 1, lesser reliable fair values are level 2, and the least reliable fair values are level 3. They are all fair values. They are all fair values. My intention is to communicate to the user, brother, this fair value is very reliable. You can definitely say this is 100% the correct value. Level 2, reasonably certain that this is the fair value. I'm not saying that this is exact, but I'm saying reasonably certain that this is the fair value. Level 3, don't ask me, I cannot tell you. This is my definition of fair value. Your determination of fair value might be significantly different. Clear? So this is the 3 levels of hierarchy that we apply. So when I communicate as a part of notes to accounts, I will pick up first all the fair values which are applied in your presentation of financial statements. All those fair values I'll bring up and I'll say, this is level 1, this is level 2, this is level 3. This one highly reliable, this one less reliability, this one least reliable fair value. I'm communicating it to the user. So this communication to the user is basically determined by level 1, level 2 and level 3 hierarchy. So what is level 1 hierarchy? Directly observable market price. Directly observable market inputs. Active market exists. I am directly determining the fair value based on market observable factors. Like I have given you the example of market price of Infosys. Market price of Infosys is directly observable input, therefore highest reliability, therefore classified as level 1. Level 2, lesser reliable. That means I am taking market observable input, but I am performing certain adjustments. The land which is right beside me was sold for 30,000 rupees per square yard. This is 500 square yards. So it should be valued at 1.5 crore. But this is received as a government grant for me. Government put a restriction saying that I cannot transfer the land to anyone else for the next 5 years. After 5 years, I can sell the land. Therefore, since there is a restriction, I am taking the 30,000 rupees as a valuation basis, but I am reducing it by immobility or non-marketability discount of 20%. So therefore, a little insignificant changes have been applied, and that insignificant change is unobservable input. So direct observable market inputs adjusted by insignificant unobservable inputs should be categorized as level 2 category. Sometimes a market price of an unlisted enterprise can be determined with respect to the quoted market price. The quoted market price of a particular share of a company is at a certain value. Since my company in which I hold investments is almost similar to the same company, but it is not marketable. So what I do, I'll take the quoted market price and I'll adjust it by immobility discount or a restriction on transfer of share, which is a small variation in the quoted market price, which is insignificant. Since it is insignificant unobservable input, I will categorize it as level 2. What is level 3? Significant use of unobservable inputs. Don't even ask me. There is no quoted market price available. No similar company is already having a quoted market. I am into a specialized segment where quoted market price are not existing. Therefore, I significantly use a lot of unobservable inputs. Even if I've started with quoted market price, I applied certain adjustments which are not significant, which are not insignificant, they're very significant. Very significant adjustments have been done to direct observable market inputs. And in such cases, since the significant changes have occurred, I have to categorize them as level 3. So what am I saying? The most reliable fair value is level 1, lesser reliable fair value is level 2, and the least reliable fair value is level 3. Highest use of market observable input, direct use of market observable input is level 1. Taking the market observable input, I did some insignificant changes. I did adjustment, but the adjustment is very insignificant where I use market unobservable input, then it is level 2. Quoted market price not available. Or even if quoted market price was available, the adjustments in determination of fair value was very significant where I applied unobservable inputs. In such cases, you will categorize them as level 3. The same thing he's giving it to you in the form of certain sheet. Just check. Quoted market price is available. Yes, then are adjustments necessary? If there is no adjustment necessary, then the fair value is a level 1 hierarchy. If adjustment is necessary, but however, the use of significant I have not used significant unobservable inputs, then it is level 2. But if I have significantly used unobservable inputs, then it is level 3. Quoted market price is not available, but I have significantly used unobservable input is level 3. Quoted market price is not available, but my use of unobservable inputs is very insignificant, very little. Then in such cases, it is level 2. This way, I can identify the fair value hierarchy of any item which is determined as fair value. Whenever I have a fair value determined, I'll have to classify them under either level 1 or level 2 or level 3. In such a way, I'm communicating it to the user which is more reliable, less reliable, and least reliable fair value. It is presented like this. Property, plant, and equipment fair value could be level 3 generally. Investments are level 1. Receivables are level 1. Leases could be level 2. This is my disclosure requirement and how I determine fair value. So 3 things that we have covered so far as far as Ind AS 113 is concerned. What are the 3 things that we have covered so far? We have done with the discussion on, we started with the discussion with what is a fair value? When should I apply this standard? Like I told you, this standard will not tell you when to apply the fair value, but will only tell you how to apply or how to determine fair value. So the standard was divided into 3 parts, and I told you definition of fair value, your framework for determination of fair value, and disclosures. So we have covered all the 3 parts, but there is one small miscellaneous topic which I have to cover, and upon which I can say that this standard is concluded. Clear? Yes, guys, the old school theory has always been resisting this fair value. The old school theories have been very resistant to fair value. Because earlier, if you remember ICAI, we used to adopt something called as cost approach. Cost approach is more reliable. I agree, because cost approach will always identify an item at its cost. I spent 100 rupees to acquire this asset, measure it at 100. That is basically determination by cost approach. But there's also a determination under fair value, which is emphasized by Ind AS, where it says, even though I've acquired it at 100, that is a forced sale. That's a forced sale. So that's why he gave it to me at 100. Actually, if I would have bought it under free market situation, it would have been 120. Therefore, in such situation, you can say that transaction price and fair value are significantly different. There's such a restriction from the old school thought that fair value itself by concept is one of the most subjective things, and why should I incorporate into our books of accounts? Why should fair value be given such greater emphasis? I'll tell you. There is an enterprise which I have done Ind AS on, or I worked with them for transition to Ind AS. They had machinery which was imported 35 years ago. 35 years ago. Initially, under Companies Act, they started charging depreciation. By the time I entered the organization and started performing Ind AS transition, I observed that by the time of 2018, when I was doing Ind AS transition, these assets were significantly depreciated. At 35 years ago, first of all, value of a rupee was high. So their acquisition cost in relative terms to today's date was significantly less. And that too depreciated over 35 years. Imagine what is the value of the machinery. But when we called upon a technical expert to do the valuation of the asset, he said, sir, the value of the asset, if I determine on today's date, I can say that this asset has another at least 50 years to run. And even on today's date, the asset which I see is the most technologically advanced asset. There is no new advancement which come in after this asset was acquired. So I would say that the fair value of this asset is significantly high. But when I present it to my users, to my shareholders, to my board of directors, I am showing the value of the asset at a minimal cost. 35 years depreciated already. And the cost was also 35 years back. Today, if I want to acquire the same asset, I had to pay at least 100 times of the price which I paid 35 years back. Cost of material has increased so much. So what the my logic is here, that fair value, though is subjective in nature, it gives you a true understanding of what is today's effects. Yes, I have to apply fair value on a very conservative basis. I agree. I cannot go aggressive in fair valuation, but determination of fair value or presenting fair valuation of items in financial statements is only going to give you a better understanding of financial statements or better representation of fair value of your financial statement. Infosys, your Flipkart, when it was taken over by Walmart, had 7 successive years of losses. 7 years of continuous losses. Value, if you look at which they have acquired, that was a whooping valuation. My question is the balance sheet of Flipkart truly representing what is the value at which Walmart has acquired them? Absolutely no. Because there is a significant restriction of money measurement concept which has been put into your accounting process. Some things which you cannot measure in money terms, you cannot basically present in financial statements. I'll tell you, Flipkart's main asset was its user. Number of people who already had Flipkart installed on their mobile phone are the active users. Now, these people who are active users who have been accessing the Flipkart continuously, every time we want to buy an item, we'll first check on Amazon, then check on Flipkart, compare the price and select where you have to buy, right? That is exactly how we have been doing it, or we have been using Flipkart like that. But still we are called as active users. Now, can Flipkart recognize active users as an asset in its financial statements? Because that is the main asset. Because Walmart has applied a valuation to Flipkart based on the active users that it has. Unfortunately, this cannot be created as a basis. Unless, unfortunately, these cannot be incorporated in financial statements because we have the concept of money measurement, we have the concept of internally generated intangible asset, which should not be recognized as an asset unless they can be measured in money terms. So many restrictions are making my financial statements redundant. It should not become a simple piece of paper which is not truly representing the value of the company. Therefore, the emphasis on fair value is, though delayed, is very important on today's day. So slowly we are moving into making the financial statements more relevant on today's date. Now, the last topic that I have to cover as a part of your Ind AS 113 is regarding the concept of transaction price and fair value. Transaction price is not equal to fair value. Why is that so? Because transaction price is a price at which you enter into a transaction. While if you remember the definition of fair value, we said it is an exit price, a price at which you can sell the asset, a price at which you can transfer a liability. So therefore, an entry price may not be equal to the exit price. I gave you the example of foreign exchange. You go to a Western Union money transfer where forex is being sold or bought, or you go to any other bank to buy foreign exchange, he will give you bid price so and so, ask price so and so. So basically, when you want to buy, you pay a higher price. When you want to sell, you pay a lower price. So therefore, the transaction price, a price at which you purchase those foreign currency, is not equal to the price at which I can sell those foreign currency. That's why your entry price may not be equal to your fair value, may not be equal to your fair value or exit price. Whenever I have a transaction to be recognized at fair value, a transaction is in such a way that it should be recognized at its fair value. But I paid a different price while entering into the transaction. Such a difference which comes up should be transferred to P&L unless an alternative treatment is proposed under any other standard. Now, what is this alternative treatment? I'll come to Ind AS 109 where I'll give you an alternative treatment for a similar transaction where your transaction price is not equal to fair value. Here, so I'll tell you where it happens. But can you tell me what are the situations where the transaction price is not equal to fair value? Can you quote a few situations? Number one, let's say the transaction did not occur in a principal market. The transaction occurred in other than principal market, but fair value is determined with respect to principal market. The transaction did not occur with a willfulness to transact. There was a stress or a force to transact. Therefore, the price at which I entered into the transaction may not be equal to the fair value. The volume in which I purchased is not the same volume in which I intend to sell. I purchased in bulk, but my sale is in piece by piece basis. Therefore, it is again change. A transaction between related parties. The transaction between related parties, the transaction price is influenced by the relation. But your fair value should not be based on that because fair value is between market participants who are independent, unrelated. Therefore, in such circumstances, I can come across situations where your transaction price is not equal to fair value. Whenever you have a difference, such difference will be transferred to P&L, either to the debit of P&L or credit of P&L, unless another Ind AS is proposing an alternative treatment. Clear? One more last concept which I'll talk about is asset specific valuation exemption. If I have a financial asset and a financial liability, then I will determine the fair value of financial asset separately and liability separately. You will never determine it on a net basis according to the standard. But now I'm creating an exception. I am saying if the entity wants to settle the transaction on net basis, the entity intends to settle the transaction on net basis and it is legally enforceable. Ind AS 1, offsetting of assets and liabilities, we have discussed there. If they are in an offsetting position, then in such cases, I will determine fair value on net basis. That means I will determine fair value based on financial asset minus financial liability on a net basis. This is entity related valuation or entity specific valuation because it is entity's intention to settle the transaction on net basis. But I will still consider it only if the fair value of the net exposure will be considered only if the risk mitigation strategy is documented. Both financial asset and financial liability should have been measured at fair value. If both should have been measured at fair value, then in such cases, even if the entity is intending to settle these financial assets and liabilities on net basis, it is sufficient if you determine the fair value of the net effect. Instead of trying to determine what is the fair value of financial assets separately, liability separately, not necessary. Only the net exposure, if you determine the fair value, that is absolutely sufficient. And that will bring us to the end of discussion on this standard, that is Ind AS 113. Yes, guys. So when we look at this standard of Ind AS 41, which deals with agriculture, it primarily deals with three things. One, biological assets. Number two, agricultural produce at the point of harvest. Number three, government grants related to agriculture. Guys, these three are very common. Okay. These are not, maybe you're hearing those terms for the very first time, but they're not something that are uncommon to us on a daily basis. First one is biological asset. Second one is agricultural produce at the point of harvest. Third one is government grants related to agriculture. Guys, government grants we have already dealt with under Ind AS 20. So Ind AS 20 will continue to apply. But however, related to agriculture, there are certain provisions that we need to explain related to a government grant. Now, if I look at the first one, where we talk about a biological asset, what is a biological asset and what do you understand by this term biological asset? Guys, I'll put it like this. Biological asset is a plant or a living animal. It is a plant or an animal. Now, however, under Ind AS 16, we cover a concept called as bearer plant. What is the difference between bearer plant, which we discuss as a part of Ind AS 16, and what is the difference between a biological asset, which we discuss as per Ind AS 41? Let me tell you. Let's say for example, I'm just giving you an example here. Let's say I have a plantation of mangoes. Okay, everyone loves mangoes. So I have a plantation of mangoes in my farm. And these plantation of mangoes during the season, sometime between February to June, we'll get some mango produce. This produce which we get, we will pluck it out of it and make sure that we are selling it. Next season, again, the same plant, without even uprooting, without even removing the plant, no improvement which happened. But this plant continues to give the produce during the season. Like this, it continuously gives me a produce for about 15 to 20 years or even 30 years as well. So these plants are called as bearer plants. A bearer plant gives you an agricultural produce over the period of time. That means it has a utility or a useful life of more than 12 months. That is why they get covered under Ind AS 60. Because it is within the control of enterprise, future of economic benefits arise, can be measured reliably, and lastly, they are expected to be used for more than 12 months. Then what are biological assets? What are biological assets and how are they different from your bearer plants? Your biological assets are, let's say I gave you the example of banana plantation. A banana plant normally gives you only one single fruit, one single lot of bananas. That's it. So one such lot of bananas are produced out of a banana plant. That banana plant is of no longer any use. You chop off the plant right from their roots because their roots are useful, their stem is useful, their leaf is useful. Because even if you leave it for any longer period, it is not gonna reproduce another fruit out there. So these are called as biological assets because they are not expected to be used for more than 12 months. potatoes, your cash crops like your rice, wheat, maize. These are basically your commercial crops where you have to make sure that to get the agricultural produce, I have to chop off the plant or I have to harvest the entire plant itself. They are called as biological assets. They are not covered under Ind AS 16 as bearer plants. If I talk about a bearer plant, then I have to cover it under Ind AS 16, where I either recognize it under cost approach or revaluation approach. But biological assets, there is no particular recognition under Ind AS 16. So we needed a separate standard for that. Therefore, it gets covered under Ind AS 41 agriculture. Now guys, Ind AS is particularly talking about applicability to companies, right? Why agriculture? Agriculture in India today is such an unorganized segment. You have individual farmers who are basically involved in agriculture. Is it necessary for Ind AS 41 to talk about agriculture? Is agriculture on today's date performed in corporate form? Answer is yes. There are a lot of companies on today's date, and more companies are coming up on today's date which are involving themselves in agriculture. We have a client who is basically into a seed manufacturing company. So they basically give seeds to farmers. These farmers will produce plantations. These will give rise to more seeds. So one bag of seeds which I give to farmer, the farmer gives me back 100 bags of seeds. So these are seed manufacturing companies, purely performing the function of agriculture. Very recently, I've been looking at your Facebook, and I see a post saying that 2 IIM graduates or 2 IIT graduates, I don't remember, but they have been making a revenue of almost 1 crore per day only from agricultural produce somewhere near Pune. So you need to understand that today agriculture is taking a corporate form. It has been taking a corporate form even in the past. There were companies like Sanghi Plantations. Many other plantations companies have come in where the plantations were basically done in corporate form. So therefore, biological assets or agricultural produce from these biological assets or bearer plants have to be dealt under a particular recognition criteria. Now, why a separate standard? Why can't it be merged with some other standard? I'll tell you. Because the point is, these assets, biological assets or agricultural produce, there is no particular cost which I can associate to it. A mango plantation, mango tree was laid. So there were some saplings which are bought. They have been erected. They have been let alone like that. There's a biological transformation which happened where the tree has grown up big and started giving me produce. And this agricultural produce, once at the time of harvest when I got this mango, what is the cost of this mango? Did you spend anything for that? Absolutely no. The cost is zero or very minimal. So therefore, this requires a specific measurement principle. Let's say we are into rearing of cattle. So there were cows which I already own. I'm into a dairy farm. 2 cows have actually mated and they give rise to a new calf. What is the cost of the new calf? Can you tell me? So I was into, let's say, poultry, and there was an egg which hatched and gave rise to a new chicken. So my concept is, what is the cost of the new chick? Is there any particular cost that you incurred? Absolutely no. It's a biological transformation which happened. Therefore, what is the cost of the new chick or the new calf? I cannot determine, because there is no particular cost which is associated to these assets. When there is no cost associated to these assets, then recognition and measurement of these assets become very, very, very important. That is particularly the reason why we come across this concept of Ind AS 41 agriculture, which requires a different recognition and measurement cycles. Clear? So now you understood the concept of agriculture. Remember, like I told you, Ind AS 41 deals with only 3 aspects: biological assets, agricultural produce at the point of harvest. Why am I specifying at the point of harvest, at the point of harvest, at the point of harvest? I'll come to that logic. Give me a second. And then lastly, garment grants. It particularly excludes land on which the agricultural produce is being grown. Number 2, bearer plants which are already covered under Ind AS 16. Land is also covered under Ind AS 16 itself. Any biological any transformation in the product other than biological transformation. Okay, so these are particularly excluded from the concept of the standard Ind AS 41. Same way, government grants related to the bearer plants are also excluded. Only government grants related to biological assets or government grants related to agricultural produce are covered under the standard, but any government grant given for a bearer plant cannot be covered under the standard Ind AS 41. So let's see what the standard talks about. It talks about biological assets, agricultural produce, and grants related to agriculture. Specifically exclude bearer plants, grants related to bearer plants, land used for agriculture, and any intangible asset. Now, as we progress, the first thing that I have to talk about is what is the definition. How do I define what is a biological asset? How do I define what is an agricultural produce? A biological asset is nothing but a living plant or animal which is not a bearer plant. Bearer plants covered under Ind AS 16, so specifically excluded. So any other living plant or animal which cannot be categorized as bearer plants should get covered under this concept of biological asset. What is agricultural produce? When you harvest these biological assets or harvest the bearer plants, the produce which I get is called as agricultural produce. Agricultural produce results from the harvest of biological assets and bearer plants. What is agricultural activity? An activity which relates to agriculture getting covered under the standard is either the harvest or a biological transformation which happens. Question comes up, what is this biological transformation, biological transformation, biological transformation? So many times you're using this logic. What do you mean by biological transformation? What is not a biological transformation? Let's say I have a rubber plantation. Okay. From the rubber plantation, I extract some liquid called as latex. Latex is an agricultural produce. Using this latex, I create some or I produce some rubber products. Producing rubber products from the latex cannot be considered as a biological transformation. It cannot be considered as biological transformation. Reproduction, I give you a bag of seeds, you give me back 100 seeds. Biological transformation. Because you sow the seeds, automatically because of the land, it has given me multiple more seeds. That is biological transformation. I rear cattle, automatically the cattle has reproduced and I got a new calf. I got a new chick. So in this way, we can say that having a new animal or a new plant produced also can be called as biological transformation. Tea, any tea garden will you normally harvest in the form of tea leaf. The tea leaf which you harvest is called as agricultural produce. But using this tea leaf, I dry the tea leaf, process it, and will get tea from it, a tea powder from it, or a tea bag from it. That cannot be considered as biological transformation because it is a manufacturing process. Here, so manufacturing process is excluded from the standard. Only biological transformation is covered under the standard. Then what is a biological transformation? Biological transformation is production, where I get agricultural produce. Growth, increase in quantity or increase in quality of the product is also a biological transformation. Degeneration, decrease in quality, decrease in quantity is also called as biological transformation. Procreation, where a new plant or animal is generated or created biologically, is called as procreation. Either of these processes are called as biological transformation, which can be included in the definition of agricultural activity to be covered under Ind AS 41. So what are the four things? Production, growth, degeneration, procreation. Production means deriving agricultural produce from harvest is called as agricultural activity or a biological transformation of production. Growth, where I increase the quantity or increase the quality of the agricultural produce. Whenever I'm talking about degeneration, I'm decreasing the quantity or decreasing the quality of the agricultural produce. Procreation, where a new plant or an animal is generated biologically or created biologically. You call it as procreation. These activities can be called as agricultural activities. They should be covered under the scope of Ind AS 41. Clear? Now, let's get into this concept. Understanding what is an agricultural activity and what is not an agricultural activity which is not covered under Ind AS 40. If I have a biological asset or a bearer plant in the form of a rubber tree, which is a bearer plant, the produce or the biological activity is production of latex. But from the latex, if I produce rubber products, then it cannot be considered as biological transformation. It is a process of production which should not be covered under Ind AS 41. So once I got the agricultural produce, your application of Ind AS 41 stops. From latex, if I produce a rubber product, then it goes into Ind AS 2 valuation of inventory. Clear? I rear a cattle, sheep, biological asset. I extract wool from the skin. That is basically a biological transformation or an agricultural activity. Using this wool, I generate some woolen clothing. At the point of extracting wool, your agricultural activity is done, completed. So you no longer can further apply this standard. So agricultural produce at the point of harvest will stop and Ind AS 41 will cease to apply. Once I extracted the wool, this wool being applied for woolen clothing is a pure process of manufacture which will be covered under Ind AS 2. Dairy cattle, I have milk or the dairy cattle normally produce some milk. So this process of milking is an agricultural activity which results in milk being produced, which is an agricultural produce at the point of harvest. Using this milk, I packeted the milk or I created cheese or paneer or butter or multiple other dairy products. That is a process of manufacture covered under Ind AS 2. Clear? So this way you need to understand what is the point at which the standard ceases to apply. The standard ceases to apply for agricultural produce at the point of harvest. Further processing of this agricultural produce is not covered under the standard because at the beginning I told you that this standard Ind AS 41 applies to biological assets, agricultural produce at the point of harvest. Only at the point of harvest. After harvest, any further production happens, it shall not be covered under Ind AS 41 but should be covered under respective standard. In most circumstances, it is Ind AS 2, that is inventory. Clear? Now, what is the recognition criteria? When should I recognize an agricultural produce or when should I recognize a biological asset? When the entity controls the asset as a result of its past event. Control, similar definition of control under recognition criteria we have seen under Ind AS 16, 38 and 40 regarding PPE, intangible assets and investment property. There, okay, control. Here, biological assets can be controlled. How do you control? If I have a massive mango plantation, how do you exercise control? I put a gate outside. I number the tree. If I have a cattle, I number the cattle. I make sure that they are not exiting my gate without without authorization. In such cases, legal ownership and branding will normally give you a control. Future economic benefits are probable to arise either from sale or from further production of the biological asset or a bearer plant. You normally get some future economic benefits. A biological asset or a bearer plant, you normally harvest to derive agricultural produce. This agricultural produce is definitely giving me some economic benefit. Clear? And then you can say that the recognition criteria is satisfied. And lastly, the fair value or the cost of this biological asset and agricultural produce can be reliably measured. If you remember in days 16 and 38, we were talking about only cost can be reliably measured. Here we are saying even if the fair value can be reliably measured, you can recognize the asset. That means higher emphasis is laid on the word fair value when we discuss about Ind AS 41. So what are the three recognition criteria? Control arising from past event. Generally, control emerges from legal ownership or branding. Number two, future economic benefits are probable to arise either by harvesting the agricultural produce or by sale of the biological asset itself. Clear? Number three, either the cost or the fair value of these biological assets or agricultural produce can be measured reliably. If these three conditions are met, then I can recognize a biological asset or an agricultural produce under Ind AS 41. Let's look at the concept of measurement then. If I have a biological asset, which is a living plant or an animal, in the case of cattle, it is an animal. In the case of agricultural activity of growing plantations, then it is a biological asset. In such biological assets, always biological assets should be valued at fair value less cost to sell. Fair value less cost to sell. This is again the same value. If you remember, we have applied in Ind AS 36 regarding impairment, and we called it with a word called as net selling price under Ind AS 36. We have also applied this valuation under NRV of inventory, where fair value or estimated selling price minus cost to sell. Same way we applied this formula under Ind AS 105 non-current assets held for sale, where we applied the logic that a non-current asset held for sale should be valued at lower of carrying value or fair value less cost to sell. Same formula I am applying it here for a biological asset. The value of biological asset should be either fair value minus cost to sell. Agricultural produce at the point of harvest also should be valued in the same manner. Fair value less cost to sell. Agricultural produce, there is no other alternative but to measure them at fair value. Why? Because cost cannot be measured reliably. I told you, mango, what is the cost? I can't measure reliably. Because I only grew the plantation, mango came free of cost. That is the reason why where cost cannot be measured reliably, agricultural produce should always be measured at fair value less cost to sell. But when I talk about biological assets, though your valuation principle primarily is fair value less cost to sell, there is an exception rule which is inserted. The exception rule says, if I am not able to measure the fair value of the biological asset reliably, if reliable measurement of fair valuation is not possible, then I can apply cost approach. The same cost approach that we have adopted even as per Ind AS 16, 38 or 40, where we apply cost minus accumulated depreciation. Clear? So measurement of biological asset should be at fair value less cost to sell unless the fair value cannot be measured reliably. If the determination of fair value cannot be ascertained reliably, in such case I'll apply a cost model where it will be valued at cost minus accumulated depreciation. Any agricultural produce derived from the biological asset or from the bearer plant should be valued at the point of harvest only. And at the point of harvest, it should be measured at fair value less cost to sell. If this agricultural produce is further applied for manufacturing some products, then whatever your application is has to be dealt as per Ind AS 2. According to Ind AS 2, the material which is valued at fair value less cost to sell on the date of produce or at the point of harvest should be included as cost of material in production process. Clear? A fair value of a biological asset cannot be measured reliably if the quoted market price is not available or alternate fair value method is unreliable. There is no quoted market. An alternate approach of fair valuation is giving me unreliable information. In such cases, I cannot apply fair value. In such cases, what did we say? Fair value cannot be measured reliably. Apply cost approach. Let's say initially the fair value could not be measured reliably. So I measured the biological asset on cost model. Subsequently, in the next financial year, fair value became available to me. In such cases, I will shift from cost approach to fair valuation approach. Here I'm saying initially the fair value on a balance sheet date could not be measured reliably. So I adopted cost model for measuring a biological asset. But subsequently in the next financial year, the fair value became available. Therefore, I can shift from cost model to fair value model. Vice versa possible. Initially, the fair value was available. I measured it on fair value basis or fair value minus cost to sell. Subsequently, the fair value could not be determined. Can I go back to cost model? Answer is no. Cost approach can go into fair value, but fair value cannot go into cost approach subsequently. Clear? Sometimes, I'm only saying sometimes, the cost of an asset is equal to fair value. What are those situations? Let's say I am into sandalwood plantation. My sandalwood plantation will give me an agricultural produce after 14 years. On balance sheet date, my sandalwood plantation is exactly 100 days old. 100 days old. And I'm saying you will get agricultural produce after how many years? 14 years. 100 days. That means the biological transformation which have occurred during the 100 days is very minimal, very immaterial. In such cases, the cost can be considered as fair value. Okay, where there is a very little biological transformation, or even if there is a biological transformation, it is immaterial. In such cases, your cost can be considered as fair value. I've given you the example of timber plantation. 14 years timber plantation on balance sheet date, if it is 100 days old or 120 days old, then you can say that the biological transformation which has undergone is very little or immaterial. Therefore, in such cases, the cost is an approximate fair value. Now, whenever I measure it at fair value, we'll always give rise to gain or loss. Guys, immediately if you look at agricultural produce itself is being measured at fair value less cost to sell. So that means the gain or loss on agricultural produce arises at the point of harvest itself. Initially, what is the cost? Nothing. So when I measured it at fair value less cost to sell, automatically I gave rise to a gain. Because how do you recognize agricultural produce? Agricultural produce account debit to gain at the point of harvest. Agricultural produce account debit to gain at the point of harvest. So this gain at the point of harvest being transferred to P&L. So always remember, whenever I have an agricultural produce, the fair value of the agricultural produce should be recognized to the credit of P&L at the point of harvest itself. If I am applying it in subsequently into manufacturing process, then the fair value of the agricultural produce should be a cost in valuation of inventory. Should be considered as cost in valuation of inventory. What about biological assets? Year on year, I keep on measuring it at fair value less cost to sell. Then the difference between the fair value less cost to sell each year should be recognized in the P&L. If there's an increase in fair value, then I will credit it to P&L. Decrease in fair value, I will debit it to P&L. 1 year old calf, still not in the situation to provide me milk, valuation is less. 3 year old cow, yes, automatically it is able to milk it, or we will be able to derive some milk from it. 100% there is an increase in the fair value of that particular cow. 10 years over, the cow is not eligible or is not in a position to give you any further milk. What happened? Automatically the fair value has declined. So what happened? Year on year, I started recognizing gain because of increase in fair value of the biological asset. But after a certain point of time, when the production of milk from the cows significantly declines, then the fair value of the cow also keeps falling down. In such cases, I'll keep recognizing a loss in P&L. So biological asset, I will recognize a gain or loss on each balance sheet date by measuring the biological asset at fair value less cost to sell, comparing it with fair value in the last year, and recognizing the difference into the P&L. But regarding agricultural produce, you will only value the agricultural produce at the point of harvest at fair value less cost to sell. So on that day, at the point of harvest, when you have recognized it at fair value less cost to sell, it should be immediately credited to P&L. I don't have to do it year on year. Clear? Coming down to the last point where we talk about government grants related to agriculture. If the government grant relates to an asset which is measured at cost, then this standard will not discuss about it. Here, biological assets and agricultural produce both are being measured at fair value. They are not measured at cost. Therefore, Ind AS 20 is not applicable. But when I talk about assets for which government grant is received, if these assets are measured at fair value, both in the case of biological assets, also in the case of agricultural produce, the government grant is received against the agricultural produce or biological assets which are measured at fair value. In such case, I will divide the grants into two types: unconditional grants and conditional grants. Any farmer holding 1 acre of land, yearly is entitled to receive 14,000 from the state government. Unconditional grant. Your ownership has given rise to that particular income. Even if you're not doing any agricultural activity on that, you're still entitled to receive that grant. Clear? So whenever I talk about such unconditional grant, recognize the grant as income in the P&L immediately when the grant is receivable. Immediately when the grant is receivable, I'll credit the P&L with the amount of grant received. But if it is a conditional grant, I will give you per bag of rice, let's say 100 rupees of government grant. If you produce at least 25 bags per acre for the next 5 years, conditional grant. In such case, I will recognize the grant which are attached to the conditions as income in the P&L over the period for which the conditions attached to the grant are expected to be met. Here, this conditional grant is very much in similar line with the standard Ind AS 20, where even Ind AS 20 had the same recognition principle, where he said the government grant should be credited to P&L over the period for which the expenditure is expected to be met for satisfying the conditions attached to the grant. Same rule applicable even for government grants which are conditional in nature relating to agriculture. But generally, grants on agriculture are unconditional in nature because agriculture in India is a sensitive political aspect. Sensitive political aspect. So you need to understand that generally in India, we have a lot of unconditional grants. So these unconditional grants should be recognized as income when the grant is receivable. Now, can I consider a binding sale agreement as fair value? If you remember your Ind AS 36 impairment, when we are talking about determination of net selling price, fair value minus cost to sell, we had a particular discussion about determination of fair value, where I had a binding sale agreement, then the fair value is equal to the binding sale agreement price. If binding sale agreement is not available, then active market exists, then determine your fair value based on active quoted market bid price. If bid price not available, adjust. If you cannot have an active market and you cannot determine fair value with respect to active market also, in such case, don't consider your net selling price. Straightforward, your value in use is your recoverable amount. This is what we have learned as a part of Ind AS 36. There, the first emphasis was on binding sale agreement. But here, under Ind AS 41, he says binding sale agreements are not considered as fair value because binding sale agreements are always entered at less than fair value. That's why he says binding sale agreements are predetermined agreed price for agricultural produce expected to arise in future. They are normally considered to be less than the fair value at the point of harvest. That is the reason why they should not be considered as fair value. What is a fair value then? It is a market assessment of agricultural produce at the point of harvest. So there could be a significant difference between a binding sale agreement price and the fair value. Even if there is a binding sale agreement price, after the new farm reforms have come up, you can get into a contract with the farmer to basically sell his produce at a predetermined price. This is called as contract farming. But you need to understand the price at which I agreed to sell the produce cannot be considered as fair value. It is a binding sale agreement price. It is for a price for the expected future agricultural produce. So that cannot be considered as fair value because fair value is a market assessment of agricultural produce done at the point of harvest. And that will bring us to the end of discussion on this standard Ind AS 41. Remember guys, it's a very typical standard, has a lot of concepts relating to fair valuation because it is very difficult to ascertain cost in case of biological assets or bearer plants. Sorry, in case of biological assets or agricultural produce. The cost cannot be measured. So therefore, fair value is a much logical valuation of agricultural produce. Clear? Ind AS 21. Why does Ind AS 21 talk about this functional currency then? Guys, you need to understand when I talk about functional currency, Functional currency is a currency of the primary economic environment in which the entity operates. Guys, India's 21 is significantly different from AS 11 is what I'm saying. I'm saying AS 11, which was a comparable standard, just spoke about home currencies and foreign currencies. But on the other hand, when it came to India's 21, I showed a distinction between functional currency, presentation currency, and foreign currency. So there, the home currency concept itself is removed. Why is the concept of home currency removed? Because here we need to understand the concept of globalization's impact on Indians. What is happening on today's date? There are many such enterprises which are established in India, but predominantly are serving the interest of public outside India. So their customer sources are basically outside India. They're actually reporting to the foreign currency itself. They're reporting to the foreign entity itself. In Hyderabad, you have a company called Synchrony. Synchrony is basically providing a credit card transaction services to people of US. So basically what is happening? The country in which they are actually operating is India, but the economic environment in which they principally operate is in US. So an Indian enterprise, instead of having a functional currency in rupee terms, can have a functional currency in dollar terms, because their primary currency of economic environment or economic transactions is denominated predominantly in dollars. So it is not affected by rupee terms. That is fundamentally why you get this concept of functional currency and the elimination of the concept of home currency out there. Clear? So whenever I talk about functional currency, it is eliminating the concept of home currency and is saying wherever your enterprise is, irrespective of the country in which you reside, irrespective of the country in which you have a registered office, what is the primary economic environment in which you operate? I operate primarily in US. My operations are directed to the people of US. So therefore, the economic environment in which I operate is the US, and the currency of that primary economic environment is a dollar. Therefore, functional currency should be considered as a dollar form. Clear? So that is the reason why India's 21 has a high significance and a significant difference from what we earlier discussed as a part of AS 11. So the standard deals with predominantly three parts. The first part, which deals with foreign currency transaction. Second part, dealing with foreign operation. Third one, dealing with translation into presentation currency. So now, foreign operations was very similar, and foreign currency transaction is very similar to what we dealt under AS 11. But this third one has come into picture, that is translation into presentation currency. Why did this prop up now? Why is there a difference between a reporting currency and a presentation, your functional currency and your reporting currency? Because you might be basically in conducting your operations in India. Your functional currency is the currency in which you have primary economic environment, which is a rupee term. But I'm a US subsidiary. So my holding company does not understand money terms in rupee. So I wanted to prepare my financial statements in dollars so that it is communicable to them, so that they understand it better. So therefore, in such cases, I select a presentation currency. Functional currency, can I select? I don't select for functional currency, because functional currency is determined. They are not selected. Presentation currency is selected by the management. Functional currency is determined based on the primary economic environment in which the entity operates. Clear? What is a foreign currency then? Any currency other than the functional currency is considered as a foreign currency. Let's see. So the currency is broken down into three parts: functional currency, foreign currency, and presentation currency. What is the functional currency? The currency of primary economic environment in which the entity operates is called as functional currency. What is a foreign currency? Anything other than this functional currency is called as a foreign currency. What is presentation currency? The currency in which my financial statements are prepared. It is the choice of the management functional currency is never a choice. It is not a choice. It is the primary economic environment in which the entity operates, which determine what is the functional currency. So let's talk about determination of functional currency. There are certain factors which I have to consider in determining a functional currency. What are those factors? Number one, the currency which influences the sale price of goods and services. That is the currency in which the sale occurs, or the sale price is denominated, or the sale is settled, the transaction is settled. This currency is predominantly called as functional currency. The currency which influences the sale price of goods and services, that is the price in which, or the currency in which the sale price is quoted or settled, can be considered as my functional currency. Number one. Number two, the currency of the country whose competitive forces and regulation determine the sale prices of the goods and services. So where I gave you the example of Synchrony, they predominantly operate in the US. The US expects the entire transactions to be denominated in dollars. The country has competitive forces and regulations which determine that the sale price should be denominated in a particular currency. Therefore, such currency becomes my functional currency. Number three, the currency which influences labor, material, and other cost of providing the goods and services. Number four, the currency in which the funds for financial activities or financing activities are being generated. That currency in which I raise a debt, the currency in which I issue shares. These are currency in which financing activities are raising funds from, which currency can be called as a functional currency. The currency in which the receipts from operating activities are usually retained. I have a tendency of receiving a rupee, but I convert it into dollars and store it in dollars because I have payments in dollars. Therefore, a dollar becomes a functional currency even though I am receiving a rupee term. Therefore, it should be considered as a functional currency. Five things. The currency which influences the sale price of the good. Number two, the currency of the country whose competitive forces and regulations determine the sale price of the good or a service. Currency which influences labor, material, and other costs. Currency in which funds from financing activities are generated, and currency in which the receipts from operating activities are generally retained. Clear? Now, should all the conditions be satisfied to determine functional currency? Not necessary. If substantial factors are satisfied, you can determine functional currency. The functional currency of an enterprise is determined based on substantial satisfaction of factors considered for determination. Clear? My items in financial statements are generally broken down into two parts. Financial statements are balance sheet and P&L predominantly. Under balance sheet, I have real accounts and personal accounts, while under P&L, I have nominal accounts. For the purpose of Ind AS 21, I'm giving different names to it. My real accounts, for the purpose of Ind AS 21, will now be called as non-monetary items. For the purpose of Ind AS 21, I'm calling these real accounts as non-monetary items. My personal accounts are called as monetary items. Finally, my nominal items, there is no change in the name. I let them be nominal items itself. Now, what is this monetary items and non-monetary items, and how do I define them? Monetary items are items which can be either realized or paid, settled in cash. Either I am receiving or paying in a fixed sum of money is called as monetary item. Example, cash in hand, cash at bank, your debtors, bills receivable, advances, deposits are monetary assets. Monetary liabilities, loans, creditors, bills payable, outstanding expenses, all these are monetary items which are settled by payment of a fixed sum of money. What are real accounts? Real accounts which are considered as non-monetary in nature, they are not settled or not realized in fixed sum of money. Best example, your property, plant and equipment, intangible assets, investments, inventory. These are further classified into two types. Those non-monetary items which are carried at historic cost and those non-monetary items which are carried at fair value. Like you remember, under Ind AS 16, now we said either you can go as per cost approach or you can go as per revaluation approach. When I apply revaluation approach, I'll have to measure the asset at its fair value. So whenever you are classifying the non-monetary assets, these non-monetary assets are also classified again into two parts. One is non-monetary assets carried at historic cost and non-monetary assets carried at fair value. Clear? First thing, what is a foreign currency transaction? What do you mean by a foreign currency transaction? First, any transaction which is denominated in a foreign currency is called as a foreign currency transaction. Can you give me some examples? I purchased my machinery from Germany in euro is a foreign currency transaction for an Indian enterprise. I am selling my good or a service to US which is denominated in dollars to an Indian enterprise. Such sale of good or a service to US in dollars can be considered as a foreign currency transaction. I raised debt from Australia in Australian dollar because the dollar borrowing rate in Australia was cheaper, which is a foreign currency transaction. So taking a loan in foreign currency or repaying the loan in foreign currency is also a foreign currency transaction. So these are classic examples of foreign currency transaction where a transaction is denominated in a currency which is other than the other than the functional currency is called as a foreign currency transaction. Whenever I have a foreign currency transaction, then how do I recognize the transaction? For example, I purchased a machinery in euro, and let's say the purchase price of the machinery is 100,000 euros. 100,000 is 1 lakh. How do you recognize the entry? Machinery account debit to supplier. How much amount? 1 lakh euro or 100,000 euro. But all your journal entries above are in rupees. How can you have this journal entry in euro terms? I have to convert this euro into rupee terms. Therefore, a foreign currency transaction has to be converted into functional currency for the purpose of accounting, for the purpose of recording a journal entry, for the purpose of posting it into a ledger. It requires me to record the transaction in functional currency. So the foreign currency transaction has to get translated into functional currency. This is the concept that we're going to discuss as the first part of Ind AS 21 when we deal with foreign currency transaction. Remember, at the first date of recognition, initial recognition that occurs on the date of transaction, I will translate this foreign currency transaction into functional currency using the exchange rate on date of transaction. I'm saying I'll initially recognize the transaction on the date of transaction using the exchange rate applicable on the date of transaction. Clear? So if I have purchased a machinery from Germany in euro, then in such cases I will apply the exchange rate on the date of acquisition. Let's say acquisition happened on 15th August 2020. Then what do? Machinery account debit to supplier 100,000 euros multiplied by exchange rate of euro on 15th August. But let's say this amount payable to the supplier is after 1 year. So what happened? On 31st March 2021, I have to close my books of accounts for the year 2021. On such day, I need to go for subsequent measurement, a subsequent recognition. What do you subsequently recognize? I subsequently recognize only monetary items. Non-monetary items I will not subsequently recognize. If you remember the transaction, what was the transaction recorded as? Machinery account debit to supplier. Machinery account, it is a real account which is non-monetary in nature. Either it could be carried at historic cost or it could be measured at fair value. Forget about that concept. But ultimately it is a non-monetary item. No subsequent recognition should happen. But I wrote machinery account debit to supplier. Supplier is a creditor. He should be settled by payment of fixed sum of money. Therefore, he is a monetary item. Such monetary items should be subsequently recognized on balance sheet date. On the balance sheet date, I'll have to use a closing rate for translation of the monetary item. What is a closing rate? Closing rate is the exchange rate on date of balance sheet. Let's say when I initially recognized the transaction on 15th August 2020, the value of euro was 80 rupees per 80 rupees per euro. Therefore, 80 rupees into 1 lakh, I recognize the transaction machinery account debit to supplier for 80 lakhs. As I came on to the balance sheet date on 31st of March, now the supplier's account which is showing at 80 lakhs has to be restated based on the exchange rate on the date of balance sheet. Let's say the closing rate on the date of balance sheet was 82. So the supplier's value is 1 lakh into 82 lakhs and not 80 lakhs. Therefore, the supplier, that is a liability which you are showing, has to be restated to 82 lakhs. That means I'll have to credit the supplier by 2 lakhs extra. Then what do I debit? Can I debit the machinery? I can't debit the machinery because machinery is a non-monetary item. It should not be subsequently measured. Then what should I debit? In such cases, the transfer of the debit should happen to P&L. I will recognize it as an exchange loss to be transferred to P&L because there is an increase in the value of liability. Therefore, it is a loss. So on the balance sheet date, I will recognize the entry as P&L account debit to supplier for 2 lakhs because the exchange rate on balance sheet date, that is your closing rate today, is 82. Let's say we went up to 15th of August again. 15th August 2021, I am settling the transaction today. My settlement happened at 81 rupee per dollar. So what is the entry that you passed? Supplier account debit to bank, 81 rupee per euro, 81 into 1 lakh, 81 lakhs. But the supplier account was having a credit balance of how much? 82 lakhs. 80 lakhs recorded on the date of transaction, 2 lakhs recorded on balance sheet date. That 1 lakh is a reduction in liability because of a fall in exchange rate. Therefore, I'll have to make sure that the supplier's credit balance of 1 lakh should be written off. So I'll write supplier account debit 1 lakh because of reduction in the value of euro to P&L. This exchange difference arising due to subsequent recognition or subsequent measurement of monetary items should always be resulting in gain or loss. Such gain or loss resulting from a change in exchange rate should be transferred to P&L. Clear now? Concept, did you get it? Remember, there is one exception. He says, if the closing rate is unrealistic and you don't expect, the enterprise does not expect the transaction to be settled at a closing rate. I don't expect the transaction to be settled at closing rate. In such situation, instead of considering the closing rate, you can consider the rate at which the transaction is expected to be settled. Can you give me an example? Why does this happen? Transaction happened on 15th August when the euro was 80 rupees. Suddenly there was a crisis in Europe and the closing rate has come down to 65. On balance sheet date, it became 65. I know it is only a temporary fall in the value of euro. I know euro is a much stronger currency. I know that the transaction will not be settled at 65 because when the amount falls due on 15th of August 2021, I know that the euro will appreciate again. So therefore, on that day of balance sheet date, I will not recognize the supplier's account at 65 rupees. Instead of taking 65, I'll assume a rate at which I'm expected to settle the transaction. Let's say I'm expecting that the euro value will bounce back. The recovery is already in progress and I'm expecting the euro to settle down at 75 rupees, which could be the possible value even on 15th August when I intend to settle the transaction. Therefore, instead of considering 65, I will consider 75 because your closing rate is unrealistic and I don't expect settlement to happen at that closing rate. Clear? It's an unusual situation, guys, but still you need to remember that this paragraph exists within Ind AS 21. So therefore, is it compulsory to take closing rate always? Not necessary. If the closing rate is unrealistic, then you can take the rate at which the transaction is expected to be settled for the purpose of translating your monetary item on a balance sheet date. This will bring us to the end of the first concept of Ind AS 21, which deals with foreign currency transaction. Clear? Yes, guys. So going into the next part of the standard of Ind AS 21, which deals with foreign operation. What is a foreign operation and what do you mean by a foreign operation? A foreign operation basically means that I am an enterprise somewhere in India, but I have a branch or a subsidiary or any other form of operations being running in outside India. Let's say I have a branch in US or a branch in US, in UK, or I have a branch in Australia, and that branch is also performing its operations, then it will be called as foreign operation. Now, why is this concept of foreign operation so important, and why should I deal it under Ind AS 21? Remember, when I prepare financial statements of the enterprise, then financial statements of the enterprise should be prepared on a consolidated basis with all the subsidiaries. Should be presented for all the branches put together. You have to add all the branches. Then only you will be able to prepare one set of financial statements for the enterprise. But unfortunately, the branch which is situated outside India or the subsidiary which is situated outside India is performing operations or having a functional currency which is other than a rupee. You here sitting in India, your head office is presenting everything in rupee terms. There, the branch or the subsidiary is presenting everything in other than rupee terms. How will you combine? How will you combine everything and to form one single financial statement? Can I add $1 lakh plus 10 lakh rupees? Add? I can't add. So therefore, I have to make sure that even such foreign operation have to be translating their trial balance, their entire trial balance into rupee terms, into my functional currency of the home enterprise or the parent enterprise. This concept of translation of foreign operation trial balance into the home enterprise currency is called as foreign operations translation. It is dealt under Ind AS 21. So what is this translation of foreign operation? What are foreign operations? So what is a foreign operation? We have seen. So what are you translating? You're translating the trial balance of the foreign operation into multiplying it with the exchange rate to derive a trial balance of foreign operations in functional currency. Why do you need that? Because I need to present one single set of financial statements for the enterprise. If it is a holding and subsidiary relationship, then I have to present consolidated financial statements. If it is a branch, then I have to combine the trial balance to present the financial statements of my enterprise. So to combine them, to consolidate them, you need to translate the foreign currency trial balance of the foreign operations by using certain exchange rates into trial balance in functional currency. The question here under Ind AS 21 is, what exchange rate? What is the exchange rate which I have to apply to translate the trial balance of foreign operation to derive a trial balance in functional currency? This is the exchange rates. For a non-monetary item, which are real accounts, and if they are carried at historic cost, then I'll have to apply exchange rate at closing rate. Closing rate is exchange rate on balance sheet date. But if these non-monetary items are carried at fair value, where a fixed asset like property, plant and equipment or intangible asset could be measured at fair value, or inventory could be measured at fair value, in such cases, you have to apply the exchange rate on which you determine the fair value. Clear? Monetary items. What are monetary items? Like I told you, they are either realized or settled by fixed cash, like personal accounts. In such cases, I'll apply a closing rate. Nominal items, which are nothing but incomes, expenses, losses, and gains, they have to be translated using average rate. What is average rate? Average rate is opening rate plus closing rate divided by 2. Now, let's say, for example, I have a foreign operation. Okay. I have a foreign operation in London. What is the functional currency in London? Pound. Their functional currency is pound. Let's say, for example, I have drafted a trial balance. All my functional currency trial balances are in pounds only. Let's say there is an item A, B, C, whatever it is. Your trial balance has finally tallied. Now what are you doing? Now I'm translating this into INR. So for translation, what did you do? These debits and credits, they are multiplied with certain exchange rate. So what happened? This item A, I multiplied with an exchange rate ER1. This B, I translated using exchange rate ER2. This C, I applied some other exchange rate ER3. Now, in this case, how will your foreign currency trial balance tally? After translation into INR, your foreign currency trial balance will not tally. Here, the total is not the same. Therefore, it's always a difference which arises. If it tallies, it's pure coincidence, guys, and nothing else. Pure coincidence. Generally, it does not tally. There is some difference which arises. What about this difference? What should I do with this difference? This difference which arises on translation of foreign operation into functional currency of the parent enterprise, this difference should be transferred to another reserve called as FCTR. I'll have to transfer it to a reserve called as FCTR. Foreign Currency Translation Reserve. You can also call it as Foreign Currency Translation Adjustment, FCTA, but general sequence we use the word FCTR. Clear? That will bring us to the end of discussion on foreign operations. Remember, guys, if I go into the concept of Ind AS 110, which is consolidation, your Ind AS 110 says your parent and the subsidiary need not have the same balance sheet dates. Consolidation is probable even if the difference between the two reporting dates of parent enterprise and subsidiary are not separated by more than 3 months. If the difference between the reporting date of the subsidiary and the reporting date of the parent enterprise is only 3 months, you can consolidate. If it is beyond 3 months, then the subsidiary's financial statement should be prepared or redrafted again on the date of parent enterprise closing its financials. Okay. Let's say it is exactly 3 months. Let's say your foreign operations financial statements are ending on 31st of December, while your parent enterprise financial statements are ending on 31st of March. Difference is only 3 months, so it is absolutely fine. Then when I translate this foreign operation using at exchange rate, then what should be the closing rate? Should the closing rate be considered as exchange rate of balance sheet date of the parent enterprise, or should it be considered as exchange rate or balance sheet date of foreign operation? The answer is it should be considered as the exchange rate on the balance sheet date of the foreign operation. Therefore, in this given example, 31st December will be considered as the exchange rate on balance sheet date and not 31st March. Clear? What happens when I dispose of a foreign operation? Dispose means I sell out the division or I completely shut down those foreign operation. In such case, what happens? If there's a complete disposal, that means it was a subsidiary. I sold out all the shares in the subsidiary to another enterprise. In such cases, whatever FCTR has already been accumulated, every year I kept on accumulating the FCTR due to the differences which are arising on translation. So all those accumulated FCTR should be transferred to P&L, either to the credit of P&L or debit of P&L, depending upon the balance in FCTR account. But if there is a partial disposal means only in part. So subsidiary, I had 80% shares, I sold 20%. So proportionate disposal, fractional disposal happened, but even after the fractional disposal, I still control 60%. It is still my subsidiary. In such situations, where the controlling interest is retained, proportionate FCTR reserve should be transferred to NCI, which is non-controlling interest. This concept of non-controlling interest will emerge under Ind AS 110. So I'm saying whatever FCTR has already been accumulated so far, on the date of partial disposal, if the controlling interest in the subsidiary is still retained, proportionate FCTR, that is 20 by 80, in the case of disposal of only 20%, so into 20 by 80 should be transferred to non-controlling interest. If I did a partial disposal in such a way that I don't have controlling interest anymore, I had 80% interest earlier. Today, I have sold 50% of the interest in the subsidiary. So my shareholding has come down to only 30%. So no longer controlling interest. In such cases where it has been dropped down to 30%, so proportionate FCTR should be transferred to P&L. That means total FCTR into 50 by 80 should be transferred to the credit or debit of P&L depending upon what is the balance in FCTR. So what am I saying? Complete disposal, full FCTR transfer to P&L. Partial disposal, but no controlling interest. Proportionate FCTR you transfer to P&L. Partial disposal, but I am still having controlling interest in the subsidiary. In such cases, the proportionate FCTR should be transferred to NCI or non-controlling interest and no longer to P&L. Clear? Now comes this concept of presentation currency. What did I say? Presentation currency is the choice of management. The management can choose to present its financial statements in a particular currency. Functional currency is not management choice. It is based on the primary economic environment in which the entity operates. So it is determined. It is not assumed. It is not selected. It is not the choice of management. But presentation currency is the choice of management. If your functional currency is different from presentation currency, your entire trial balance until the date of preparing financial statements are always denominated in functional currency. You reported everything in functional currency, your trial balance prepared in functional currency. But exactly on balance sheet date, I am preparing financial statements, but my financial statements are not in functional currency. You choose another currency for presenting your financial statements. I gave you the example. I'm an enterprise registered in India, conducting operations in India, but I'm predominantly a subsidiary of a US company. US company is requesting me to prepare financial statements in dollars so that it will be easier for that fellow to consolidate. Fine. So I said, okay, fine. Let me select another presentation currency in dollars instead of a functional currency of a rupee. In such case, what happens? Whatever trial balance you already drafted in functional currency, such trial balance should be translated into foreign currency, into presentation currency. What are the exchange rates applicable? The same exchange rates which you applied as far as your foreign operation is concerned. Non-monetary items carried at historic cost using closing rate. Non-monetary items carried at fair value using exchange rate on determination of fair value. Monetary items using closing rate. Nominal items using average rate. Again, difference does arise. Like we've already discussed earlier, when we have a translation of foreign operation, there will be a difference. Even when you translate it into presentation currency, there will be a difference. Such difference, if it was a foreign operation, I transferred it to FCTR, foreign currency translation reserve. But if it is a translation into a presentation currency, FCTR concept does not arise. It should only be transferred to OCI, other comprehensive incomes. Clear? So instead of FCTR, I'm taking it as OCI. Check above. It is the same exchange rates for translation of foreign operation into functional currency. I have transferred the differences to FCTR. If my functional currency is not the same as presentation currency, I'll apply same exchange rates, but the difference is no longer transferred to FCTR, but it should be transferred to OCI. Clear? One last paragraph before I end the standard Ind AS 21. One last paragraph. For explaining this particular point, I'll have to draw some attention towards a paragraph of AS 11. This paragraph is called as para 46A of AS 11. Guys, your para 46A of AS 11 was inserted into AS 11 only in 2009. Until 2009, we had only para 46. That is the last paragraph of AS 11. Subsequent to 2009, 31st March, this paragraph additionally was inserted into AS 11, which is called as para 46A. What is this para 46A of AS 11? I'll talk about the relevance of Ind AS 21 here, but first understand what the AS is talking about. Accounting Standard 11 para 46A says, if I have taken a long-term foreign currency borrowing, to acquire a non-monetary depreciable asset. I have taken a long-term foreign currency borrowing to purchase a fixed asset which is depreciable in nature. Fixed assets depreciable in nature are non-monetary items. No further translation is required. So keep it like that. But this foreign currency long-term borrowing is a monetary item. When I say it is a monetary item, like we have already discussed as a part of foreign currency transactions, they have to be translated using closing rate on each balance sheet date. So you translated the foreign currency borrowing using the closing rate, and there was some exchange difference which arose. If I wouldn't talk about 46A, what you would have done? This exchange difference which has arisen should be considered as an exchange gain or exchange loss, and I will transfer it to P&L. Correct? But here 46A gives an option to the enterprise. He says, if you have taken the long-term foreign currency borrowing anytime after 7th December 2006, anytime after 7th December 2006, it was inserted in 2009. He is giving a retrospective reference starting from 7th December 2006. Don't ask me what is the concept of 7th December 2006, but 2006 was the period when Lehman Brothers went down, Merrill Lynch Bank went down, AIG was almost at the verge of declaring insolvency. There was a huge crisis in US where the borrowing rate came down very, very low. So if I have taken a long-term foreign currency borrowing anytime after 7th December 2006, such foreign currency borrowing has been utilized towards purchasing a depreciable asset, then in such case, the exchange difference arising from translation of this borrowing on each balance sheet date, instead of charging off to P&L, it is an option of the enterprise to add it or deduct it from the cost of the asset. You can either charge it off to P&L or you can adjust it to the cost of the asset. Now, if it is a gain, I'll reduce it from the cost of the asset. If it is a loss, then I'll add it to the cost of the asset. Why? Why is one of the very beautiful questions, guys. What I can answer? Why can I answer? Yes, I can. I'll tell you. Around the same date, 7th December 2006, the dollar rate was 38 rupees. Dollar to rupee rate was 38 rupees. I'm talking about exactly 15 years back or 14 years back. By the time we touched 2009, already dollar was quoting more than 55 rupees. By the time we came to 2014, dollar was already trading at 70 plus rupees. That is where Raghuram Rajan came in. A little bit of standardization happened where dollar settled down between 68, 69, around that rate. So you need to understand, a person who has borrowed dollars in 2006 at the rate of 38 rupees per dollar, today in 2009 or 2010, okay, I'm talking not today, in 2009 or 2010, should have been repaying 60 rupees per dollar. That means the value of the borrowing has increased by almost 22 rupees per dollar. Imagine what sort of a loss am I talking about. On today's date, if you look at what is the exchange differences between the opening and the closing, maximum 2 rupees or 2.5 rupees. But if I'm talking about 3 years difference, averaging to about 22 rupees over 3 years, then imagine what kind of exchange loss is it. If such exchange loss get debited to P&L, it could have given a significant effect as far as your P&L is concerned. It could have a serious effect on the P&L. Whatever operating profit which I might have got would have completely got eroded because of the exchange loss. So that is the reason why the Companies Act has come up with Companies Accounting Standard Amendment Rules 2009, applicable starting from 31st March 2009 itself, where he has given a retrospective application from 7th December 2006 and said that in such situations, in a situation where you have a foreign currency borrowing and you have acquired a non-monetary depreciable asset, then the exchange gain or loss arising on subsequent measurement of the foreign currency borrowing on a balance sheet date, such exchange gain or loss should be adjusted to the cost of the asset or can be charged off to P&L. Either of these options are given to the manager. But he put a particular condition saying that these options, either you charge it off to P&L or capitalize it to the cost of the asset, are irrevocable option. If you select the option at a particular point of time, you will have to continue to apply that option throughout the period, even if tomorrow there is an exchange gain. Exchange loss last year, I added to the cost of the asset. Exchange gain next year, sir, I don't want to add, sir, I'll credit it to the P&L. Not possible. Once you have applied a particular option, you will continue to exercise the same option over the lifetime until the borrowing is repaid. Clear? Now, what is the significance of para 46A of AS 11 in case of Ind AS 21? Is there a similar paragraph even under Ind AS 21? No. There is no such similar paragraph in Ind AS 21. But what Ind AS 21 says is, if an enterprise has applied the provisions of para 46A to a foreign currency borrowing before the adoption of Ind AS, if an enterprise has already applied the provisions of para 46A of AS 11 to a foreign currency borrowing, though such paragraph is not available under Ind AS 21, you can continue to apply the treatment of para 46A of AS 11. Even if the enterprise has translated into Ind AS, even after they are adopting Ind AS, even though such paragraph is not available under Ind AS, if an enterprise has already had a foreign currency borrowing before and they continue to follow a particular approach of 46A, then you can continue to apply the same approach even under Ind AS. However, this option to apply such provisions of 46A is only valid until the loan is repaid or the asset is disposed, whichever is earlier. Once the loan is repaid or the asset is disposed, you can no longer apply the provisions of para 46A. This is not a part of Ind AS 21, but it is given as an ITFG, Ind AS Transition Facilitation Group. So they have given this clarification saying that these provisions can apply. Look at what he's saying now. He says, if I have a long-term foreign currency borrowing with which I have acquired a depreciable non-monetary asset. Your long-term foreign currency borrowing is a monetary item subsequently measured using closing rate on balance sheet date. It resulted in an exchange gain or loss, which at the option 1 can be transferred to P&L or option 2 can be capitalized to the cost of the asset. The provisions of para 46A shall continue to apply even in the case of Ind AS, even though that corresponding paragraph is not applicable in Ind AS 21, if the enterprise has already applied the choice or option under para 46A before the transition to Ind AS. But this option of continuing to apply para 46A is available to the enterprise only until the borrowing is repaid or the asset is disposed, whichever is earlier. Once the borrowing is repaid, you can no longer take the benefit of para 46A. Clear? I hope I got it clear now. Can a functional currency change? Yes, sometimes there can be a change when there is a change in circumstances. In such cases, your monetary and non-monetary items should be translated using closing rate, and the change in value of the item, be it monetary item or non-monetary item, should be considered as a change in historic cost. should be considered as a change in historic cost. So no exchange gain or loss should be considered. It should directly be considered as a change in historic cost and go on. So option under 46A, one second, sir. Yeah, option under 46A is not applicable for companies which adopted Ind AS. However, the loan in foreign currency borrowing after adoption of 46A is not eligible to apply the provisions of para 46A. However, if an entity has already applied 46A prior to the application of Ind AS, they can continue to use the option until the loan is repaid or the asset is disposed. This is the last concept of para 46A or Ind AS 21, where the 46A is not applicable but still has a significance because there could be certain companies which are continuing to apply provisions of 46A even before the adoption of Ind AS. So this is only an interim relief. Once the loan gets repaid or the asset is disposed, the benefits of para 46A cannot be utilized by the enterprise any longer. Clear? That will bring us to the end of discussion on Ind AS 21. Yes, guys. So now we get into a disclosure related standard which deals with segment reporting. It was called by the name segment reporting under ICAI as per AS 17. Now, this is a part of Ind AS 108 which deals with something called as operating segments. The name given is operating segments. I'll tell you what is the difference. I'll tell you why it has become very important. Now, I'll put it like this. Guys, whenever I talk about operating segments, the intention of the standard is basically to make sure that the user of financial statements can see through the eyes of the management. On how the management sees the enterprise. Management does not simply present a P&L or a balance sheet for making decision-making process. They have broken down the operating segments. They have identified small components of the enterprise based on which they take a decision, based on which they basically perform the activity of decision making. Now, let's say I am into a garment industry. Garment industry is a very fancy industry, right? Let's say my garment industry is into making garments for both men as well as women. The enterprise tries to look at what is the revenue which they collect from men garment as well as the women garment. What is the expenditure related to men garment and what is the expenditure related to women garment? What is the profitability they derive from men garment and what is the profitability they derive from women garment? This way of presentation will entitle the management to take a call on where should they allocate the further resources to. If the women garment is giving me a substantial higher profit, then the enterprise resources will also be diverted towards the women garment industry only. Clear? So men garment industry will not be allocated enough funds or any further funds. Now this decision making process cannot be derived only if I create one single P&L. Because in that single P&L, I will only be able to understand whether the enterprise as a whole is deriving a profit or a loss. How will I know whether women garment is doing better or men garment is doing better? How will I know whether the South industry or the South India or North India or Central India or West India or East India is giving me a better sales? How do I know whether the state of Tamil Nadu or whether the state of Karnataka, whether the state of Madhya Pradesh or Uttar Pradesh or Delhi or Rajasthan or Haryana is giving me a better benefit? So that means an enterprise has to break down the entire P&L into bits and pieces. How will they break down? If I was the manager of the enterprise and if I was supposed to take a decision financially, then I will request them to give me data like this. State-wise, area-wise, give me data of male garments and female garments. Based on which I will take a call. Based on which I will decide which one is more important for me. Or where the resources has to be allocated. How do I assess the performance of each particular pattern? So all these decisions are being derived by breaking down the P&L into small parts. This breaking down of P&L into small parts to assess the performance and to allocate resources is basically called as operating segment. Each that small piece is called as operating segment. These operating segments have to be reported as a part of your financial statements as per Ind AS 108. What does this do? This will give a better clarity to the user and can help the user to see through the eyes of the management how the management sees data to make decision making process, to make certain decisions. So even the user will be entitled to make those decisions, where user will also be entitled to see or judge the decisions of the management based on this information. This is the objective of Ind AS 108. Clear? It was also the similar objective under AS 17. But we have particularly one strong problem in Ind AS 108 or even under AS 17. If I break down in that way, and if I try to basically give you based on each component or based on each state on geographical location, if I break down and if I give you two basic problems, I get. Number one, competitor will know where I'm making major profit. Competitor will kill my competitive advantage by entering into that industry which is actually creating so much of profit to me. Number one problem from the competitor. Number two problem I have from the customer. If the customer will access my information and he will see that this particular component which he is buying, the company has a profit of almost 35%. Next time he will say, sir, I've seen your financial statements. You're making a profit of 35%, which is more than normal. So why don't you cut down by 10% so that you give the product at a much cheaper price to me? So customer will get a bargaining power because of these operating segments. Similarly, a competitor will kill my competitive advantage if such sensitive data is being exposed to them. So understandably, operating segments to be reported is always a sense of discomfort to the management, because the management does not want to expose such kind of information. Clear? Because this is highly sensitive data. So that is one big problem of operating segments. Now, what does Ind AS 108 say? How is it significantly different from AS 17? AS 17 used to classify the segments into two types called as business segments and geographical segments. While your business segments are categorized or classified based on the nature of products and services, based on the class of customers, based on the production process, based on the distribution channel. Geographical segments are based on the proximity of operation, based on the regulating statutes, based on the foreign currency risk. Based on these, I will identify geographical segments. Now that way, AS 17 gave a guidance on how to identify segments as well. Ind AS 108 said, forget. You don't have this concept of business segments or geographical segments anymore, because by identifying geographical segments and business segments, you're again putting extra pressure on the management to identify segments in a particular manner only. But in Ind AS 108, what is the objective? To make the user see through the eyes of the management. So management is anyways preparing a report, present the same report. Sir, management is not dividing it based on area or based on the business. No problem. Under Ind AS 108, we don't have the concept of business segments and geographical segments. It is exactly the same segments which the management sees or which the management presents internally for the purpose of decision making. So therefore, there is no concept of business segments and geographical segments resulting from Ind AS 108. Clear? So let's see. AS 17 has given us a classification of business segments and geographical segments, where they identify business segments based on nature of products, production process, class of customers, distribution channels, which are significantly distinct risk and rewards. Same way, even they used to identify geographical segments based on area of operation, regulating environment and currency risk, which are significantly distinct from each other in risk and rewards. Ind AS 108 has eliminated this process. They made things simpler, saying that you present however the management is seeing the information. Clear? According to Ind AS 108, an operating segment is a component of an enterprise which involves in business activities of deriving revenue and incurring expenses, which the CODM uses the information to allocate resources and assess performance. CODM means Chief Operating Decision Maker. in simple sense, management. Discrete financial information of that particular component is available. Discrete financial information is separate financial information for that particular segment is available. A segment is a component of an enterprise which involves in business activities of deriving revenue and incurring expenses, and the CODM uses the information to allocate resources and assess the performance, and where separate or a discrete financial information is available. There are 4-step process which I have to apply in reporting operating segments. What is this 4-step process? First step, identify the CODM. Who is your chief operating decision maker? That is the first thing. Number 2, identify operating segments. Number 3, determine what is my reportable segments. Number 4, disclosures necessary. This part of disclosures I'll briefly explain towards the end, but as such disclosures are not very important as a part of the standard for your exam perspective. Only from your exam perspective I'm saying the disclosures are not the most important ones. But the first 3 steps will elaborately understand how do I identify a CODM, who is this person CODM, chief operating decision maker, who is he? Number 2, what are the operating segments in an enterprise? Number 3, out of these operating segments, what should be reported? Number 4, what are the disclosures necessary? Clear? So this is the part which I have to understand as a part of Ind AS 108. First one, who is this CODM? He is a chief operating decision maker. I have never found in an enterprise a title of CODM at all. Have you seen? I know CEO, I know CFO, I know managing director, I know chairman, I know company secretary. These designations I know. I've never heard about this person called as chief operating decision maker. Therefore, CODM is not a title. It is not a title given to a person. It is the function which the person does. What function he does? A chief operating decision maker happens to perform the function of assessing the performance and allocation of resources. He will assess the performance on which segment is doing better, which segment is doing badly, and he will allocate resources accordingly. If these functions are handled out by a person, that person is called as chief operating decision maker. Generally, the managing director, CEO, CFO, COO, all these people should be generally called as CODM because they perform the function of assessing the performance and allocating resources. Clear? Then step 2. How do I identify operating segments? Operating segments should be identified based on the reports accessed by CODM in assessing the performance and allocating resources. What reports he sees in making decisions regarding assessment of performance and allocation of resources. He generally comes across an MIS, a Management Information System reports. These are generated periodically. Some organization they do it on monthly basis. Some organization do it on quarterly basis. These are provided to your internal management, which will enable the management to make decisions regarding allocation of resources and assessment of performance. So based on this MIS, based on this internally generated information, based on this internally circulated information, I will identify operating segments. So that concept of AS 17 rigidly defining business segments and geographical segments is gone. You will only identify segments based on the periodical reports which are provided to the CODM, based on which he makes decisions regarding allocation of resources and assessment of performance. Clear? So it became simple here. Then comes into the third, the most important concept of reportable segments. Out of the segments identified in step 2, all operating segments which I've identified in step 2, I will only report a few segments. Now your reporting of only a few segments has an underlying concept of materiality. He says the management has 365 days time and he will see every information. User does not have so much time on your enterprise. So the user wants to see only material information. So out of all the operating segments which are reported to the CODM on a periodic basis, I want to identify only a few segments which are material enough so that the user will get to access that material information only. Immaterial information can be ignored. Now, how do I apply materiality? How do I know that a particular segment is material? How do I know whether a particular segment should be reported or not? To identify this materiality, there are three materiality tests that he has given under Ind AS 108. What are those three tests which he has given? Revenue test, result test, asset test. Revenue test, where the segment revenue is at least 10% of total segment revenue. It is not greater than, guys, greater than, equal to is more appropriate. Segment revenue is at least 10% of total segment revenue. Segment assets of a particular segment are at least 10% of the total segment assets. Thirdly, your result test, where segment result is nothing but net profit or net loss, is at least 10% of higher of all the segments and profits put in total, or the total of all segments and losses considered as an absolute figure. I'll add all segments and profits, I'll add all segments and losses. Out of these two totals, whichever is higher, considering them as absolute number. Because you'll say, sir, loss means minus. No, anyways, profit will be higher. No, consider them as absolute numbers and compare these two figures. Whichever is higher, if your segment result is at least 10% of that particular 10%, if your segment result is at least 10% of the higher of the total of segment results and profits and total of segment results and losses, then it shall be considered as a reportable segment. Question comes up, should a segment to be considered as reportable satisfy all three tests, or can it satisfy any of these three tests? Answer is any of these three tests. That means a segment which satisfies a revenue test is sufficient to be called as a reportable segment even if it does not satisfy the asset test and the result test. Same way it applies even to other tests as well. Therefore, I can say that if a segment satisfies any of the three materiality tests, revenue test, result test, and asset test, then you can consider these segments as reportable segments. What are these three tests and how do we identify these three tests? Let's see. I'm talking about materiality tests, to determine reportable segments. I'll determine reportable segments out of all the operating segments identified in step 2 based on three materiality tests. What are the three materiality tests that he'll apply? The first test that he's going to apply is called as revenue test. What is your revenue test? Revenue test means if my segment revenue of a particular segment is at least greater than or equal to 10% of total sum of all segment revenues, then I can consider it as a reportable segment. Number 2, asset test. Under asset test, he says if a segment has an operating assets, segment asset is at least greater than or equal to 10% of total segment assets. Then you can consider them as reportable segments. Thirdly, result test. Under result test, he says If your segment result is nothing but profit or loss, if your segment result, profit or loss of the segment is at least 10% of higher of point number 1, sum of all segments and profits, sum of all segments and profits, or sum of all segments and losses. Loss, don't take it as negative figure, should be considered as absolute amounts. Then it satisfies result test. All these three tests, result test, asset test, and revenue test, are separated by or. That means if a segment satisfies any of these three tests, then it can be considered as a reportable segment as per Ind AS 108. So, three materiality tests which I have given: revenue test, asset test, result test. So, if a segment satisfies segments identified as operating segments in step 2, if they satisfy any of these three tests, then they should be considered as material segments which should be reported under Ind AS 108. Because reporting too many segments will be waste of time. That's why he's asking us to identify what are reportable segments. Clear? What is segment revenue? It is a segment revenue is a directly attributable revenue or reasonably allocated revenue to a segment. It includes inter-segment revenue. What is inter-segment revenue? That means if one segment is billing to the other segment or sending goods to the other segment, that is called as inter-segment transaction. In an inter-segment transaction, if the segment which is transferring goods is charging a certain price from the other segment, it should be called as inter-segment revenue. Clear? So it is a directly attributable or reasonably allocated revenue to a segment, including inter-segment revenue and excluding extraordinary items, should be considered as segment revenue. What is a segment result? Segment revenue minus segment expenses is segment result. That is nothing but profit or loss. What is a segment expense? Same thing as segment revenue. It is directly attributable or reasonably allocable revenue expenses to the segment, including inter-segment expenses, inter-segment revenue included in segment revenue, inter-segment expenses included in segment expenses. It excludes extraordinary items and also excludes tax expense. What is a segment asset? Operating assets that are directly attributable to the segments, but they exclude deferred tax asset. Tax expense excluded from segment expense, deferred tax asset excluded from your segment assets. Clear? This is the concept of revenues, segment assets, segment expenses, and finally segment result. Clear? So based on these definitions, you can apply these three materiality tests on the segments identified in step 2 based on the management information, and you identify which segment is material and report that segment under Ind AS 108. Clear? However, a few segments which do not satisfy the materiality test. It neither satisfied revenue test, neither satisfied result test, nor satisfied asset test, but can still be considered as reportable under two situations. Number 1, at the discretion of the management. Number 2, a segment which was identified as reportable segment in last year as a result of management discretion. Both are somewhere related to management discretion, I'll tell you. A management believes that this particular segment is of great importance. It is going to be of great importance in the coming future. But today, that segment is very small. So as such, that segment did not meet the criteria of materiality test, of result test, asset test or revenue test. But management is believing that this segment is of great importance, and tomorrow in future this will be the primarily one of the big segments. Then at the discretion of the management can identify a segment as reportable even if it does not satisfy any of the materiality tests. Remember, if a segment was identified as reportable due to discretion of the management in last year, in the previous year, the management by their discretion has selected a particular segment to be a reportable segment. Even in the current year, it will continue to be a reportable segment even if the management does not have the same intention about that segment in the current year. Last year, I thought this segment will be super good. Electric car segment on today, last year I thought it will be amazing. But as days progressed by, there is no government subsidy which is really announced on the electric cars, which can bring down the price of the electric cars. So last year I thought government will announce a subsidy, so I made sure by management discretion I selected the segment as reported. Current year corona crisis came in, already fiscal deficit has become so big, so I don't expect the government to allow any subsidy on electrical vehicles. It is no longer of that continued importance. But since you reported in the last year due to management discretion, you will continue to report it even in current year. These are the only two exceptions where a segment which was not satisfying the materiality test will also be reported under Ind AS 108. Management discretion. A segment can be identified as reportable at the discretion of the management, though it does not meet the materiality test if the management believes that the segment is of continuing importance for the future. Segments identified as reportable in the previous financial year at the discretion of the management, such this segment should continue to be reported in the current year even if the management does not believe that the segment is of continued importance. It is no longer of that importance, but I will still identify it as a reportable segment because you reported it last year due to management discretion. Last year it was reported due to materiality test. This year it is not meeting materiality test. I don't have to report it. Clear? Last year it was reported due to discretion of management. Current year I'll have to compulsory report it even though management does not apply the same discretion in current year. Clear? Aggregation of segments. Two or more segments which are not satisfying the materiality test can be aggregated and reported if they are economically similar or major aggregation criteria is satisfied. Two or more segments, they are small segments. They were not considered as reportable because they did not satisfy materiality test. But if they are economically similar in nature and if they meet the aggregation criteria, they are eligible to be combined and be reported as one single segment. What is this aggregation criteria? Aggregation criteria means if the products and services which are dealt by those segments are similar, they have a similar production process, they have a similar distribution cycle, they have a similar class of customers. In such cases, two or more segments, if they have similar goods and services, similar class of customers, similar production process or similar distribution cycle, they can be combined and reported if they don't individually meet the materiality test. Lastly, we come to the last test under Ind AS 109 to identify reportable segments called as overall test. What is an overall test? Overall test means the total segment revenue from segments identified as reportable. The total segment revenue from segments identified as reportable either as per materiality test or as per management discretion or management discretion of the previous year or by aggregation of segments. Out of the segments identified as reportable, if the total segment revenue from external customers, that means I'm particularly excluding inter-segment revenue, if it should be at least 75% of enterprise revenue. If it is less than 75% of the enterprise revenue, then you can include more segments. You can identify more segments as reportable, even though those segments did not satisfy materiality test. So that means what? A segment did not identify, was not satisfying materiality test, but out of the segments identified as reportable, if revenue from external customers is not 70 is less than 75% of the total enterprise revenue, then you can include even those segments which did not satisfy materiality test as reportable segments to meet the overall test. So how many ways? 1. Materiality test. 2. Aggregation of segments. 3. Management discretion. 4. Management discretion of previous year. 5. Overall test. In these 5 ways, I can identify segments as reportable. Sir, why did you apply materiality? I applied materiality because sometimes probably the management information which is circulated internally might be too vast, might be too elaborate. Such elaborate information I don't need. The user of financial statement says, why so much of information? Give material data, that is sufficient. Because I can't lead lengthy reports. Fine, sir. So are you telling me that out of all the operating segments in the enterprise, you will report only a few which satisfied materiality or as per discretion of the management or as per overall test? That means, are you trying to restrict the number of segments to be reported under Ind AS 108? No. There is no restriction on the number of segments to be reported as per Ind AS 108. However, if your total reportable segments exceed 10, more than 10 they are, then the management should assess reasonability of information presented. He is only asking you to assess. He never asked you to limit it. He's not saying 10 is the maximum limit. He's saying there's no limit. But if it exceeds 10, the management should assess whether it is reasonable to report so many segments or not. Clear? Yes, guys. Now, if I draw your attention to this reportable segments, then under AS 17, there was one single paragraph which defeated the entire purpose of AS 17. Where what he said in that paragraph of AS 17 was that if an enterprise has only one business segment and only one geographical segment, if you cannot identify various segments in an enterprise, that means the enterprise has only one business segment and one geographical segment, that segment information is not necessary to be reported. It defeated the purpose of the entire standard itself. Because many enterprises, by taking this exemption, have continued to give a statement saying that the enterprise has only one segment, one business segment and one geographical segment. Therefore, segment information need not be reported. Such paragraph is not available under Ind AS 108. Therefore, you cannot take the shield of that particular notification or such paragraph earlier which was there saying that I have only one geographical segment and one business segment. Segment information is no longer to be reported. That paragraph is missing in Ind AS 108. Therefore, higher emphasis on the paragraph because it will make sure that the companies will by force be required to present segment information under Ind AS 108. Clear? Now, since we have discussed all this, what is the fundamental concept? The standard particularly deals with disclosure. I've identified certain segments as reportable. Then what are the disclosures required to be presented for such segments? I'll have to give general information. What is the general information? What is the segment dealing with? What is the geographical location of that segment? What is the class of customers in that segment? What goods and products are being served in that segment? Segment information. What is the segment revenue? What are the expenses in that segment? What is the tax on that segment? Right? What is the finance cost in that segment? What is the net resulting profit or loss in the segment? What are the segment assets which are attributable to it? What are segment liabilities attributable to it? This is segment specific information provided. Finally, I will give a reconciliation. What does the reconciliation mean? Ultimately, sum of all segments is equal to P&L. Segment revenue from external customer, add everything, should be equal to the total revenue, enterprise revenue in P&L. But only few are identified as reportable. So let's say A, B, C, D, 4 reportable segments, few segments not identified as reportable. So what do? Segment revenue from external customer, A plus B plus C plus D, plus total of segments are not identified as reportable is equal to total enterprise revenue. Segment expenses, salaries attributable to segment A plus B plus C plus D, plus salaries of those segments which are not identified as reportable is equal to total salary in P&L. Like this, you will have to present segment information reconciliation for every item in your P&L and your segment information. And that will bring us to the end of discussion under Ind AS 108. So guys, good morning, and today's session we will be talking about consolidated financial statements where we look at multiple standards. So Ind AS 110 is the main standard which deals with consolidation, but apart from Ind AS 110, we have standards like Ind AS 27, 28, 111 and 112 which also have to be understood along with consolidation. So when I talk about consolidation, it is consolidation with a subsidiary, associate and a joint venture. All these three combined are called as group companies. They're called as group companies. So all these three group companies put together, what we discuss as one single chapter is called as consolidated financial statements. So my intention with this video is to basically bring you the concepts of consolidation all at one place. There is a basic nature of consolidation, steps involved in consolidation, exemptions from consolidation, adjustments to consolidation. So all these things I'm trying to bring it up in one place and I'm trying to discuss as a part of this chapter. Now, I will definitely be solving approximately about 20 to 21 questions as far as this chapter is concerned, and majority of them are the newly added problems as far as your ICAI new study material or the revised study material is concerned. But are these problems sufficient? Absolutely no. Guys, when we talk about consolidation comprehensive problems, where we'll be at least solving two problems on comprehensive nature, you need to understand about the time taken in solving those problems. Generally, the time taken, if you're solving it for the very first time, just understanding the concept, it could take something around 1 hour for you to complete the problem. But understand that 1 hour which you're taking to complete solving the problem will come down to at least 30 to 35 minutes if there is a repeated practice of multiple questions. Now, unfortunately, your study material has a very limited comprehensive questions. So you can always bank on your model test papers or revision test papers to find more comprehensive problems. There's one such problem which also appeared as a compulsory question in your Jan 2021 exam. So remember guys, all those people who are of an intention that I can leave this chapter as choice, last exam or your January 2021 exam, this question was a compulsory question. So therefore, all those people having an intention that I will take this a choice of this chapter, then it may not be possible in all situations. Yes, majority of the time you can take a choice, but here it is not possible. And one more thing why I discourage in taking a choice is consolidation is one such chapter where if you know the basic nature of consolidation, you can definitely score at least 60 to 70% of the marks allotted. So let's say I have a problem for 12 marks, I can definitely score about 8 marks even if I know the basic nature of consolidation. Now, I cannot give you any such assurance when you're writing other Ind AS related standards. Because let's say I make a small error in reading the question or interpreting the answer of that question, then automatically the entire marks which are allotted will be 0. That is the reason why consolidation is a safer bet. It's a very safe bet because as far as consolidation is concerned, apply your common sense. There are two balance sheets which are given to us. I am combining these two balance sheets. In combining these two balance sheets, what are the adjustments necessary is all that you need to understand. Clear? So we will go by the step-by-step approach in understanding consolidation. I'll give you examples that will help you understand consolidation. Approximately this could take about 4.5 hours of entire concepts relating to our consolidation and also solving the problems around this chapter. Clear? Now let's get into the concepts of consolidation first. Now, first thing, how did consolidation actually come into your picture? Guys, earlier, if you look at even the IGAP, which had AS 21, 23, and 27, and here today we have comparative standards of Ind AS 27, 28, 110, 111, and 112. You need to understand that none of these standards specify the application of the standard. None of these standards come up with applying the standard saying that these standards are applicable in these particular circumstances. He simply says whenever an enterprise intends to present financial statements on consolidated basis, then they need to apply these standards. That's all is what he said. So that means fundamentally the applicability of these standards is not governed by either IGAP or the Ind AS. So the applicability, if I was talking about prior to Companies Act 2013, where your IGAP was applicable, consolidation was only limited to SEBI listed enterprises, where as a part of listing agreement, you had to present a consolidated financial statements. Apart from those listed enterprises, we do not have consolidated financial statements applicable to any other sort of enterprise. But after the introduction of Companies Act 2013, we have observed that Section 123, 3 and 4 sections have been incorporated into the Companies Act, which require any company which has one or more subsidiaries to present financial statements on consolidated basis. So what happened? By transitioning from Companies Act 1956 to Companies Act 2013, the scope of consolidation has increased multifold. Why multifold? 1956, no consolidation as per Companies Act. So until then, consolidation was only limited to those companies which had their securities listed in any stock exchange. But once we came into Companies Act 2013, now he has removed that concept. He has inserted consolidation as a part of Companies Act itself. Therefore, any company, whether listed or unlisted, if it has one or more subsidiary, needs to perform consolidation and needs to present financial statements on consolidated basis. That increases the scope. Because earlier private limited companies, unlisted public enterprises, they were not coming under consolidation. But after the insertion of 129.3 and 4, you have consolidation applicable to any company which has one or more subsidiary. Therefore, the scope of the standard has definitely increased multifold. Ind AS 27 deals with separate set of financial statements. What do you mean by separate set of financial statements? That means a holding company which has one or more subsidiary is presenting financial statements only for the holding company without consolidation. That is called as separate set of financial statements. Number 2, your investments in associates and joint ventures, consolidation is prescribed as per a method called as equity method, which is prescribed under Ind AS 28. Ind AS 110, where we talk about consolidated financial statements with a subsidiary, which is a direct comparable standard to AS 21, prescribes something called as full consolidation method. Here, then comes joint arrangement, where we have joint controls and joint ventures. So joint controls and joint ventures have to be understood with respect to Ind AS 111. 112 is a pure disclosure standard. There's nothing much that we have to discuss as a part of Ind AS 112. So let's see what is the concepts of consolidation. I'm not going to name the standard. We're just going to go ahead with understanding what is consolidation with respect to multiple slides that we're going to come across. The first thing, understand, when do you call something as a subsidiary? Where an enterprise controls the other enterprise, then you can say that there is a holding subsidiary relationship which has actually existed. Now, when do you say control? The word control, when I use, I need to understand that the definition of control is distinct from Companies Act and Ind AS 110. What does Ind AS 110 define control as? What does your Companies Act define control as? Earlier under IGAP, your definition of control was the same for both Companies Act 1956 as well as AS 21. But however, after the introduction of Ind AS 110, the definition which was given under AS 23 has changed. Therefore, the Companies Act comes out with a different control definition, while your Ind AS 110 comes out with a complete different definition. Let's see what is a control definition then. According to your Companies Act 2013, Section 227, it says that an enterprise has a control over other enterprise if I have a right to control over the management and policy decisions by virtue of shareholding. By virtue of shareholding, I have a control over the management decisions and the policy decisions taken by the company. So that means what? By virtue of shareholding. That means my voting power in that particular enterprise is more than 50%. So since I have majority shareholding, I might be in a position where I could influence or I could control, I could dictate what are the management decisions and policy decisions taken by the enterprise. First one. Second one, where I have a right to appoint the majority of the board of directors. Now, it may be through voting power or it may be through an arrangement with the management where I get a right to appoint majority of the board of directors. Then in such situation, the enterprise is set to control the other enterprise. So what are the two types of control which are given under Companies Act 227 section? Number one, where by virtue of the shareholding, an enterprise can either control the management decisions or can control the policy decisions taken by the management. That means the voting power of the enterprise is at least 50% in the other enterprise. Number two, where by virtue of either the voting power or by virtue of another arrangement with the company, I have a right to appoint majority of the board of directors. Then I could have a control being demonstrated as far as the subsidiary is concerned. So these are the two parts which we also discuss under your AS 21 as well. AS 21 definition of control is also limited to only these 2 points. But Ind AS 110 has looked beyond this point. I'll tell you. Let's say, for example, a company like Reliance Industries. You know where Reliance conducts its AGM? It's in Wankhede Stadium because that is the number of shareholders he has. The number of shareholders he has at any point of time. The only place where he can conduct the AGM in Mumbai, which is his registered address or registered place of business, is only Wankhede Stadium. That is the number of people. I don't know how many of you remember this movie Guru, where he'll be Abhishek Bachchan is standing and waving to the crowd, and it's a Wankhede Stadium which is being covered. That is the size of AGM which is being conducted. That is the size of shareholding that it has. But let's say, for suppose, a management or a particular individual or another company controls only 35% of the total shares in Reliance. By virtue of voting power, it is not more than 50%, but I'm saying only 35% is the voting power that he controls. On a general tendency, when I observe the total shareholding of the people who are attending my AGM, it was only 60%. Only 60% of the voting power or 60% of the shares held, those shareholders are making it to the Wankhede Stadium. Because my other shareholders might be in different parts of the country, may not be making it to the AGM. And my AGM is also limited to a size of Wankhede Stadium. I cannot fill more than that. Therefore, in such kind of situations where I'm talking about, if only 60% of voting power is present at any AGM based on my past experience, if I hold 35%, that is sufficient enough to override the balance shareholders. The balance shareholders are less than 1% shareholders. So those people, I can definitely override my decisions because I myself hold 35% of the shareholding. Therefore, it is not necessary for someone to hold more than 50% of voting power to have a control over the investee or over the subsidiary. Clear? That is the first point which I wanted to drive. That's why the control definition required a change. The control definition required a change. I have 25% shareholding. Can I control? I can definitely control if the remaining 75% shareholding is in the hands of multiple shareholders and each one is not even holding 1% share capital. There can be demonstration of control even in such situations where I hold only 25% of voting power. Therefore, it is not necessary for someone to hold at least 50% of voting power to exercise control, because you need to understand that the remaining voting power is divided into small bits and pieces. So that's why Ind AS 110 demonstrates control in a different sense. He says three conditions are necessary to be satisfied to demonstrate control. First one, X Limited has a power over, the holding company has a power over the investee. What do you mean by power over the investee? A power to influence the decisions made by the investee, a power to control the investee, a power to direct the investee to perform certain functions. That is first one, called as a power over the investee. Now, it is exposed to variable returns. What do you mean by variable returns over the investee? I am exposed to variable returns means I am deriving returns in the form of dividends. Dividends are variable. 10% debenture, the rate of return which I expect from the person who is holding this debenture is basically to get 10% as a return. It's a fixed return. There's no variable return out there. But if I hold equity shares, I might get dividend at the rate of 20% in 1 year. I might get dividend at the rate of 60% in 1 year. I might not get dividend in one particular year as well. So therefore, one has to understand that whenever there is a control, that person who is actually exercising the control or the investor is exposed to variable returns from the investee. Number 3, the investee or the parent enterprise has a ability to use its power to influence or to affect the returns from the investee. I have a power to influence the returns or to affect the returns from which are expected to be received from the investee. That means if the decision making regarding activities, decision making regarding payment of dividend, if I can direct, if I have an ability to basically have a control over such kind of power, then I can say that it is a subsidiary. All three conditions are necessary to be satisfied. Number 1, there is a power over the investee, they're exposed to variable returns, and they have an ability to use the power to influence or affect the returns of the returns which are expected from the investee. Clear? So this is fundamentally what is control. But if you look at Companies Act 2013, is giving you two types of control, where I have, by virtue of voting power, a control over management decisions, or I have a right to appoint majority of the board of directors. Both are separated by or. Ind AS 110 definition, control is separated by and. That means all three conditions are necessary to be satisfied. Here, any of the two conditions are necessary to be satisfied. If I go as per Companies Act, each subsidiary can have, I'm not saying will have, I'm saying can have, two holding companies. One by virtue of shareholding, one by virtue of their agreement or arrangement to appoint the majority of board of directors. So that is the reason why we say that control as such has taken a significant change under Ind AS 110, because according to Ind AS 110, where all three conditions are necessary to be satisfied, there can only be one holding company for a subsidiary. You cannot have multiple holding companies. Clear? So what is control under 110? Control is established when the investor has power over the investee. He is exposed to variable returns from the investee. Number 3, he has an ability to use the power over the investee to influence or to affect the investor returns. If these three conditions together are satisfied, then the investor has a control over the investee. That is where the holding subsidiary relationship exists. Clear? Now, question very smartly will be asked, which one should I comply with? I'll have to comply with both the definitions. If I comply with one definition that is not sufficient, I should be in a position to comply with both the definitions. Both together have to be assessed in directing whether there is a control or not. What is the exemption from consolidation? Guys, if you look at your accounting standard AS21, he has provided a particular exemption saying that if the investments held in the subsidiary are of a nature that the parent enterprise expects to sell these investments and realize a short-term gain. That means at the time of acquiring the control itself, I had an intention to dispose of the investments, or I have an intention to sell the investments at any near future point of time. Near future means less than 12 months. Then in such cases, consolidation is not necessary. Consolidation is not necessary in such situation. But when it comes to exemptions under Ind AS 110, he gave a different view of exemption itself. Let's see what he's talking about. Let's say X controls Y. Y controls Z. X is called as the ultimate parent enterprise. Y is called as intermediary parent enterprise. And Z is anyways a subsidiary. Now the exemption from consolidation is not given to X. It is given to Y, which is an intermediary parent. Question will be why? Because sir, when consolidation occurs or consolidation is supposed to happen on the financial statements day, X is anyways consolidating with both Y and Z. So why should Y enterprise again consolidate? That is the point that he is trying to drive. So he's saying Y is eligible to claim an exemption from consolidation. When can he claim exemption from consolidation? Number one, Y is also a subsidiary of another parent enterprise. Okay, Y is also a subsidiary of another parent enterprise. Number two, neither equity instrument nor debt instrument of Y Limited are listed or traded in public market. They are neither listed nor traded in public market. Number two, Y Limited is not in the process of filing any statements with the SEBI for the purpose of listing any class of instruments. That means I'm not even in the process of listing. Y is not in the process of listing. I have not submitted any financial statements or any other necessary documents to SEBI or the Securities Board for listing of any class of my instruments, be it debt or equity. Finally, the ultimate parent has provided financial statements on consolidated basis. So when the final ultimate parent company is anyways consolidating, the intermediary subsidiary or intermediary parent enterprise is exempted from consolidation. But remember, to exercise this exemption, I also need to take the approval of the other shareholders in Y Limited. X holds 80% shares in Y. The other 20% is held by minority shareholders. Those minority shareholders also should be given an approval to give an exemption for Y Limited to exempt from consolidation. So what are the necessary conditions to be satisfied? I'm putting 4 conditions. Broadly, I'll classify it as 3. Number 1, the intermediary parent enterprise is also a subsidiary of the ultimate parent enterprise. So that means this parent enterprise is a subsidiary of another enterprise. In this case, Y was a subsidiary of X Limited. Number 2, no class of its instruments, be it equity or debt, were listed in the stock market or traded in public markets. Along with that, I'll also give you one more point even clubbed into the second one. The Y Limited, which is the parent, has not filed any necessary documentation with the Securities Board of India for listing any of its class of securities. So neither the securities are listed nor in the process of listing. That is second exemption. Third one, the ultimate parent enterprise, in this case that is the X Limited, which is the ultimate parent, is providing financial statements on consolidated basis. In such cases, with the approval of all the shareholders of intermediary parent, Y Limited can claim exemption from consolidation. There are certain illustrations that will look into this, so be very careful. Your control definition, which we have just seen now, power over the investor has a power over the investee, exposed to variable returns, has an ability to use its power over the investee to influence the investor returns. These are the 3 points, and these are exemptions. So certain cases where the intermediary parent enterprise, in this case the Y Limited, is exempt from consolidation or is eligible to claim an exemption from consolidation, both these points have been tested, or a new illustrations have come in as far as your study material is concerned, which is going around the similar paragraphs what we have just discussed now. Clear? Now, what is your procedures of consolidation? Now, I will talk about steps of consolidation separately, but I am here only talking about the procedures which are involved in consolidation. In logical sense, I am giving you 2 balance sheets, and both these balance sheets have to be combined. In combining these balance sheets, what are you supposed to do? I can combine assets, I can combine liabilities, I can combine incomes, I can combine cash flows, I can combine expenses. I can combine my assets, liabilities, incomes, expenses, cash flows. But while you are combining these, the intergroup transactions should be eliminated. Intergroup transactions means if the subsidiary is showing the holding company as a debtor, the holding company is showing the subsidiary as a creditor, then these two are supposed to be cancelled. They have to be eliminated. A bill has been given to the subsidiary by the holding company. Holding company shows it as bills payable. Subsidiary company shows it as bills receivable. When I combine assets and liabilities, these holding and subsidiaries, these bills receivable and bills payable are supposed to be eliminated. One more thing which is compulsory to eliminate is the investments held by the holding company in the subsidiary. Because without investment, you cannot have holding subsidiary relationship. Therefore, the holding company in its balance sheet has been writing the investments in subsidiary on the asset side. This investment in subsidiary should not be represented after consolidation. How do I eliminate it? We'll discuss it. Relax for now. New situations arise. At the time of eliminating this investment in subsidiary, it gives rise to something called as goodwill or bargain purchase as per Ind AS 103. 103 is about business combination. So why is it 103 coming into picture? We'll talk about it. But I'm saying when I eliminate this investment in subsidiary, which we just discussed, it gives rise to another event or another item in the consolidated balance sheet called as goodwill or bargain purchase. Another item which arises during consolidation is called as non-controlling interest. So these two happen to be the new things that we have to discover and how to calculate as a part of consolidation. Because combining is what? Simple addition. Elimination means at the time you add, you might deduct this. But new 2 situations are coming up: non-controlling interest and goodwill or bargain purchase arising at the time of eliminating your investment in group companies. These 2 situations have to be discussed on how do we compute these. Here, what is non-controlling interest? Non-controlling interest or minority interest, it is nothing but to the extent, let's say X holds in Y 70% holding. If X holds in Y 70% holding, then X is a parent enterprise, Y is a subsidiary, compulsory because there is a control by virtue of voting power. But if 70% is held by X in Y, the balance 30% shares in Y are held by someone else. Who are these someone else? There could be multiple shareholders or there could be only one single shareholder. But this person who holds only 30% is not in a position to control Y Limited. If X has a control over Y Limited, the other shareholders holding 30% shares cannot exercise control over Y Limited. Therefore, X is called as a controlling party and these people are called as minorities. They're called as minorities. These minority shareholders should be represented in the consolidated balance sheet with a name called as non-controlling interest. If X has controlling interest, then these minority interests have an interest in Y Limited, but they are called as non-controlling in nature. So I call them as NCI, non-controlling interest. This word non-controlling interest has occurred new in Ind AS 110. Earlier, under AS 21, These non-controlling interests were called as minority interest. Clear? They were earlier called as minority interest. So what is NCI? NCI represents other than parent enterprise's share in the equity of the subsidiary. Other than parent entity's share in the equity of the subsidiary. Now, what do you mean by equity? Equity means share capital along with reserves. So, in this example, if I talk about, I'll simply say that the minority interest or NCI, non-controlling interest, is equal to 30% of share capital plus reserves of the subsidiary. Clear? Or you can also say equity as assets minus outside liabilities. So, in such situation, I can say NCI is equal to 30% of the total net assets in Y Limited. This way also you can represent. So whatever it is, whatever way you represent, it depends on question to question. I can simply say NCI represents other than holding companies or other than parent enterprises share in the equity of the subsidiary. So equity means share capital plus reserves or assets minus outside liabilities called as net assets. Whatever is your equity, if I calculate what is the minority share of those equity, that should be considered as NCI, which should arise at the time of consolidated financial statements. It should arise at the time of consolidated financial statements. Clear? Your NCI, which is non-controlling interest, can be measured in two ways. One is called as fair value method. Other one is called as proportionate share method. What is fair value method? Fair value method is nothing but fair value of the subsidiary multiplied by minority holding. I calculate what is the total fair value of the subsidiary or what is the fair value per share in the subsidiary, and I will multiply it with the minority shareholding. If you calculate the total fair value of the subsidiary, then I will multiply it with minority shareholding as a percentage. If I calculate fair value per share in the subsidiary, then I will multiply it with number of shares held by minority shareholders. In that way, I can get non-controlling interest under fair value method. Then what is proportionate share method? This is a common procedure that we follow, and this was the procedure which was earlier laid down even under AS21. AS21 did not have fair value method. It is Ind AS 110 which introduced the fair value method to us, but otherwise NCI or minority interest was earlier calculated under proportionate share method. What is proportionate share method? Calculate the total net assets of the subsidiary. Net assets you can calculate by assets minus outside liabilities or share capital plus reserves. Whatever it is, that is the equity of the subsidiary multiplied by minority shareholding. That will give you NCI or minority interest by proportionate share method. Clear? Now, where should NCI be represented in consolidated financial statements? NCI should be represented along with the liabilities and equity. And where under liabilities and equity? Within equity itself, but should be separate from share capital and other equity. Therefore, in generally, whenever I talk about shareholder funds, I generally have only two line items: share capital, other equity. But upon consolidation, I'll get three line items: share capital, other equity, non-controlling interest. Clear? Now, preference shareholding, preference share capital which of the subsidiary, to an extent, it is not held by the holding company. Preference share capital, to the extent it is not held by the holding company, should be included in the computation of NCI. Let me see what this is. Let's say there are two enterprises, X and Y. X is the parent enterprise. Y obviously is my subsidiary. X holds, let's say, 80% of voting power in subsidiary. That means the balance 20% voting power in the subsidiary is held by someone called as minority or non-controlling interest. Guys, like I told you, voting power is derived from equity shares. But what if in Y Limited there are some preference share capital? Let's say my preference share capital in Y Limited is equal to 100. Is it necessary that the holding company should hold even the preference shares as well? Not necessary. Therefore, what happened was this preference share capital was held by X to a certain extent and the balance to a certain extent. Let's say X only is holding 20 rupees of preference share capital, only 20. Therefore, the balance is 80. Correct? To the extent of 20, I will consider in computation of cost of control. What is this cost of control? I'll tell you later. We haven't come to that concept of cost of control yet, but cost of control is computed as per Ind AS 103. It is computed as per Ind AS 103. This balance 80, which is not held by the holding company, this one should be added to NCI. This should be added to non-controlling interest. This is exactly what we are talking about. So what did I say? I said preference share capital, to an extent it is not held by the holding company, should be included or should be added to your computation of non-controlling interest. That is what my second line says. Preference share capital in the subsidiary, to the extent not held by the parent enterprise, should be included in the computation of non-controlling interest. Clear? Now, can NCI be a negative figure? Again, a very good question I'm asking. Can NCI be a negative amount? Is it possible? Yes, it is possible. NCI is what? NCI is equal to minority holding as a percentage multiplied by the net assets or equity of subsidiary. Net assets or equity of subsidiary. Correct? Can NCI be negative? Yes, it can be negative. Why does it become negative? If your net assets in the subsidiary are negative, then even your NCI can be negative. Absolutely right. Then question comes up, why is the net assets of subsidiary negative? That means the losses accumulated in the subsidiary are greater than the share capital in the subsidiary. Losses accumulated in the subsidiary are greater than the share capital of the subsidiary, then you do come across a situation where NCI is a negative figure. NCI positive, liability side under shareholder funds I represent. NCI negative, should I represent it on the asset side? No. It should still be continued to be reported as a negative amount as far as your share capital is concerned. Sorry, as far as your shareholding funds is concerned. Clear? So what am I saying? NCI can definitely be a negative amount, and such negative amount should be presented in under shareholder funds itself. So NCI may represent negative figure if subsidiary incurs losses which are accumulated in such a way that they exceed the paid up share capital of the company. And with that, we come to the end of discussion on NCI, though I did not completely come across the computation of NCI. But let's move into this concept of cost of control. What is this cost of control and why does this arise? Let me help you with an example. Let's say I have an enterprise X, I have an enterprise Y. X has acquired 70% of voting power in Y. This 70% was acquired on, let's say it is on 28th of March 2021. 28th March 2021, X has acquired 70% of voting power in Y. The date on which an entity acquires a control over the other entity, on that date, this transaction is called as business combination. So on this date, I will call this as business combination. Business combination arises when an enterprise has acquired controlling interest over the other enterprise. And business combination has to be dealt as per India's. So what am I saying? On the day on which X exercises the control or X acquires control over Y, on that day, you will have to apply Ind AS 103 business combination. According to the standard of Ind AS 103, on the date of acquisition, with respect to date of acquisition, I have to calculate something called as cost of control. What is cost of control? Cost of control which is identified with respect to date of acquisition by applying Ind AS 103 is to identify, that is to determine determination of goodwill or bargain purchase. How to calculate this goodwill or bargain purchase? That is your cost of control. Let's see. For control, cost of control in determination of goodwill or bargain purchase, it should be computed with respect to the date of acquisition of control in subsidiary. On that date of acquisition, I'll apply Ind AS 103, right? So let's say for suppose this was Y Limited's financials on 28th of March. Okay. Let's say, for example, my total assets are 200 on the date. My share capital or equity share capital was about 50. My reserves and surplus was about 80. And my other liabilities were the balancing. Oh, no, I don't think so. It is 70. Yeah, it is 70. So this is how I conclude. On this day, X Limited acquired interest in Y Limited. X cost of acquisition of 70% in Y is, let's say, about 150. Then my cost of acquisition of interest in Y Limited is 150. Now, by paying 150 rupees, what did I acquire? By paying 150, X acquired 70% of equity of Y, 70% of net assets of Y. So calculate your net assets of Y. Net assets of Y on 28th of March 2001. Either liabilities or add share capital and reserves. Answer is 130. Answer is 130 on that date. But how much did X acquire? 70%. So what is X's share? X share in net assets of Y. Net assets of Y. 70% calculate of this. 70% is how much? 91. 91 is the net assets acquired by X. Right? X has acquired 91 rupees of net assets in Y. What is the cost of acquisition? The cost of this acquisition of 70% in Y was 150. Therefore, to buy 91 rupees of an asset, 91 rupees of net assets you acquired, but you paid 150. Therefore, the difference should be determined as goodwill. Since my cost of acquisition is greater, then I will determine a goodwill of 59 rupees. The difference should be considered as goodwill. And this is called as cost of control. So what is cost of control? Cost of control is determined on the day on which the parent enterprise acquires controlling interest in the subsidiary. On that day, I will compare two things. Cost of acquisition compared with the holding companies or parent enterprises share in the net assets of the subsidiary. Comparing these two, I determine either goodwill, or sometimes if my net assets are greater than cost of acquisition, then I'll call it as bargain purchase. Clear? This is acquired with respect to the date of acquisition. So that is the date on which Ind AS 103 shall apply. Clear? Now, however, while computing the same 59, let me have a different idea also. I will calculate in a different way. I'll still have to get down to that 59 number only. Let's say I write it like this. Cost of acquisition by X in Y. X acquired in Y, 70%. At what cost? At a cost of 150. This is 70%. What is the other 30%? The other 30% is the net assets which belong to minority interest or non-controlling interest. On 28th of March. How do you calculate NCI on that date? Calculate 30% multiplied by total net assets are, how much was the total net assets? 130. So what is your answer? NCI on that date total is only 39. 70 plus 30, that is total 100%. Total value of 100% is 189. I will compare this 189 with the total net assets in the subsidiary compared with net assets in Y Limited. On 28th of March 2021, entire 100% net assets should be compared with entire 100% share capital. What is the 100% of net assets? The 100% of net assets is 130. Compare these two, what is the answer? Again, back to the same answer, 59. The same answer that we ascertained above. 59 was goodwill there, even 59 is goodwill here. But your Ind AS 103 has prescribed this type of measurement and not this measurement. So this is not an appropriate measurement. You cannot calculate in this manner. Your computation should go like this. Cost of acquisition plus NCI should be compared with the net assets in the subsidiary on the date of acquisition. Guys, when you're calculating only on the date of acquisition, it is not going to change subsequently. Let's say the acquisition of control happened on 28 March 2021. When I'm consolidating in 2022, when I consolidated in 2023, when I consolidated even in 2100 also, my amount of goodwill will still stay 59 because I'm only calculating with respect to my date of acquisition. Your date of acquisition never changes. Therefore, even your goodwill or bargain purchase never changes. Never changes. Clear? Guys, if you remember, NCI can be calculated in two methods. This is one method which is called as proportionate share method. This is called as proportionate share method. But there was also one more method that we have just seen. We said Ind AS 110 gives you a choice to either go as per proportionate share method, which was there even under Ind AS 21, or you can even measure it under fair value method. So let's say NCI had to be measured at fair value and not at proportionate share. Then what do? I'll have to calculate NCI at fair value. Calculate. Cost of acquisition by X in Y. On 28th of March 2021, what is his cost? 150. Correct? I am measuring NCI at fair value on the same date of acquisition, 28 March 2021. So instead of taking proportionate share, I am measuring it at fair value. How do I identify fair value? Very simple. This is for 70%. So what is 30%? Calculate into 3 by 7. I think you will get some random number. 150, because it's not divisible by 7. 150 divided by 7 into 3. 64.28 or 29, I think. 64.29. In such case, this is 214.29. If I compare this with net assets in Y on the date of acquisition, 28th of March 2021, what was the net assets on the date? Net asset was 130. So this time I came across a goodwill which is 84.29. Observe earlier when I represented goodwill in the previous method, I calculated goodwill as only 59. But now when I measure NCI at fair value, automatically my goodwill jumped to 84.29. Yes or no? Here the goodwill was 59. Correct? The goodwill of 59 rupees if the NCI is measured under proportionate share method. But if you are calculating goodwill as per fair value method, it is 84.29. I'll tell you what. Here when I got NCI goodwill as 59 as against 84.29, this 59 is considered to be goodwill which pertains only to goodwill in Y, only to X. But this 84, this goodwill in Y to both X and or NCI. Therefore, this is called as full goodwill. This is called as parent goodwill or proportionate share of parent's goodwill. You know what? I can calculate it even without all that. If I know that the proportionate goodwill is 59 rupees which belongs to the parent is only holding 70%. What is the full goodwill? 59 into 100 by 70. You should get the same answer. You will get the same answer, 84.29. This is exactly right. So 59 is only the parent's portion of goodwill, while the total goodwill, full goodwill, which pertains to both X as well as non-controlling interest, is 84.29. So this is exactly what we are discussing. as far as the cost of control is concerned, and I say I calculate cost of control with respect to the standard Ind AS 103. When do you calculate? On the day on which the parent enterprise has acquired controlling interest in the subsidiary. Only on that particular day, I will calculate your cost of control. Clear? Look at the formulation. Cost of investment in subsidiary plus non-controlling interest on date of acquisition compared with the fair value of net assets in subsidiary on date of acquisition is resulting in either goodwill or bargain purchase. If A plus B, that is cost of investment and your non-controlling interest, was greater than fair value, then fair value of net assets, it results in goodwill. Exact the other way around, it results in bargain purchase. Clear? If NCI is measured at proportionate share method, goodwill arrived at in cost of control is parent portion of goodwill. This is what I told you towards the end. If NCI is measured at fair value, then the goodwill arrived at is called as full goodwill or fair value of goodwill. This is exactly what I was talking about. If you just remember, this is how I calculated the difference between 59 and 84 point whatever it is. Right? 59 was only parent's portion of goodwill. That 84 is basically full goodwill or the fair value of goodwill. Is Fakhruddin for you? All those who want to take down, please take down. Just an example, guys. Random numbers, whatever I got in my head, that's why I get a points. If I would have actually planned the example, then there wouldn't have been those points. So the question comes up, are we done with computation of cost of control? Answer is no. Because is it compulsory for a parent enterprise to acquire controlling interest in the subsidiary in one single transaction itself? No. Sometimes it can happen where the parent enterprise X Limited has acquired in Y Limited first about 40%, which was not controlling interest. In the subsequent transaction, he acquired another 20%. So the total total interest in the subsidiary, which was earlier 40, on acquisition of 20 has become 60, which is the date on which the controlling interest is acquired. So if I want to determine what is the cost of control, then my determination should be based on the second date when he acquired 20%. That is the date on which he has acquired controlling interest over the subsidiary. First acquisition of 40% is not controlling interest. So the acquisition of controlling interest in the subsidiary should be computed. Your cost of control should be computed with respect to the second date when he has acquired 20%. Clear? In such situation, how do I go about the computation? Very simple. Again, let's see some examples out there. Again, a random example. Don't expect me to have round numbers out there. There was a company X and there's a company Y. X acquired interest in Y to the extent of 40% at 100 rupees on, let's say, give me a date, let's say 28th of March 2021. Controlling interest was not acquired on that date because it is only 40% interest. Subsequently, in Y, they have acquired another 20% of voting power by paying, let's say, 75 rupees on 15th of August 2021. So the total controlling interest has become 60%. But remember, what is your date of control? The date of control is this date on 15th of August 2021. On this day, control in Y is acquired. Therefore, my cost of control computation should be based on 15th of August itself. Cost of control as per Ind AS 103. Should be computed based on 15th of August 2021. On that day, I determine either a goodwill or bargain purchase. Let's see how do I calculate here. What is my cost of acquisition on that date? My cost of acquisition on 15th of August 2021, where I acquired how much? 20% shareholding is how much? I purchased it at a cost of, I've already given you, 75. Okay. Part B. No NCI because another 40% was already acquired. That 40% which I acquired, I'll have to now measure it at fair value. Fair value of investments in Y already held by X. How much investments already held by X in Y? 40%. How do I calculate the fair value of the investment? Guys, if 20% is 75, 40% is how much? 75 into 40 divided by 20. Therefore, proportion fair value is 40. But the total is only 60%. That means the balance 40% is held by NCI. Let's say, for example, in this case, I am saying that the net in Y on 28th March is 130, like we have seen in the previous example. On 15th August, so what is your cost of control calculated based on 15th of August? Therefore, when I calculate NCI on 15th of August, I can either take fair value or I can either calculate based on proportionate share method. Let's say I'm taking proportionate share method. I'll tell you how to calculate even fair value as well. Proportionate share method, 200 is the net assets in Y Limited. Their shareholding, NCI shareholding is 40%. It is 40% because 60% is held by holding company. So 40% NCI share on 15th August is how much? 80. Calculate the total. 75 plus 50, 225. 225 plus 80 is 305. I will compare this with Part D, net assets on 15th August. The entire net assets on 15th August was 200. Therefore, this results in 105 resultant as goodwill. Guys, this is parent goodwill. It's not goodwill. If I have to get full goodwill, then what do? I'll have to measure NCI at its fair value. Guys, if 40% is 150, then 40% investment is 150, then even this 40% investment could also be 150. Correct? In that case, this total will not be 305. It will be 150 plus 150 plus 75. This instead of 305 would become 375. In such case, this goodwill will not be 105, but instead it will be 175. So 105 is the parent's share of goodwill, while 175 is the full goodwill of the entire enterprise or the fair value of goodwill. But remember, my earlier investment of 40%, I purchased it at what price? I purchased it at 100. But today, on the day when you acquired controlling interest on 15th of August, I measured that investment as how much? 150. So that means 100 rupees of investment in Y Limited has been restated to 150. Correct? My cost of investment by on 28th of March 2021 was 100. This I have restated fair value. When you restate the fair value on the date of acquiring controlling interest, restated fair value of investment on 15th August 2021 On that day, I have restated it to a value of 150. Therefore, the value of your investment in Y Limited has increased by 50. This increase in the value of investment in Y Limited already held by X prior to acquisition of controlling interest should be transferred to fair value reserve. Transferred to fair value reserve. This fair value reserve should be transferred, should get under other equity. It should be presented as a part of other equity in my balance sheet. So what am I doing? I'm recording an entry as cost of investment in Y Limited by 50 rupees increase to fair value reserve 50. So automatically my cost of investment of 100 has now increased by 50 and became 150 on the date of 15th of August. On that day, I calculated my cost of control where I restated the previous investment to fair value and I identified proportionate goodwill as 105 or full goodwill as 175 depending on how you have measured your NCI. You can either measure NCI at carrying value or proportionate share method, that is 80, or you could have measured it at fair value of 150 depending on which the value of your goodwill would have been 105 or 175. Clear? So this is the additional adjustment necessary whenever I have multiple dates of acquisition in subsidiary. So what do? Whenever I have multiple investment dates, then I'll have to first identify what is the date on which controlling interest was acquired. Once I've identified controlling interest, then once I've identified the date on which controlling interest was acquired, then for calculating cost of control, I will restate all the investments already held in subsidiary by the holding company will be restated to their fair value. The difference between the cost and the difference between the fair value on the date of acquisition will be transferred to another reserve called as fair value reserve. Let's look at this. Whenever I have multiple dates of acquisition, the cost of acquisition on the date of acquiring controlling interest plus the fair value of investment in subsidiary already held by parent enterprise plus NCI on date of acquisition of controlling in the subsidiary should be compared with the net assets of the subsidiary on date of acquisition to result in either goodwill or bargain purchase. Now the fair value of investment in subsidiary already held by parent when compared with the cost of investment should be transferred to fair value reserve, which is classified as a part of other equity. This is my discussion on multiple dates of acquisition in a subsidiary by the parent enterprise. Now, since we have looked at already your computation of NCI and computation of cost of control in various situations, we've taken some examples to determine this. Now let's get into the concept of consolidation, which has certain adjustments. Now, what adjustments am I talking about? Now, sometimes it happens to be a situation where you have two different dates of a subsidiary and balance sheet, a subsidiary's balance sheet and holding company's balance sheet. Let's say the balance sheet date of holding company is on 31st of March. Let's say the balance sheet of subsidiary is on 31st of December. In such case, can I consolidate? Is it necessary for me to redraft the subsidiary's balance sheet to meet the balance sheet date of holding company? That is the question. So let's try to understand this. Let's say, for example, my parent enterprise X balance sheet date is 31st of March every year. My parent enterprise, my subsidiary Y, has a balance sheet date of 31st December every year. Then can I consolidate? Answer is yes. As long as the difference between these two balance sheet dates, difference is within 3 months. If the difference between two balance sheet dates is within 3 months, that is materiality he is talking about, guys. 3 months is purely materiality. So over 3 months, I don't expect the subsidiary to change so much. That is the reason why he is saying you don't have to redraft the balance sheet of subsidiary Y since the difference between two balance sheet dates within 3 months. So you can directly consolidate with the subsidiary, notwithstanding the difference in the reporting dates. But what if I come across a similar situation, but X has a balance sheet date of 31st March. Okay. But let's say Y, which is a subsidiary, is drafting its balance sheet date on 30th of September. Then in such cases, the difference between the two reporting dates is greater than 3 months. Since it is greater than 3 months, no consolidation is possible. Therefore, to facilitate consolidation, what you do is you will take this subsidiary and redraft. I will redraft the balance sheet on 31st March to comply with the balance sheet date of holding company only if you have different reporting dates and the difference between the reporting dates is greater than 3 months. This is a new incorporation under Ind AS 110. Remember guys, earlier under AS 21, he said 6 months. It has been cut short to 3 months to make the balance sheet dates more relevant. Guys, in practical sense, can I have a situation like this? Yes, but remember, most of the auditors will require the subsidiary to redraft the balance sheet date to confirm with the holding enterprise. So that is the most common situation which occurs. So we are talking about different reporting dates. Financial statements of holding and subsidiary are eligible to consolidate, notwithstanding the difference in reporting dates if they are separated by not more than 3 months. However, if the difference is more than 3 months between the reporting dates, then the financial statements of the subsidiary should be redrafted on the reporting date of the parent enterprise to facilitate consolidation. Clear? So this is our concept regarding different reporting dates. Now let's talk about different accounting policies. Let's say the subsidiary and the holding have different accounting policies. Is it absolutely fine to have different accounting policies, or is it necessary for the subsidiary to follow the same accounting policies as the parent enterprise? Answer is no. So that means a subsidiary can have a different set of accounting policies from the holding company's accounting policies. Let's say the holding company's accounting policy of evaluation of your inventory is as per weighted average cost basis, but the subsidiary is valuing its inventory on FIFO basis. Your assets in subsidiary are valued as per revaluation method. The assets as per your holding company is valued under cost approach. Different set of accounting policies are being adopted. In such cases, you cannot consolidate. But can they follow like that? Yes, but consolidation is not possible. So therefore, to facilitate consolidation, the subsidiary's financial statement should be redrafted to conform with the accounting policies of the holding company or the parent enterprise. That is only for the purpose of facilitating consolidation. You are redrafting it. Your financial statements of subsidiary will still follow its own set of accounting policies, need not conform with parent enterprise. But just to facilitate consolidation, on the date of drafting financial statements on consolidated basis, I'll redraft the subsidiary. Guys, it is reworking again. So generally, it is a concept of the company to follow same set of accounting policies so that it will be easier for them to actually consolidate. Guys, whenever I redraft the financial statements of the subsidiary to conform with the accounting policies of parent enterprise, the difference which arises in redrafting should be transferred to other equity. Clear? So whenever I redraft subsidiaries financial statements, the difference which arises, I will park it into other equity of the subsidiary. Now what about dividend from subsidiary? Any dividend income which is received from subsidiary, how do I account for this dividend income? Remember guys, dividend income should be recognized by any person. By any person, dividend, if I hold investments in another company and I have to recognize dividend income, then I recognize dividend income only when I have a right to receive the dividend. Only when right to receive dividend is established. Same concept even applies to holding subsidiary also. So the holding company is entitled to receive dividend from subsidiary. So the holding company will recognize dividend as income, dividend income from the subsidiary only when the right to receive dividend is established. When do you say that the right to receive dividend is established? I will say that the right to receive dividend is established when a valid resolution of for payment of dividend is passed in the AGM of the subsidiary. In the AGM of the subsidiary, if a valid resolution has been passed, then in such situations, you can say that the right to receive dividend has been established. Clear? Now, before I move further into this concept, I'll have to bring out another concept for you for treatment of subsidiary. What is the other concept? I'll tell you. In the books of holding company, in the books of holding or enterprise, we have investments in subsidiary, correct? This investment in subsidiary is held as asset. Is held as an asset. This asset of investment can be valued on two bases. They can either be valued on cost or valued at fair value. Valued at cost or they can be valued at fair value. If I'm measuring it at cost, then that means I'm complying with the standard Ind AS 27. But if I'm valuing it at fair value, then I'm adopting Ind AS 109 of investment. Either way is absolutely fine. It is 100% at the option of the holding company. Either of these two is fine. It is at the option of the holding company. But however you measure it, it is going to determine your recognition of dividend income. I'll tell you. As far as your recognition at fair value is concerned, if the investment is measured at fair value, then dividend income from subsidiary should be transferred to P&L. Dividend income from the subsidiary should be transferred to P&L. Easy. When you value it at cost, then I can have multiple treatments. In this case, your dividend income from subsidiary, dividend income from subsidiary should be identified in two ways. If I'm measuring the cost, in such cases, I will divide the dividend income from subsidiary into two ways. One is called as return on investment, and the other one is called as return of investment. Return of investment. If it is categorized as return on investment, then I have to transfer to P&L. In such case, I transfer to P&L. In case it is categorized as return on investment, then I'll have to transfer it to cost of investment. I have to use the cost of investment. If you understood nothing in this, I'll repeat again and I'll help you with the example. I'm saying in the books of a parent enterprise, the investment in subsidiary can either be measured at cost or can be measured at fair value. If I'm measuring it at cost, then I'm adopting the standard Ind AS 27 separate set of financial statements. But if I'm measuring it at fair value, then it is common for all enterprises. I am adopting Ind AS 109. If I adopt Ind AS 109 and I receive any dividend income from subsidiary, straightforward I'll put it off to P&L. No discussion any longer. But when I am carrying investment at cost, applying Ind AS 27, then the dividend income of subsidiary should be identified as return of investment or return on investment. If it is classified as return on investment, then I will again transfer it to P&L. But if it is categorized as return of investment, then I'll have to transfer it to cost of investment. What is this concept? What is this return of investment? This concept of return of investment is called as pre-acquisition dividend. This is called as pre-acquisition dividend. In such cases, normally I would have passed the entry. Bank account debit to dividend income. Correct? This dividend income should be transferred to P&L. But if it is return of investment, then instead of transferring it to dividend income, I have to transfer it to cost of investment. So to investment in subsidiary. I'll have to credit either of them depending on the situation. Now help me with an example on what I just said. I'll tell. Let's say for suppose the financial year is starting on 1st April 2020, ending on 30 March 2020. The dividend regarding this was paid on 30th of September. Okay, this is my dividend payment date. Let's say I purchased investment here 30th June 2021. I purchased investment in subsidiary. In such case, I purchased understand I am entitled to receive the dividend on 30th September because as on the book closure day, I am receiving the dividend. As on book closure day, I am the shareholder, I will receive dividend. But which year dividend is this? This is the dividend for the year 2022. Does it hold shares on the date? No. Therefore, in this case, the cost of shares which you acquired, cost of subsidiary should be considered as come dividend price. Come dividend price. Is called as dividend price. So whenever I receive the dividend, I will have to make sure that the investments go back to X dividend price. So what do? This cost of investment, I will reduce it less dividend income or dividend from subsidiary is for the year 2021. And finally, I will get X dividend price. X dividend price. Clear? Only in situation when you acquire the shares of the subsidiary after the book closure date, after your balance sheet date, but before the date on which the dividend is paid. Only in such situation, I will identify that these shares are come dividend in price. They are come dividend in value. Therefore, in such situations only, I will have to make sure that the dividend received from subsidiary is treated as a return of investment, and I'll have to reduce it from the cost of investment to make it an X dividend price. To make it an X dividend price. Clear? In such cases, I will make sure that it is reduced from the cost of investment. In all other situations, dividend income should be straightforward credited to P&L. In this case, let's say the dividend is received for the next year 21-22. In the year 21-22, I am holding shares. Therefore, I will still treat it again as return on investment and transfer it to P&L. Only for once, I will treat it as return of investment where I will reduce it from the cost of investment. This is exactly what we have to discuss as far as dividend income is concerned. But remember, your ICAI solved all the problems based on the approach that the investments are measured at fair value under Ind AS 109. So dividend income will be transferred to P&L. This concept of return of investment and return on investment is not considered at all. It is not considered at all in any of the adjustments because we tend to believe that always the investments in subsidiary are measured at fair value. So this concept will emerge of return on investment and return of investment only if the investments are measured at cost. If you don't take that assumption that the investments are measured at cost, then you can forget about this logic of return of investment and return on investment. You can straightforward transfer it to P&L. However, since the discussion is given, so I did continue with the discussion of what is return of investment and what is the treatment that we are supposed to do whenever you have a return of investment. Clear? Let's look at the PDF then. Return of investment and return on investment. Return of investment is when the investment in subsidiary is measured at cost. In such cases, reduce dividend receipt from the cost of investment only if the shares were purchased on come dividend basis. Return on investment when the investment in the subsidiary is measured at its fair value. In such cases, the dividend income should be credited to P&L by the parent enterprise. So no discussion regarding return of investment on return on investment. If it is measured at fair value, dividend from subsidiary transfer to P&L. When will you transfer it to P&L? Only when I have a right to receive the dividend. When do you have a right to receive dividend? When a valid resolution is passed in the AGM. Only when a valid resolution is passed in the AGM, I will have to consider it as a dividend income in the P&L. So therefore, this is a conclusion about the discussion or the adjustment which relates to dividend income in my subsidiary. Clear? Yes, guys. Now we come into the concept of intercompany transactions. What do you mean by intercompany transaction? That means the holding company is having certain transactions with the subsidiary. So they might sell goods, they might sell an asset, whatever it is. That is a transaction which happened. A bill of the subsidiary is given to the holding company, which the holding company discounted at the bank. So there is a mutual transaction which occurred between the holding and subsidiary. Guys, remember, I will apply an adjustment for intercompany transactions between a holding and subsidiary only if they occur after the date of acquiring controlling interest. If there is a transaction between the parent and the subsidiary prior to acquiring the controlling interest, let's say controlling interest was acquired on 28th March 2021. All those transactions between these two enterprises before 28th March 2021 should be ignored. You cannot have an adjustment there. But if there is a transaction which occurred after 28th March, after the acquisition of controlling interest, then you need to apply certain adjustments. If there is an intercompany owing means bills receivable of holding company, bills payable of subsidiary. Creditor in holding company, debtor of subsidiary. Loan to subsidiary in holding company, loan from holding in subsidiary company. These are mutual owings. When I combine these two balance sheets, the debtor and creditors, bills receivable and bills payable, loans and advances, they get knocked off from each other because they're being represented on both sides of the balance sheet. So they should generally get knocked off or cancelled. But when I'm talking about intercompany transaction, I talk about something called as unrealized profit. What is this logic of unrealized profit? Let's see. Let's say, for example, the holding company H, subsidiary S. Holding company sold goods to subsidiary. In holding company, the cost of these goods were 100. Number of units sold, let's say, is 10. That means the total transaction is of 1000 rupees. Simple says, that's why I took like that. But the selling price sold goods at not 100 but at 120. Subsidiary again sold the goods to external customers. Where in this case, let's say the sales were done at 150. How many units were sold? Let's say the number of units sold in this case were 8. That means, as far as the subsidiary is concerned, there is an inventory which is still left out. Inventory is equal to 2 units at 120 rupees. He does not know the cost is 100. He just knows the what at what price he is acquired it from H. So inventory should be measured at cost. Let's say NRV is higher, so it is 240. When we combine, then the inventory of holding and the inventory of subsidiary should be combined with each other. So whenever you prepare consolidated financial statements, upon consolidation, then this inventory value should be reduced by 40 rupees. The actual cost of inventory to the holding company. So consolidation also I will record only inventory at cost. So inventory should be measured at 200 and not 240. So I'll reduce the inventory by 40. What is the other impact? You need to understand that one single impact in the balance sheet is not sufficient. 2 impacts should be given. What is the second impact? Since the units of 100 rupees were sold by holding company to the subsidiary at 120, 20 rupees per unit has already been included as profit in holding company. Therefore, upon consolidation, inventory is reduced by 40. At the same time, the P&L of holding company H also should be reduced by 40. What was the actual total profit there? Actually, if you look at each unit sold at 120, 20 rupees profit on 10 units is 200. But how much did I adjust? I adjusted only for 40, but not the entire 200. Why is that so? Because 8 units were already sold out. I will only adjust for unrealized profit only to the extent of inventory held by subsidiary or inventory held by intercompanies. Beyond that, whatever inventory was already sold off, I will not call it as unrealized profit. It is realized profit. What is a realized profit? 20 rupees to holding company with respect to 8 units of 20 rupees per unit of 8 units is realized because the sale is completed to external customer. To subsidiary, 30 rupees is the profit because 120 minus 150. 30 rupees is already recognized as profit by S Limited. So holding company recognized 20 rupees profit, subsidiary recognized 30 rupees profit, total profit is 150, total profit is 50 on 8 items realized. But to the extent of those 2 items which are still lying in the inventory, I'll consider it as unrealized profit. Therefore, it should be reduced from the cost of inventory. At the same time, also reduced from the person who made that profit. Here, H Limited made the profit. So I'll reduce H Limited's profit by 40. This is my intercompany transaction. These transactions which move from holding to subsidiary is called as a downstream transaction. Similar transaction ulta, where a subsidiary sold goods to holding company, such cases I'll call it as upstream transaction. Be it upstream or downstream, inventory should be shown at cost. So inventory has to be reduced by the amount of unrealized profit. If it is a downstream transaction, holding made the profit, So the P&L of holding company is reduced. If it is an upstream transaction where subsidiary sold goods to holding, who made the profit? Subsidiary made the profit. Therefore, subsidiary's P&L should reduce by 40 rupees. Look at what he says. Downstream and upstream transactions. It is downstream if holding sells goods to subsidiary. It is upstream when subsidiary sells goods to holding. What is the adjustment? I'll reduce the unrealized profit from the cost of inventory. And I will reduce the reserve or the P&L of the enterprise which has earned that unrealized profit. If it is a downstream transaction, who made the profit? Holding. If it is an upstream transaction, who made the profit? Subsidiary. So such enterprise which made such profit should be reduced. Clear? How do I calculate unrealized profit on inventory? Closing inventory multiplied by GP margin. Okay. But if it is a non-current asset, what do you mean by non-current asset? That means it is an asset of fixed asset. Let's say a machine was sold. Then in such cases, inventory situation will not arise. So therefore, whenever it is a fixed asset which is depreciable, then unrealized profit should be profit on sale minus depreciation on profit till date. I'll tell you. I'll help you with an example. Let's say, for example, again, I have the same thing, holding and subsidiary. Holding sold a machine to subsidiary. The cost of the machinery, I'll tell you, but it was sold at 120 on 1st Jan 2021. While the cost of the machinery only 100. What is the profit on sale? My profit on sale is 20. Let's say depreciation rate on this is at 10%. Then in such cases, how do I identify unrealized profit? In this case, I'll reduce minus depreciation on profit. Up to 31st of March 2020. Calculate. What is your profit? 20. What is the depreciation rate? 10%. 20 into 10. But when was the sale? 1st of Jan. What is your balance sheet date? 31st of March. Therefore, how much should be calculated of profit? Only 3 months. Into 3 by 12 is the. So 2 divided by 4, it is nothing but 0.5. Therefore, what is unrealized profit? 19.5 should be considered as unrealized profit on 31st March. Unrealized profit on 31st March 2021. If I should calculate what is the unrealized profit on 31st March 2022, further depreciate minus depreciation for 21-22. How much? 10%. What is the amount? 10% of 20 is basically 2 rupees. Therefore, what is the unrealized profit on 31st March 2022? Unrealized profit on 31st March 2022 is 17. Clear? So like this, as years progress by, your unrealized profit keep on reducing. So what should I do? I will reduce the machinery by the unrealized profit. The same reduction should also be made in the profit of the company, in the P&L of the company which sold the machine. In this example, who sold? H sold. So the P&L of H should be reduced. At the same time, the machinery also should be reduced in its value by 19.5 on 31st March 21, by 17.5 on 31st March 22. This is the concept of unrealized profit on a non-current asset. If there is a non-current asset which is sold, then this is how I adjust it. That is what he said. Profit on sale reduced by depreciation on the profit till date. Clear? If the transactions between group enterprises occurred prior to the acquisition of controlling interest, then the concept of unrealized profit does not arise. It does not arise. Mutual owings. Mutual owings among group companies should be eliminated in addition of assets and liabilities in preparation of balance sheet. This is what we have discussed. If I have a bills receivable, such bills receivable, if it is held to maturity, then I will eliminate. But if it is discounted with bank, is it still there with me? No. Who owns the bill now? The bill is owned by the bank. How will I cancel? Let's say subsidiary gave the bill there. For example, let's say for example, there was a subsidiary and a holding. Okay. The subsidiary had a bills payable of 100 rupees. The same 100 rupees was bills receivable with holding company. Holding company can do three functions with these bills. 1, 2, 3. First one, I can hold till maturity. Hold maturity. In such case, I will eliminate the both bills receivable and bills payable because it is still appearing in the balance sheet of holding company. So in such cases, eliminate. But if it is discounted to bank, who owns it now? The bill is not owned by holding company anymore. Discounted to bank. Basically, the bill has now become the property of the bank. I cannot cancel the bill anymore because the bills receivable is not there in holding company. It has been transferred to the bank. In such cases, no. If I endorse it to creditor, even in such case, the bill is no longer with the holding company. Who is the owner of the bill? The owner is the creditor. Therefore, there is no elimination even when I endorse the bill to the creditor. Clear? The same thing is being established here. Look at your PDF. Endorsed to creditor, no elimination on consolidation. Discounted with bank, not eliminated on consolidation. But if it is held to maturity, then you will eliminate it when you consolidate. Clear? So yes, guys, when we talk about consolidation, first of all, you need to understand that the problems are comprehensive. That means they're a little lengthy than the normal usual problems. So how do we approach these problems and what are the steps involved in consolidation? Now, to explain us the steps, first let's take a small illustration. Let's take some simple example so that we understand exactly how does consolidation be approached with. Okay. Let's say for suppose I have a balance sheet of parent enterprise in this way. I'm calling it as H holding company. Okay. Let's say the assets are 250 and there's also an investment subsidiary to the extent of 50. Let's say the equity share capital is 100. The surplus being 80, and my other equity, or sorry, other liabilities are about 120. So the balance sheets. Just taking random numbers, guys. Don't ask me what is the reason why I've taken those numbers. Let's talk about a subsidiary then. Equity share capital is 100. Reserves being 30. My other release 20. Make my assets a total of 50. Just a second, guys. Calculations. I'll take my reserves as 30 and my other liabilities as, I'll take my reserves as 20 and other liabilities as 30. 120 is easier to calculate, right? Okay. Let's say this was the instance which existed on the date of acquisition. On date of acquisition of controlling interest, let's say the date of acquisition was 1st April 2000. Okay. On that day, the balance sheet appeared in this manner. If I have to consolidate these financial statements, then the first thing that I have to do is identify my non-controlling interest. I did not tell you how much was acquired, right? So let's say this is 80% acquisition. 80% acquisition, therefore 20% is NCI. So first, let me start with computation of non-controlling interest. Non-controlling interest. The computation, go with the calculations, guys. 20% of net assets is a subsidiary. 100 plus 120 or 150 minus 30, whatever it is, answer is 120. So NCI is 24. I'm going by proportionate cost method. If I have to calculate my cost of control here, guys, just one more change, guys. Let us assume that the assets are 200 and investments is acquired at 100. Okay. Now, let's start calculating. First, part A is my cost of investment. Part B, NCI on date of acquisition, which I know is 24. That is the date on which I have drafted those balance sheets. Has to be compared, has to be totaled and compared with part C, fair value of net assets in subsidiary on date of acquisition. Fair value of net assets in subsidiary S on date of acquisition. What is your cost of investment? 100. What is NCI? 24. Total is 124. Compared with fair value of net assets in subsidiary on date of acquisition is 120. Therefore, it leaves me with a total of 4, or the difference of 4, which can be considered as my goodwill. When you consolidate, the first thing that you need to understand is with respect to other liabilities and assets, it's a simple addition which is required. A simple addition of assets and other liabilities is what is necessary. So let us start drafting out your consolidated balance sheet. Consolidated balance sheet of holding company H. Your assets and total it. Total your assets 200 plus 150. Answer is 350. As far as your other item of asset is concerned, which is regarding your investment, this has to be cancelled. Eliminate this investment, but instead I will get a goodwill or a bargain purchase. Here in this case, I got a goodwill of 4. So additional item, goodwill of 4. Now, what about my other liabilities? My other liabilities which have to be reported. Look at the totals. Look at the total, guys. 120 plus 30 is a total of 150. Right? At the same time, I have to arise a new item called as NCI. In case this is 24, my equity capital and your equity. Take only the holding company's equity and equity share capital and reserves, which is nothing but 180. Apply the same items. So total 350. Balance sheet. How it tallied. Observe in simple sense, what are the items which I did not consider in consolidated balance sheet? Assets and other liabilities, simple addition I've done. Equity, share capital and reserves, only the subsidiary, only the holding company has been considered. What I consider is share capital reserve subsidiary. Let's see how it got adjusted. This 120 which I did not consider, 120 which I did not consider, this 120 I'll divide it into two parts. One which belongs to the holding company, one which belongs to the holding company. 80% belongs to the holding company, so 96. NCI 20%, 24. Where should I write this 120? It is on the liability side. So even upon consolidation, this 120 should have been written on the liability side only. So what am I doing? First, I am writing 24 on the liability side as NCI. This 24 is handled out. What else I should consider? 96 should be written on the liability side. But what am I doing with this 96? Instead of writing 96 on the liability side, I'm knocking off this investment on the asset side and I'm saying the difference is 4, which has to be reported as goodwill. So this 120, which is equity share capital plus reserve in the subsidiary, is being broken down into two parts, NCI and holding company. NCI, on the liability side in the consolidated financial statements, I am presenting the 24 rupees, which is NCI share in 120. But to the extent of the difference of 96, which belongs to the holding company, I am cancelling it against the investments in the subsidiary. Therefore, the balance figure of 4 appears. Clear? This is how I prepare consolidated financial statements, and that is how it tallies. Let's say, for suppose, I'm going to the next year. So I'm drafting the financial statements as on 31st of March 2022. I'm drafting financial statements as on that date. First, the holding enterprise has an equity share capital of 100 as it is. My reserves and surplus, that is other equity, already existing in the balance sheet was 80 in holding company as on 31st March 2021. So current year profit also got added. Let's say this became 140. My other liabilities, what was existing earlier? So 80 rupees of profit, 80 rupees of reserve in holding company. Current year, another 60 rupees of profit became 140. Your other liabilities, which were 120 earlier, let's say became 160 now. Assets had investment in subsidiary, and my change, there is no change in the value of investment in subsidiary. It was 100 before, it is 100 now. So that means the balance of other assets in my holding company to balance, just to write as balancing figure, is 300. Similarly, I am preparing even for the subsidiary as well. My equity share capital is 100. And even subsidiary profit. What was the reserve and subsidiary earlier? 20. Let's say the reserve and subsidiary has increased to 50 now. That means current year profit is 30. My other liabilities, last year other liabilities were 30. Let's say current year other liabilities are 20. And my assets are 170. This way I have balance sheet drafted for the next year. Now I'm supposed to identify what is the consolidated balance sheet here. Let's try to prepare a consolidated balance sheet. Consolidated balance sheet of H. Right? Let's add up. Assets. Total it. What is the assets in holding company? 300. Subsidiary 170. 470. What about the other liabilities? 160 in holding plus 20 in subsidiary, 180. You calculated cost of control and I told you that goodwill will not change. Cost of control will not change. It was 4, will remain 4. Now, equity share capital, there is no change in the holding company share capital. Balance sheet is not tallying because there are 2 more items which has to come in, reserves and surplus. And now look at here. What is your reserve and surplus of holding company? 140, correct? So I'm initially taking it as 140. What is the NCI last year? Last year's NCI was 24. I'm taking the same thing. Observe the balance sheet will not tally. Look at the balance sheet now. 24. And how much? 300, 420, 444. What is the difference which is coming up? The difference between these two is exactly 30. What is this? This 30 is the current year profit of subsidiary. It was 20 earlier, became 50 now. So what is the current year profit in subsidiary? 30. So this 30 is the difference which is appearing. So what should we do with this 30? Let's see. Subsidiaries, current 2022 belongs to the shareholders. So shareholders are broken down into 2 parts. It belongs to the holding H, 80%, which is nothing but 80% of 30 is 24. To the extent it belongs to the subsidiary S, 20%, which is nothing but 6. Correct? Now what I'll do, for me to tally the balance sheet, holding company's 24 rupees is the share in profit of the subsidiary for the current year. Therefore, when you prepare your reserve and surplus, it is no longer to be considered as 120 or 140, but it is 140 plus 24, which is share in subsidiary's profit after the date of acquisition, becomes 164. Your NCI is no longer 24. NCI should be measured on measurement day 24 at the beginning of the year plus his share in current year profit of 6. Therefore, 24 will now become 30. Or NCI normally also. If you calculate NCI normally, what is the subsidiary's net asset? Subsidiary's net asset is 120 minus 170 minus 20, 150. Which is 30. So that same 30, I'm trying to write it in consolidated balance sheet. Automatically, your balance sheet total is not 444 anymore. It has come down to 474, which your balance sheet has tallied. Therefore, what is changing every year? Every year, because of current year profits made by the subsidiary, two items always change. One is the reserve of holding company, other one is the NCA. Every year, this goodwill will remain constant. This is constant. There is no change as far as this value is concerned. As far as my other liabilities and my assets are concerned, I'll adopt the same approach of adding those values. So if I have to break down now, what is the value which I did not do simple addition for? 150. Correct? Let's look at this 150, what I will do now. Equity share capital plus reserve and surplus in S subsidiary is equal to 150. What do I do with this 150? Let's see. I'll first break it down. Into two parts. To the extent it belongs to equity share capital, to the extent it belongs to reserves. To the extent it belongs to equity share capital amount is 100, reserve and amount is 50. Of this 100, 80% is held by the holding company, balance 20% is held by minority and holding company. Minority holds 20% and holding company holds 80%. Out of this reserve and surplus, what I do is I'll again bifurcate the reserve and surplus into two parts. To the extent it belongs to holding company, to the extent it belongs to minority interest, 20% of that 30 is how much? 20% of 50 is 10. How much is holding company share? 40. But understand, out of this 40, again I'll divide it into two parts. This 40, the amount which was existing on the date of acquisition is called as pre-acquisition. To the extent I earned after the date of acquisition, I'll call it as post-acquisition. What was pre-acquisition? Before acquisition, the subsidiary's reserve was 20. Out of which, how much did I acquire? 80%. Therefore, my share in pre-acquisition reserve existing on the date of acquisition was 16. What is current year profit? Out of which holding company share is 24. What I do now is take this. Minority interest to the extent of 20 in share capital. Minority share of reserve to the extent of 10. Total minority is 30, which I went into balance sheet. Look at the holding company now. Holding company, this particular amount of 80 plus this amount of pre-acquisition reserves in subsidiary to the extent of 16, this total is 96. This is the holding company share in net assets of the subsidiary existing on balance sheet date. Correct? How much did you acquire it by? I paid 100. The balance is 4. So investment worth 100 got knocked out. Holding company share in share capital plus holding company share in pre-acquisition got knocked out. The difference appeared to the extent of 4. That 4 I have written in the balance sheet as goodwill. To the extent of this share, their share in profits of the subsidiary after acquisition, that is 24. I added it to the reserves of subsidiary, became 164. NCI or minority of 30, goodwill of 4 appeared, balance sheet tally. So that means because of simple addition, I did not take up these two amounts. So these two amounts of 150, I have allocated this 150 in this particular manner. Share capital of 100 and reserve of 50. Out of share capital, minority is 20 and holding company is 80. Clear? Just check. Keep checking, guys. Yes, guys. So many adjustments are happening. Let's try to have a holistic view of how do we approach the problems on consolidation. Whenever a problem emerges on consolidation, there are certain steps that we need to follow. What are the steps that we need to follow as far as consolidation is concerned? Let's see the steps one by one. Right? Now, the first step that we need to apply here is to start with the date of acquisition. First, always start with date of acquisition. Guys, date of acquisition is generally given in the question, so you don't have to apply your head in trying to determine what is the date of acquisition. Clear? Number two, I'll try to give out what is my shareholding pattern. How do I write shareholding pattern? I'll write it like this. Whenever I have the concept of shareholding pattern, I will try to present it in this manner. Number of shares and percentage holding. This will be presented for holding company as well as my NCI. Okay. So if I take up the number of shares and this will be the total shares. It should be equal to total shares in subsidiary. If I take holding, then the total should be coming down to 100%. How I generally, even this part is presented as far as your question is concerned itself. You don't have to apply great logics or sense in understanding this concept as well. Then we will move into the step 3. Under step 3, we will try to analyze the reserves of subsidiary. Analyze the reserves of subsidiary S Limited with respect to date of acquisition. Guys, if you can identify this step directly from the question, you can skip this step. But fundamentally, what we try to do is we will always start with balance as on balance sheet date. Balance of reserve in S Limited on balance sheet. This balance is existing on balance sheet date. I will try to identify what was the balance of reserve on the date of acquisition itself. So I will divide it into two parts. First, reserve on date of acquisition, and what is the appropriation after acquisition? How much reserve increased after acquisition? So reserve existing on the date of acquisition and reserve appropriated after the date of acquisition. Now, to the extent of reserve existing on the date of acquisition, it is called as pre-acquisition reserve. That is a reserve already existing on the date of acquisition. So I'll call it as pre-acquisition reserve. This part of reserve which has been appropriated after the date of acquisition is called as post-acquisition reserves. Clear? Now that is my step 3. So for each reserve in subsidiary, I will have to identify what is the amount of pre-acquisition reserve and what is the amount of post-acquisition reserve. For every reserve in subsidiary, I'll have to do this function. Clear? That is my step 3. Once I've identified all the pre-acquisition and post-acquisition reserves, then I will get into the concept of distribution of reserves. What do you mean by distribution of reserves? when I do distribution of reserve, I distribute the reserves which I have analyzed in step 3 to holding and minority in the ratio of their shareholding pattern. So whatever we have observed as pre-acquisition reserve and post-acquisition reserve, I will tell all reserve and post-acquisition, and I will try to allocate this amounts of among holding and minority, or the percentage of holding which you have attained in your step 2. So I will try to understand what is holding completion pre-acquisition reserve, similarly to even the post-acquisition reserve as well. Clear? Then I'll push myself into step 5, where I will try to determine what is non-controlling interest. How do I calculate controlling interest? Non-controlling interest is not share in share capital plus NCI share in reserves. It is NCI share in share capital plus NCI share in reserves. So write down NCI share in part A, share capital, plus NCI share in reserves of the subsidiary. Guys, like you already know, we have divided the reserves into pre-acquisition and post-acquisition. So reserves also divided further into pre-acquisition and post-acquisition. This total will be considered as my NCI to be presented in the balance sheet. In the balance sheet, this is my NCI total. Where do I pick up this NCI share in pre-acquisition and post-acquisition reserve? We have already distributed the reserve. So therefore, NCI share in pre-acquisition and post-acquisition reserve can be picked up from this. Clear? So it can be picked up from your distribution of reserves, where you fill up these two items of NCI share in pre-acquisition reserve plus NCI share in post-acquisition reserves, and this will bring me to the end of NCI in consolidated balance sheet. This is the end of step 5. Then I get into my step 6. My step 6 is about determination of cost of control. We have already discussed determination of cost of control as in 103. Not repeating, but I'll go into step 7, where I will try to determine what is the reserve in consolidated balance sheet. Reserve in consolidated balance sheet, I will add two figures: reserves and surplus in holding company on balance sheet date, added by plus RB company share in subsidiary post acquisition. First of all, what is the value of your post acquisition reserve? How do I determine your post acquisition reserves? We have already done it in your distribution of reserves, where you have the post acquisition reserves and you know what is a holding company share. Such share of holding company, I'm adding it to your reserves of the holding company to identify what is the reserve of consolidated balance sheet. And then I'll finally prepare step 8. Clear, guys? This is exactly my preparation model or my way on which I will present the balance sheet as far as your consolidation is concerned. So total we have seen 8 steps. First, cost of acquisition. 2, shareholding pattern. 3, analyze the reserves of the subsidiary with respect to date of acquisition to determine what is pre-acquisition reserve and what is post-acquisition reserve. Number 4, we distributed the pre-acquisition reserve and post-acquisition reserves among holding and minority interest in the percentage of holding that they already have. 5, I measured my minority interest or non-controlling interest. 6, cost of control. 7, reserves for CBS. 8, consolidated balance sheet. 8 steps done with consolidation and dusted with consolidation. Clear? So let's look at the steps in consolidation that I've written already. Date of acquisition, shareholding pattern, analyze the reserves of the subsidiary with respect to date of acquisition to determine what is pre-acquisition and post-acquisition reserves, and then I distributed my reserves. In step 4, I determined my cost of control and my NCI in step 5 and step 6. Step 7, I went into reserves for consolidated balance sheet, and finally step 8, my consolidated balance sheet. That will bring us to the end of the steps involved in consolidation. But let's look at the next adjustment. Revaluation of assets and liabilities in subsidiary on date of acquisition. This generally happens because as on the date of acquisition, you sometimes have a tendency to measure the assets and liabilities in the subsidiary at fair value. When you measure the assets and liabilities in subsidiary at fair value, you normally have some revaluation of a few assets upward or downward. Whenever there is an upward or a downward revaluation as far as the subsidiary is concerned, it gives rise to something called as revaluation surplus. Such a revaluation surplus or revaluation deficit which arises upon revaluation of assets and liabilities on the date of acquisition in subsidiary, the entire revaluation should be considered as pre-acquisition reserve. But don't forget that whenever there is a revaluation to the asset, there is a consequential effect even on the depreciation as well. So to the extent of depreciation on the revaluation part, if it is an upward revaluation of an asset, excess depreciation. If it's a downward revaluation of asset, then the depreciation will be reduced. If there is an excess depreciation, the profit should reduce, and if you are downward revaluing, then the profit should increase. Such adjustment should be made from post-acquisition profit. Why is that so? Because you are revaluing on the date of acquisition, so the depreciation and revaluation impact is after the date of acquisition. So after the date of acquisition period is called as post-acquisition period. So during this post-acquisition period, such depreciation and revaluation should be adjusted from the profits. Clear? So this is my adjustment related to revaluation of assets in the subsidiary on the date of acquisition. What about bonus issue? What if the subsidiary announces bonus? Whenever the subsidiary issues bonus, it will not affect the shareholding pattern because every shareholder will get the bonus. If holding and minority are holding shares in the ratio of 60-40, even bonus issue is also in the same ratio of 60-40. So therefore, the shareholding pattern will not change because of bonus. Now, this bonus is issued out of reserve. Which reserve? Subsidiaries reserve. Now, out of subsidiaries reserve, I have two classifications, pre-acquisition and post-acquisition. Which reserve should I consider? First, always consider pre-acquisition reserve. Whenever I have an adjustment of bonus, always consider that it is an adjustment from pre-acquisition reserve only, unless and until pre-acquisition reserve is insufficient. If pre-acquisition reserve is insufficient, then you can adjust it against post-acquisition reserve. your goodwill determined in step 6 and your NCI determined in step 5 will not change, because ultimately a reserve is becoming share capital. So when you calculate either goodwill is only calculated at the point of acquisition, so that anyways won't change. But look at minority, reserve reduced, share capital increased. How do you calculate minority? Share capital plus reserve. Ultimately, the decrease in share reserve is compensated with the increase in share capital. So there is no consequence of bonus either in computation of NCI or in computation of goodwill. Clear? These are the two general adjustments which will appear apart from the adjustments regarding multiple dates of acquisition, or we have also seen adjustments regarding your intercompany transaction. Apart from these, this is the only adjustment which should appear as far as your consolidation is concerned. So therefore, we can start solving problems as far as consolidation is concerned. Now, it does not mean we ended with consolidation, because there are also situations that we have seen which we should see regarding disposal of subsidiary and also your associates and joint ventures. What is the equity method of consolidation? So these two aspects are yet to be seen, but as of now we are sufficient enough educated to start looking at some problems on consolidation. Yes guys, so let's solve some illustrations out here. Look at the first one. Scenario A. Following is a structure of a group headed by Company X. Company X is a listed entity in India and prepares consolidated financial statements as per the requirements of Ind AS. Company A is an unlisted entity and it is not in the process of listing any of its instruments in public market. Company X does not object to Company A not preparing its financial statements. Whether Company A is required to prepare the consolidated financial statements as per Ind AS 110. Guys, Company X is basically holding the shares of Company A, and Company A probably also has another subsidiary. So Company A becomes an intermediary parent enterprise. In an intermediary parent enterprise, if the shares are not listed in any public market or in the process of listing, and what are the conditions? It is not listed nor in the process of listing. Ultimate parent enterprise is already presenting the financial statements on consolidated basis. Then you can claim exemption from consolidation. Clear? So in scenario A, yes, the company A has satisfied all the conditions. Therefore, it is exempted from consolidation. Look at scenario B then. Assuming the same facts as per scenario A, except that Company X is a foreign entity and is listed in stock exchange in a foreign country, and it prepares its financial statements as per generally accepted generally accepted accounting principles applicable to the country. So whether your answer would be different. Guys, in the same situation, if you look at scenario B, consolidated financial statements of Company A are not prepared as per Ind AS. Hence, Company A cannot avail the exemption. Why? Because the holding company is not an Indian enterprise, it's a foreign entity. It is not preparing consolidated financial statements as per Ind AS. If it is preparing as per Ind AS, then only interim parent company is exempt. Here, interim parent company is not exempt since the ultimate parent company is not preparing financial statements on a consolidated basis as per Ind AS. It is preparing as per whatever gaps in that particular country is concerned. Look at scenario C. Assuming the same facts as per scenario A, except that A is 100% investment, 100% of the investment in A is held by Mr. X instead of Company X. Will your answer change? Guys, individual is not covered under Ind AS. So Mr. X is an individual who is controlling 100% shares of investment in A. So therefore, since Mr. X is not preparing financial statements on consolidated basis, the exemption is not available to Company A. Look at the answer of scenario C. Mr. X would not be preparing financial statements as per Ind AS. Therefore, Company A cannot avail the exemption from preparing consolidated financial statements. Look at the question now. Company A has 100% shares in Company B, 60% shares in Company C. while company C in turn holds 100% shares in another company X. Look at what is the question. Company A is a listed enterprise and prepares consolidated financial statements as per the requirements of Ind AS. Company C, which is a subsidiary of Company A, is an unlisted entity and it is not in the process of any listing. 60% of share capital of Company C is held by Company A. Correct? Balance 40% is held by outsiders. Company A does not object to Company C for not preparing consolidated financial statements. Ultimate parent company is preparing financial statements on consolidated basis as per Ind AS. Interim parent company, which is Company C, is it required to prepare financial statements as per Ind AS? So whether Company C is required to prepare, Company C is eligible to claim the exemption provided all its shareholders have agreed. So Company A is only holding 60% in Company C, so there is 40% held by someone else as well. So those minority shareholders should also approve that the Company C is not necessary to prepare financial statements on consolidated basis. Only then Company C is eligible to claim exemption. But in this case, Company C is eligible to claim exemption if the balance 40% also agree that Company C does not prepare financial statements on consolidated basis. Assume in scenario B, assuming the same facts as scenario A, except that the balance 40% of equity shares of Company C is held by Company B itself. Guys, C balance 40% shares are, if they are held by Company B, then who is the minority shareholder? Company B itself. Company B is a 100% holding company or subsidiary of Company A. Therefore, if Company A agrees that Company C need not prepare consolidated financial statements, then that is sufficient for Company C to claim an exemption from consolidation. Scenario A and scenario B. So Company C is not required. They can avail the exemption from consolidation. Look at the next question. A and B have formed a new entity, AB Limited, for construction and selling of residential units consisting of 100 units. Construction will be done by A and it will take necessary decisions relating to the construction activity. Company B Limited will do the marketing and selling related activities of these units and it will take all necessary decisions relating to marketing and selling. Based on above, who has the power over AB Limited? Is it Company A which has power over AB Limited or is it Company B which has power over AB Limited? Guys, we cannot decide because A is performing the function of construction, B is performing the function of sale. So you don't know which is more significant than the other. If you believe that A Limited's construction activity is more significant, then A Limited will have a power over the investee AB Limited. But if you say B Limited, which is doing the marketing and selling, is more significant in activity, then B Limited will have a power over AB Limited. So with the given facts of the case, either A could be having a control or B could be considered to having a control. Who has the power? In this case, both AB Limited have a right to unilaterally direct different related activities of AB. Here, investor shall determine which activity will most significantly affect the returns of the investee. The investor having an ability to direct those activities would be considered to have a power. So, which one will actually influence the returns? Is it the construction which will influence the returns, or is it marketing and selling those units going to influence the returns? That we don't know. That is the reason why. Look at what is the conclusion. Hence, if the investor concludes that construction is more significant, which will affect the returns of AB Limited, then A Limited is said to have a power over AB. On the other hand, if it is concluded that marketing and selling activities would more significantly affect the returns, then B Limited is said to have a power over AB Limited. So there is no conclusive answer in this case. It depends upon what is your contention. Who has a power over the investee to influence the returns of AB Limited? If A Limited's construction is more significant and is expected to affect the returns of AB Limited more, then A Limited has a power over AB Limited. If B Limited selling activities are more significantly influencing the returns of AB Limited, then B is said to have a power over AB Limited. So I'm giving both the answers, guys. A is an asset manager of a venture capital fund. A is an asset manager of a venture capital fund. So what is A doing? Out of the total outstanding units of the fund, 10% of the units are held by A Limited himself. Balance 90% are held by other investors. Majority of the unit holders of the fund have a right to appoint the committee which will manage the day-to-day administrative activities. Guys, it's a venture fund. What is the main business activity of a venture fund? To invest and derive returns. Here, the committee which is being appointed by the majority unit holders is only for administration activities. However, the decisions relating to investment, disinvestment are done by Fund X, is taken by the fund manager A Limited. Based on the above, who has the power over Fund X? Guys, in this case, A Limited can direct the activities or has a power to influence the return of the fund, that is X. Therefore, it is A Limited which has a power over the fund X. A Limited is able to direct the activities that can more significantly affect the returns of Fund X. Hence, A Limited has a power over the investee. However, this does not mean that A Limited can control the fund, and the consideration will be given to other elements of control evaluation as well. That is exposure of variable returns and link between power and exposure of variable returns. So it's just adding a few more sentences out there, but ultimately the derivation is A Limited has a control over Fund X. An investment vehicle, the investee, is created and financed with debt instruments held by the investor, a debt investor, and the equity instruments are held by number of other investors. So basically, one company is buying the debt instruments of another company. Equity instruments are held by various people. The equity tranche is designed to absorb the first loss and to receive any residual return from the investee. Guys, that means they are exposed to variable returns. Who? Equity investor. One of the equity investor holds 30% of the equity, is also the asset manager. The investee uses its proceeds to purchase the portfolio of financial assets, exposing the investees to credit risk associated with the possible default of principal and interest of assets. The transaction is marketed to the debt investor as an investment with minimum exposure to credit risk associated with possible default of assets because of the nature of assets and because of the equity tranche is designed to absorb the first losses of the investee. The return of the investee are significantly affected by the management of the investee's asset portfolio, which includes decisions about selection, acquisition, disposal of assets within the portfolio, guidelines of the management upon the default. All those activities are managed by the asset manager until defaults reach a specific portion of portfolio value. That is, when the value of the portfolio in such of the equity tranche of the investee is consumed. For that time, the third party trustee manages the trust according to the instruction of the debt investor. Based on the above, who has the power over the investee? So basically, there is a debt instrument, there is equity instrument. Out of this equity instrument, 30% is held by one fellow who is basically saying that equity is the one which will take all the hit. Debt will not be taking any hit. So the fund manager, whoever is appointed, he will take care of disinvestment or investment policies until it reaches a specific proportion. After it reaches that specific proportion, they will be removed, the fund manager will be removed, and the third party trustee will be managing the fund at the instruction of the debt investor. Then in such case, who has the power? Look at the answer. The managing the investee's asset portfolio is a relevant activity of the investee because that is the one which influences the return from the investee. The asset manager has an ability to direct the activities until defaulted assets reach specific proportion of portfolio value. The debt investor has an ability to direct the relevant activities when the value of the defaulted asset surpasses a specific proportion. If the default surpasses a specific proportion, then only debt manager will, or the debt investor will come into picture. The asset manager and debt investor each needs to determine whether they are able to direct the activities that are more significantly affecting the investor returns and including consideration, purpose and design of the investee as well as each party's exposure to variability of return. Guys, though the answer is not conclusive here, I will put it like this. As a debt investor, I am not subjected to variable returns until the equity proportion of entire losses are gone, and then the debt value also will reduce. But that is a significant proportion. Until then, in a normal course of action, debt investor will not derive any variable returns. He is only entitled to receive fixed rate of interest. Therefore, in such case, I have a tendency to believe that the asset manager has a power over the investee. The powers of the asset manager will diminish or will completely go out only if he incurs a loss, and such loss is to a certain proportion of the portfolio value. Until then, it is the asset manager who is having the power over the investee. So if you want me to give it an assertive answer, then asset manager is having a power over the investee only if the asset manager has incurred a loss and that loss has exceeded the proportion, then only the debt investor has a power over the investee. Clear? Following is the voting power of B Limited. 10% is held by A Limited, 90% held by 9 other investors holding 10% each. All the investors have entered into a management agreement whereby they grant the decision-making powers which are related to B Limited to A Limited for a period of 5 years. So A Limited has a power to basically administer B Limited for 5 years. He got this power from all the other investors put together. After 2 years of the agreement, the investors holding 90% of the voting right have some disputes with A Limited. So they wanted to take back the decision-making right from A Limited. So they wanted to withdraw the power of A Limited over B Limited after 2 years. This can be done only by passing a resolution with majority of investors voting in favor of removal of A Limited rights. However, as per the termination clause of the management agreement, B Limited will have to pay a huge penalty to A Limited for terminating the agreement before its stated term. Whether the rights held by the investors holding 90% of voting rights are substantive. So, do they have substantive substitution right? Can they substitute A Limited substantively? Guys, you need to understand, though they can substitute, they have to incur huge amount to be paid to A Limited. Scenario B. This is scenario A. What is scenario B? Assuming the same facts, except that there is no penalty which is required to be paid by B Limited on termination of the agreement before its stated term. However, instead of all the investors, only 4 investors totaling to 40% of voting power have had disputes with A and want to take back the decision from A Limited. Whether the rights of investing 40% are substantive. Look at scenario A. If the investor holding 90% of voting power exercise their right to terminate the agreement, it would result in B Limited incurring huge penalty which would affect the returns of B Limited. This is a barrier which would prevent the investor from exercising their rights. Therefore, the rights to substitute A Limited are not substantive. Look at scenario B. I can do it without paying a penalty, but only 4 investors having 40% have come together. To take back the decision making from A Limited, investors holding majority of voting power need to vote in favor of removal of A. However, the investors are dispute or do not have a majority because they are only holding 40% of voting power. Therefore, these rights are also not substantive. In both cases, who has a power over the investee? In both the cases, the power over the investee is held by A Limited, who just has 10% of voting power. Who gave him that power? All the other shareholders put together, they vested him with that power. Question number 6. An investor is holding 30% of voting power in ABC Limited. The investor has granted an option to purchase 30% more voting power from other investors. However, the excess of option is too high compared to the current market price of ABC Limited. Because ABC Limited is incurring losses in the last 2 years and it is expected to incur loss in the future period as well. whether the rights held by the investor are substantive to purchase the balance 30%. Assuming the fact of the same scenario A, except that the option price is in line with current market price, ABC is making profit. However, the option can be exercised in next 1 month only, and the investor is not in a position to arrange the funds within 1 month time. Whether the rights to purchase the options or to purchase the further 30% are substantive. First case, they are not substantive. First case, why is it not substantive? Sir, I can buy 30% more. No, I automatically get the voting power. I have a right. It is a potential voting right that I can acquire. Yes, but understand that the price at which you can exercise the 30%, extra 30%, is much high compared to the current market price. Sir, high also no problem, sir. I'll still buy. That is where he said ABC is incurring losses for the last 2 years, expected to continue to lose in the future period as well. Therefore, it is very rare situation where the investor wants to acquire additional 30% by paying a higher amount when you know that the company is going to incur loss in future. Therefore, under scenario A, the investor's right to purchase the additional 30% is not substantive. What about second one? You can buy. It is the purchase price is exactly in line with current market price. I am expecting that the company will make profits in future. If I would have put a full stop, you will say, yes, sir, rights are substantive because it is very certain that the investor will acquire the other 30% as well. But he added a condition. The options can be exercised in 1 month only, and the investor is not in a position to arrange the required money in 1 month's time. Therefore, even though the right is substantive, but for investor it is not substantive because he has to arrange the funds within 1 month and is in no position to do that. Therefore, the rights here are not substantive. Look at scenario C. Assuming the same fact of scenario A, except that ABC is making profit. However, the current market price is not known since ABC is relatively a new company. The business of the company is unique and no other company does similar business in the market. Hence, the investor is not sure whether to exercise the purchasing option, whether the rights held are substantive or not. What did we discuss in scenario A? It is not substantive because it is too high compared to the current market price. In scenario B, the right to exercise is not substantive since the period to the investor is not sufficient, it's too narrow. C, also not substantive. Why? Because there is no information regarding the current market price. A, the investor also doesn't know whether he wants to buy or he doesn't want to buy. So therefore, this is because the investor is not able to obtain information about the market value of ABC Limited, which is necessary to order to compare the options exercise price and to decide whether the exercise of purchase would be beneficial or not. In this case also, it is not substantive. So all three scenarios. Number one, exercise price is much more than current market price and the company is expected to make loss. Not substantive, not beneficial. Number two, current market price is equal to exercise price. You are expected to make profit, but you have to exercise within 1 month. Within one month, it is not practical for me to acquire. Not substantive. Third one, you can have a right to acquire another 30%. The company is expected to make profit, but I cannot identify reliably what is the current market price. In such situation, you cannot determine whether it is beneficial to the investor or not. Therefore, the right to purchase further equity is not substantive. All three are not substantive. A venture capital fund is managed by an asset manager who has a right to make an investment or disinvestment decision related to the corpus fund. The asset manager is holding certain stake. The asset manager is holding some stake in the fund. The other investors of the fund have a right to remove the asset manager. However, in the present situation, in the absence of other managers who will be willing and able to provide specialized services that the current asset manager is providing, and the purchase of stake from the current manager is holding the fund, whether the removal rights are substantive or not. Guys, here the removal rights are not substantive. Why is the removal right not substantive? Because you need to understand, though they have a right to remove him, there is no realistic option for us but to actually have the same person. Therefore, you cannot consider it as a substantive right. If other investors exercise the removal right, then it will impact the operations of the fund and ultimately the returns from the fund, since there is no substitute of the current asset manager who can manage the corpus of the fund. Hence, removal rights are not substantive. ABC is a manufacturer of branded garments and is the owner of brand X. PQR has entered into a franchisee agreement with ABC Limited to allow PQR to set up a retail outlet to sell the products of brand X. As per the agreement, PQR will set up a retail outlet with its own funds and decide the capital structure of the entity, hire employees, their remuneration, select vendors, etc. However, ABC will give certain operating guidelines like interiors of retail outlet, uniform to the employees, other guidance to protect the brand name. Are the rights held by ABC Limited substantive or protective? Guys, these are protective rights. These are not substantive rights, because it is PQR Limited who can basically hire employees, who can schedule their remuneration, select the vendors. So everything is given to PQR only. So ABC's rights are only protective in nature, because they are only talking about what is the interior, what uniform they'll wear. You have to come in at so and so time, you have to get out at so and so time. These are guidelines. These are only protective guidelines. They are not substantive guidelines. If ABC Limited has a right to hire or fire the employee, has a right to onboard or offload a particular supplier, then you can say that they have substantive rights. Here, such rights are still vested with PQR Limited. Therefore, ABC Limited's rights are only protective in nature. You cannot call that ABC has a power over PQR. The activities that most significantly affect the returns of PQR are funding, capital requirement, hiring of the employees, vendors, etc., which are exercised by PQR. Further, the retail outlet is also set up by PQR without any financial support from ABC. The rights available with ABC are protective of brand name, and such rights do not affect the ability of PQR to take decisions and relevant activities. Hence, the rights are only protective in nature, not substantive in nature. Therefore, ABC does not have a power over PQR. An investor holds 45% of voting rights in investee. 45% is not more than 50%. The remaining voting rights are held by thousands of shareholders, none of them even holding more than 1%. None of the shareholders had any arrangement to consult any other or make a collective decisions. The remaining 55 cannot come together and make one collective decision. They're individual shareholders. Whether the investor of 45% has a power over the investee, 100% he has the power over the investee because of the size of the holding he has. He has 45% holding. None of the other people even have 1% of the holding. Therefore, it is me who hold 45%, have a power over the investee. I have a control over the investee. On the basis of the absolute size of its holding by the investor, the relative size of voting rights of other shareholders, it is likely that the investor has a power over investee. Yes, guys, let's continue with question number 9. Question number 10. ABC holds 40% of voting power of XYZ. The remaining voting powers are held by 6 other shareholders, each individually holding 10%. Whether the investor holding 40% has a right to power, voting power has a power over the investee, you can't say that, because it is very less likely for me to say that ABC has a power unless and until the balance shareholders are also agreeing with him. So therefore, you cannot say just by the shareholding here, because 10% each person holding itself is also substantive. So it is not possible to determine whether ABC has a power over the investee or not. Look at the answer. In this case, it is likely that ABC has power, since the size of the number of shareholders required to outcast ABC is not so high. The additional facts and circumstances should be considered. to determine whether ABC has power or not. So you cannot really establish, guys, only with the given example. An investor holds 35% of voting rights. Three other shareholders hold 5% of voting rights in the investee. The remaining voting rights are held by numerous other shareholders, none of them individually holding even 1%. None of the shareholders have made an arrangement to consult any others or make collective decisions. The decision about the relevant activities of the investee require the approval of majority of the votes. That is 75% of the rights of the investee would be cast at recent relevant shareholder meeting. Guys, 75% is generally being cashed. 35% is only held by the investor. Guys, which is less than 50%. Whether the investors' voting rights are sufficient to have a power to direct the activities. Guys, again inconclusive because we don't know, but understandably, the remaining shareholders, only 3 shareholders have 5% each. The remaining shareholding is less than 1%. Therefore, you can conclude that the investor has a power over the investee because of the virtue of a higher shareholding of 35% that he has. In this case, the active participation in the recent shareholders meeting indicates that investor does not have a practical ability to direct the relevant activities unilaterally, regardless of whether the investor can direct the related activities because of a sufficient number of other shareholders voted in the same manner as the investor. Investor A and 2 other investors hold 2/3 of the voting rights in investee. The investee's business activity is closely related to investor A. In addition to equity instruments, investor A also holds debt instruments which are convertible into ordinary shares at any point of time at a fixed price. The conversion right is substantive, and the debt, when converted, A Limited will have 60% of voting rights in the investee. A Limited would benefit from realizing synergies if the debt instrument is converted. Whether A Limited has a power over the investee, 100% yes. Because if there is the right to convert the debt instrument is substantive, and after that substitution of debt into equity, they'll control 60%. Therefore, including the current holding plus the potential holding, investor A has a power over the investee. Guys, all these problems we'll see later on. One comprehensive problem which I wanted to solve, let's talk about that. Let's look at this question number 90. DEF acquired 100% ordinary shares of 100 rupees each in XYZ on 1st October. On 31st March, that is after 6 months, summarized balance sheet of 2 companies is as under. Some balance sheets have been given for both the companies. Look at investments in XYZ held by DEF Limited, which is acquired at 34 lakhs. Okay. As I move further, I find that there is a share capital and other reserves. The retained earnings of XYZ showed a credit balance of 3 lakhs on 1st April, out of which 10% dividend has been paid out on 1st November. When did the acquisition happen? In October. So that means this dividend which was received must have been received even by the holding company, and they must have credited it to the P&L. DEF has credited the dividend received to its retained earnings. Fair value of plant and machinery on 1st October is 20 lakhs. The rate of depreciation on machinery is 10%. Following the changes in the fair value as per the respective indices from book value as on 1st October, which are considered while consolidation of the balance sheets. So the trade payables, these are changes in fair value. Trade payables increased by 1 lakh, land and building increased by 10 lakhs, and inventories have increased by 1 lakh 50. Prepare consolidation as on balance sheet date. Read through the question. Read through the question first. You have material in your hand. Please read through the question. First, think about what could be the steps involved in consolidation. You remember the 8 steps in consolidation, right? We will do those 8 steps. If you have read through that question completely, then I will start solving. There is revaluation in this. There is dividend in this. Acquisition is exactly in the between of the year. So there is some kind of approach that we need to follow. So let's start. So yes, guys, let's start solving this question. First, step 1, date of acquisition. What is your date of acquisition? You want me to number it? I'll number it. My date of acquisition already given in the question. Is the date? Date given to me is 1st October 2011. 110. Second one. Shareholding pattern. How do I write my shareholding pattern? Divided into number of shares and percentage holding. Number of shares, percentage holding. The holding company is DEF Limited. The balance divided by non-controlling interest. What is the number of shares? Just check. Go back to your question and think. Check up. Just a second, guys. There's a power outage. Sorry, guys. There was a power outage, guys. Guys, my camera will not be visible. So please kindly follow what I'm saying. Okay. So yes guys, we were solving this question. Let's get back to that. Number of shares held by DEF. If you look at the question, it says 100% of the shares. Therefore, the number of shares are complete. So look at what is the company number of shares existing in XYZ. XYZ says the number of shares are 100 rupees each and the total share capital is 20 lakhs. So 20 lakhs of 100 rupees each, that means the total number of shares are 20,000. The total number of shares are 20,000. This is 100%. There is no non-controlling interest. Total shares are 20,000 and 100% pattern. Let's look at step 3 then. What is your step 3? Step 3 is analysis of profits. Here we need very important analysis of revaluation. Analysis of reserves of XYZ Limited with respect to acquisition. What is your acquisition? The date of acquisition is first. Let's analyze. Look back at the question and tell me what are the reserves that you find in XYZ Limited. In XYZ Limited, under other equity, I find two reserves. One is other reserves and retained earnings. These are the two reserves which I find in XYZ. But apart from that, we have one more reserve which will appear right now in the form of revaluation. So let's first start with revaluation. How many assets are being revalued here? On the date of 1st October, that is your date of acquisition, we are revaluing certain assets. So look at what are the revalued assets out here. The first asset being revalued according to your question is your plant and machinery. Your plant and machinery is revalued on 1st October to 20 lakhs. When is the revaluation happening? On 1st October. So be careful with that. Plant and machinery. Okay. Revaluation is on 1st of October. Okay. So first you need to calculate what is the carrying value on 1st October. Then compare it with what is the revalued amount to get the revaluation reserve. So let's start. What is the book value on balance sheet date first of all? Book value on 31st of March. What is the book value on 31st March? Look at the question. Book value on 31st March of plant and machinery in XYZ Limited is 13,50,000. 13,50,000. Correct? Now, what was the depreciation on this asset? Already given in the question that they had a depreciation rate of 10% on this. Part B. Plus add back depreciation at the rate of 10% so that you will get back to what is the value of the asset at the beginning of the year. I know I should get it on 1st of October, but let's first go back to the beginning of the year. Add back depreciation at the rate of 10%, which is nothing but 13,50,000 is after depreciation by 10%. So to 10 by 90. 10 by 90 is the depreciation, correct? 10 by 90 only I'll consider. I'll get the depreciation. What is the depreciation then? The depreciation is 1 lakh 30,000. Depreciation is 15,000. Depreciation is 1 lakh 50,000. Therefore, the written down value at the beginning of the year is 15 lakhs. That is book value asset at the beginning of year. When did the therefore, to start 6 months minus depreciation to up to the date of acquisition, October. Half of the last year's depreciation. What is full depreciation? 150. What is half? 75,000. If I reduce 70,000, I'll be left with 14,25,000. This 14,25,000 is book value of the asset on the date of acquisition. Book value. First October is 14,25,000. On that day, what is the revalued amount? I'm revaluing the asset on this day. 2 lakhs. Is 20 lakhs. Therefore, the increase in value of the asset is 5,75,000, which should be considered as my revaluation surplus. Revaluation surplus. Revaluations are straightforward, already given to us. So this is plant and machinery. Let's talk about part B. That is other assets. All others are given a short. Let's check. Following the changes in the fair value as on respective of Ind AS from book value as on 1st October, which are considered in consolidating of balance sheet. So these are change in fair values or the increase in fair values. So let us consider them. First one, land and building. Increase in fair value of an asset leads to revaluation surplus of 10 lakhs. Part B, revaluation of inventory should also lead to revaluation surplus of 1 lakh. But there is a liability also which is upward revalued, which will result in revaluation deficit, which is trade payables by 1 lakh. Trade payables by 1 lakh, which is negative. So what the total amount? Part C, total revaluation surplus. 4 items total: plant and machinery, land and building, inventory, trade payables. 5,75,000, 10 lakhs, 1,50,000 and 1 lakh. Then the answer will be 16,25,000. 5,75,000 plus 10 lakhs is 15,75,000. 16,75,000, 17,25 minus 1 lakh is 16,25. So that is your answer of total revaluation surplus. And this revaluation happened on the date of acquisition. So entire amount should be considered as pre-acquisition. It should be only considered as pre-acquisition. This is the first reserve that we analyzed. That is revaluation surplus is 16,25,000 pre-acquisition. Let's look at part B then. What is the next reserve that I have to analyze to identify pre and post acquisition? The next reserve which I have to analyze according to the question, there are 2 reserves in the balance sheet of XYZ Limited, other reserves and retained earnings. But if you look at, very clearly is saying that retained earnings of XYZ showed a credit balance of 3 lakhs on 1st April, out of which 10% dividend was paid out on 1st November. Did he say anything regarding other reserves? Nothing. Since he said nothing regarding other reserves, I will consider that these other reserves were existing at the beginning of the year itself. That means the entire 10 lakhs of other reserves in XYZ should be considered as pre-acquisition reserve. Only retained earnings will have post-acquisition reserves. Let's calculate. Balance sheet date balance of retained earnings is 8 lakh 20. Beginning of the year it was 3 lakhs, out of which the dividend was paid. So I'm talking about retained earnings only. There is nothing to be analyzed for other reserves. There is no adjustment at all. Entire amount I'll consider it as pre-acquisition reserve. Always start with balance as on balance sheet date. Balance as on balance sheet date 31st March. How much was the balance in your balance sheet date? It was 8 lakh 20. 8 lakh 20,000. Out of this 8 lakh 20,000, I'll pull two arrow marks. First arrow mark will represent my balance at the beginning of the year. Balance as on 1st of April. At the beginning of the year, this balance was 3 lakhs. But out of this 3 lakhs, during the year in the month of November, they paid dividend of last year at rate of 10%. What is the total? 20 lakhs. On 20 lakhs, if I paid 10% share dividend, last year's dividend paid was 2 lakhs. After payment of dividend, balance at the beginning of the year only 1 lakh. That means 7 lakh 20,000 will be considered as profit. This is my year profit. 11. Don't forget, your acquisition is exactly on 1st October, half of the year. So again, divide this further into two parts. 3 lakh 60 and 3 lakh 60, 6 months. So my profit up to date of acquisition, 1st October 2011, and the profit after the date of acquisition, that is profit from 1st October to 31st March. This profit, which was earned after the date of acquisition, is subjected to change because of depreciation and revaluation. What is depreciation and revaluation? You only give me a depreciation with respect to content, upward revaluation and a depreciation of 10%. Correct? How do I calculate depreciation and revaluation? Total year's depreciation already provided on plant and machinery was 1 lakh 50. What is the second half's depreciation? 75,000. But now the value of the asset is 20 lakhs on 1st October. So how much will I depreciate on 1st October? Calculate and check. 10%. 20 lakhs. Half year 1 by 2 minus 70,000 depreciation already provided this half the year. So 10% on 20 lakhs for half of the year is 1 lakh minus 75,000 already charged as depreciation. So the answer is 25,000. Therefore, after depreciation, 3 lakh 35,000. This 3 lakh 35,000 is after the acquisition profit, which is post-acquisition reserve. What is the acquisition reserve? Acquisition reserve is up to 1st October. So that includes first 1 lakh plus this 3 lakh 60. That is a total amount of 4 lakh 60, which should considered as pre-acquisition. Other reserves need not be analyzed from your identity distribution of reserves. Step 4. Distribution of reserves. Distribution of reserves. What do you distribute? I distribute both my pre-acquisition reserves as well as my reserves. How many reserves do we have? First one, evaluation reserve. Returns. Other reserves. Put them and place retained earning, and lastly other reserves. Calculate the amount. First, as far as your revaluation reserve is concerned, we already calculated. Go up above and check 16,25,000, which is completely pre-acquisition. 16,25,000 complete acquisition, nothing in post-acquisition reserves at all. Correct? Moving on. What about retained earnings? 4,60,000 was pre-acquisition reserve and 3,35,000 was post-acquisition reserve. 4,60,000, 3,35,000. What about other equity? Other equity in the other reserves in my balance sheet already exists at 10 lakhs. Nothing is given regarding that. So I am assuming that this reserve was a carried forward reserve of last year itself. So nothing in the current year, no post acquisition. Total it out. This will be 30,85,000 and 3,35,000. I'll have to distribute the reserves among DEF Limited, who is 100% holding company. Therefore, entire amount of 30,85,000 and 3,35,000 will appear. There is no non-controlling interest. Guys, there is no non-controlling interest. My step 5 non-controlling interest calculation only won't come. So now my step 5 will have to become cost of control. Step 5 has to become in my cost of control. Let's start. What is the first one? Cost of acquisition. For control, what is the value that you spend? And on date of acquisition, not there, forget about it. Directly I will compare this fair value of net assets, fair value of net assets of XYZ. What is your date of cost of acquisition? Go back to your balance sheet and check. In your balance sheet on the asset side, it is already given as 34 lakhs. 34 lakhs. My net assets on the date of acquisition, I will break it down into two parts. First part, share capital. Second part, pre-acquisition reserves. Share capital plus reserves existing before date of acquisition should be my total net assets. What is the share capital? 20 lakhs. What is my pre-acquisition reserve? We calculated the total pre-acquisition reserves of the company as 30,85,000. 30,85,000. Total is 50,85,000 fair value of net assets as the acquisition. Compare it with the cost of 34 lakhs. it will result in 16,85,000 as the difference. Net. Therefore, this should result in the amount as bargain purchase. Bargain purchase should be as capital. In your balance sheet, don't forget. Now, this was cost of control, which is actually our step 6, but here becoming step 5 because we don't have computation of non-controlling interest. Last one, which is step 7, but here it is step 6. Reserves for CBS or reserves in consolidated balance sheet. Reserves in consolidated balance sheet always start with DEF limited reserves on balance sheet. DEF limited reserve on balance sheet date 1st March. What is the value of DEF limited reserve on balance sheet date? Go back to your question. The total other equity, including retained earnings and other reserves, are how much? 24 lakhs plus 5 lakhs 72,000, 29 lakhs 72,000. 2972. Add that with DEF share in post acquisition reserves of XYZ. Post acquisition reserves of XYZ. What is their share in post acquisition reserves of XYZ? Go back to distribution table. DEF share in post acquisition reserves of XYZ is 3,35,000. So take that. Total 33 lakhs. That is the value of reserves in your CBS. Now let's get to the last part, which is the consolidated balance sheet of DEF. Consolidated balance sheet of DEF Limited as on date 31st March. Let's have Schedule 3. Division 2 balance sheet. So always start with first part. Under assets. First part among that should be non-current assets. Under non-current assets. First of assets should be property and equipment. Include machinery and also should include your land and building. Both those assets are upward revalued, but plant and machinery additional depreciation on revaluation also exists. So keep that in your mind. Clear? Next one. There is no other non-current asset which I find. There's no goodwill at all. It's only bargain purchase which we have got. So let's get into the concept of current assets. I'll calculate, guys. I'll calculate the total of PP later on. Under assets, part 1. Inventory was upward revalued by 1.5 lakh. Already existing inventory in the balance sheet was 3,64,000 for XYZ, which was upward revalued by 1,50,000. So therefore, the total value became 5,14,000 plus already existing inventory in holding company is 12 lakhs. So that makes it 17,14,000. What about the other assets? Other current assets, financial assets, we have trade pay, receivables and cash. financial assets, trade receivables, adjustments, simple addition is required. Simple addition is required in both cases. What is the value of trade receivables? 5,98,000 plus 4 lakhs is 9,98,000 and 1,45,000 plus 80,000 is 2,25,000. So 9,98,000 and 2,25,000. That is the end of your assets. Then come to your second part, that is equity and liabilities. Part 2. Equity and liabilities. Under equity and liabilities, let's start with non-current liabilities. Sorry, shareholder fund first. Shareholder funds actually share capital or your reserves, and third one, the last one, should be your non-controlling interest. No non-controlling interest, so only two items. First one, share capital. Share capital, directly pick up whatever share capital you find in holding company. As on the balance sheet date, it is 50 lakhs. Second one is regarding other equity. Other equity, guys, you already calculated a set of reserves to be taken into the balance sheet. As a part of step 6, reserves in the balance sheet are 33,07,000. But don't forget, one more reserve should be considered, which is 16,85,000 rupees of capital reserve. So add both of them and you will be arriving at an answer of 49,92,000. Your reserves, if you add capital reserve, it will be 49,92,000, which is including the capital reserve as well as your other equity was 33,07,000 plus your bargain purchase, which is recorded as capital reserve, is 16,85,000. Combining both of them is 49,92,000. No other equity, so full stop there. Non-current liabilities. Go back to your balance sheet and check if there is any non-current liability. We'll also have to write whether it is a financial liability or not, but get the balance sheet. The balance sheet just mentions financial liabilities as bank overdraft and trade payables. Both are current liabilities. So I'll directly go back to current liabilities now. There is a revaluation for trade payables. Don't forget. Part A, bank OD. Part B, trade payables. Bank OD, no adjustment, simple addition. What is your bank OD amount? 8 lakhs. Your trade payables of the subsidiary are upward revalued by 1 lakh. So instead of 174, it became 274. 274 plus 471 is 7,45,000. That's it. End of balance sheet on the liability side. One item which I did not pick up is property, plant and equipment. The value of PPE. Get the value of PPE. First, find out the value of plant and machinery, which is the most important. Plant and machinery. First, what is the balance of DF Limited? Second, what is the balance of Equivalent Limited? But there is a revaluation. What is the revaluation that? And Also, don't forget to reduce depreciation and revaluation. All these are adjusted. Will be shown in the balance sheet on the closing date. DF, the value of plant and machinery existing is 24 lakhs and other XYZ is 13 lakh 50. 24 lakhs and 13 lakh 50. On balance sheet date, what is upward revaluation? How much upward revaluation happened? 5 lakhs 75,000. You can go back to your revaluation reserve and check. Plant and machinery was upward revalued by 575. Depreciation, additional depreciation is 25,000. Deduct that amount. Net effect, as far as your balance sheet is concerned, the total plant and machinery, this is 37, 42, 44, 43. 43 lakhs is plant and machinery. And now go to your land and building. Land and building, again write the same way. What is the value of DF? What is the value of and what is the valuation? Land and building in DEF 15 lakhs, XYZ 18 lakhs. 18 lakhs, 18 lakhs. Upward revaluation in another 43 lakhs. Total property, plant and equipment is 40 lakhs combined, which is 86 lakhs. 43 lakhs of land and building, total comes out to 46 lakhs. Sorry, total comes out to 86 lakhs. Go back and place the amount under PPE. 86 lakhs. Now your balance sheet should tally in the first go itself. First go it should tally. 86 lakhs plus 17 lakh 14,000 plus 9 lakh 98,000 plus 2 lakh 25,000. This is 1 crore 15 lakh 37,000. Check about this. 50 lakhs plus 49 lakh 92,000 plus 8 lakhs plus 7 lakh 45,000. It is 1 crore 15 lakhs 37,000. Your balance sheet exactly tallied. There is no difference. Therefore, your answer is absolutely correct. Your answer is bang on. There is no changes. Absolutely right value is what you have got. Let's quickly look at the concept of disposal of subsidiary then. What if you are saying multiple dates of acquisition, right? You acquired controlling interest over a subsidiary. Let's say for suppose there can occur a situation where I am disposing of my subsidiary as well. What do you mean by disposal of subsidiary? I'll tell you. Whenever I look at the concept of disposal of subsidiary, it should happen something like this. I was originally holding a holding company H was holding in its subsidiary, let's say about 80% stake. There are 3 types of disposals possible. I'll tell you. First disposal number 1, disposal of 20%. In such case, your holding and subsidiary relationship is intact because even after 20% disposal, there is 60% interest, which is controlling interest. That means continue to consolidate. But let's say, but my disposal was 40%. Let's say 50% disposal. 40 or 50, anything is the same. Holding company right now, in its subsidiary, can only control up to a maximum of 30%. So there is no controlling interest anymore. Here your controlling interest is lost and now it became substantial interest. Once it becomes substantial interest, it is treated as an associate. It is an associate, and therefore the consolidation should be as per case 28 as per equity method. Equity method as per case 28. The case full consolidation method as per case 28. You will continue to consolidate as per the same method as per case 28. No change in methodology. Let's say I'm talking about third type of disposal, where my disposal is about 65%. Then what happens now? Now the holding company, its subsidiary, is holding only 15% stake. There is no substantial interest, no subsidiary, no associate. In such cases, then there is no consolidation at all. But you have to account for these investments as per Ind AS 109. So my Ind AS 109 financial in third type of investment. Guys, in each of these cases, what should I do with the goodwill? What should I do with the non-controlling interest? Let's look at that. When controlling interest is retained, I'll consolidate and I'll continue to consolidate even as per Ind AS 110 only. But once I get substantial interest, that means the controlling interest is lost, then I will consolidate as per equity method. If any other case of consolidation or disposal where the voting powers falls less than 20%, then you will have to apply Ind AS 109 and classify these investments as financial instruments carried at fair value through OCI or fair value through P&L. You will get these logics when we discuss about Ind AS 109. Clear? Let's move further. Now I will talk about equity method for joint ventures and associates as per equity method consolidation. When I ask you to prepare a financial statements as per equity method of consolidation, remember, as it is, whatever is the balance sheet of holding company, as it is will appear. As it is will appear. Sir, where is consolidation then? Wait. Two changes occur. One change I'll do on liability side, one change I'll do on asset side. The change on the asset side and the liability side should be exactly the same. Then only your balance sheet will tally. If I add 10 to the asset side, I'll add 10 to the liability side to make sure that the balance sheet tallies. What is that one item on the asset side which should change? The one item on the asset side which should change is the carrying value of investment in associate or in joint venture. On the liability side, the change occurs in other equity in consolidated balance sheet. So one item on the asset side, investment changed. One item on the liabilities, other equity or your reserve has changed. What is the change? When you calculate carrying value of investment, then in such cases, I will take the share in net assets of the associate or share in net assets of associate or joint venture on the date of acquisition. That is share in net asset on date of acquisition. If I'll add goodwill or deduct bargain purchase, I will get what is the cost of acquisition. Cost of acquisition everyone knows because anyways balance sheet will tell you. From that cost of acquisition, I will add share in post acquisition reserves of associate or joint venture. Once I add the share in post-acquisition reserves of associate or joint venture, I will get the carrying value of investment. So what is the only change which I did? Adding the share in post-acquisition reserves of associate or joint venture to your asset side to the cost of investment to get carrying value of investment. The same change I'll do on liability side. Whatever is the balance of other equity in parent enterprise, I will add the change share in post-acquisition reserves of associate or joint venture. That is the only change which occurs both on asset side as well as on liability side as far as equity method of consolidation is concerned. All other items, no additions. Whatever appears in parent enterprise, whatever appears in holding company, same values will be taken over even in your consolidation. Clear? So, Ind AS 24 talks about related party disclosures, a pure disclosure standard, no recognition, no measurement. It only revolves around two fundamental aspects. One is who is a related party, who should not be considered as a related party. Second one is about the disclosure requirements. So first of all, who is a related party and who should not be considered as a related party can be understood only if we define the related party relationships. When I talk about a related party relationships, there are two types of relationships which can be considered as related parties. One, an individual being considered as related party. An individual could be Mr. X, Mr. Y, or Mr. Z, or Mrs. X, Mrs. Y, and Mrs. Z. So they are individuals in their capacity being related to the reporting enterprise. The second one is enterprises which can be considered as related parties. When can an enterprise be considered as related party? There are multiple relationships which you have to understand. So when does an individual become a related party is defined further into three aspects. Let us see all those three. So like I told you, according to Ind AS 24, any person can be, individual person can be considered as a related party, or an enterprise can be considered as a related party. When is an individual considered as a related party? An individual or a person along with his close member of their family can be considered as a related party to the reporting enterprise if he controls the reporting enterprise, or if he has a significant influence over the reporting enterprise, or is a member of key management personnel. Such key management personnel could be either for the reporting enterprise itself or to the parent of the reporting enterprise. Now we need to fundamentally understand a lot of aspects in this. So let us see what are the aspects that we need to consider in this. Firstly, like I told you, related party to reporting enterprise. This word reporting enterprise will keep on occurring, guys. So I'll call it as RE. This word reporting enterprise will keep on occurring while our discussion goes on. So let me call him as RE. Either an individual can be considered as a reporting enterprise, or certain enterprises can be considered as related party to reporting enterprise. So individuals can be related parties to reporting enterprise, or there can be an enterprise which can be considered as a related party to the reporting enterprise. Now, whenever I get this situation, let us first understand relating to individuals. When can an individual be considered as a related party to reporting enterprise? He says a person together with his a person along with his close members of family can be considered as related party to reporting enterprise if they can establish three relationships. A person together with close members of the family can be considered as a related party to the reporting enterprise pursuant to three relationships. What are those three relationships which we'll draw? Number 1, number 2, and number 3. Like I told you, three relationships. First one, he has a significant influence, or sorry, one second. I'll start with control first. He controls the reporting enterprise. He has a significant influence over the reporting enterprise. And finally, the last one is where is a KMP of reporting enterprise. He has a significant influence over reporting enterprise, or he has a control over the reporting enterprise, or he is a KMP of the reporting enterprise. But remember, first of all, we need to understand what is control, what is significant influence, and who is this KMP. Whenever I talk about control, a person is said to control the reporting enterprise if he has a voting power of more than 50%. He can direct or control the functions of the enterprise or the operations of the enterprise. Then you say that the person has a control over the reporting enterprise. Predominantly, if a voting power held by a person along with its close members of a family in a reporting enterprise is more than 50%. A person has a significant influence if he has a right to participate in decision making. Participate or influence the decision making of enterprise. I cannot control your decision, but I can participate or influence your decision making of reporting enterprise. Even in that instance, you call it as significant influence. Even those individuals shall also be considered as related party to reporting enterprise. Who is a KMP then? A KMP is a key management personnel. Very similar is a word we have seen under Ind AS 108. Very similar is a word we have seen in Ind AS 108 as well. Under Ind AS 108, we call this person as CODM. Under Ind AS 108. Under Ind AS 108, we call that person as CODM, Chief Operating Decision Maker. Now, what does he do? He is in charge of planning, directing, and controlling the reporting enterprise. He plans the operations of reporting enterprise. He directs the operations of the reporting enterprise. He controls the activities of reporting enterprise. Then he is called as a key management person. Don't go with the word. No enterprise on today's day in an organization has named any designation as key management person. So the designation which belongs to a key management personnel or a person who belongs to the key management person should have the designations as CEO, CFO, MD. These people are generally called as key management person. The one who accesses information for planning, directing, and controlling the reporting enterprise, that person can be considered as a KMP. Clear? Now, remember, towards the end, I'll also add one more relationship. I'll say a KMP of the reporting enterprise is a related party, and also a KMP of the parent of reporting enterprise is also the related party. Now, if my reporting enterprise is having a holding company or a parent enterprise, then such parent enterprise key management personnel shall also be considered as key management personnel of my reporting enterprise. So what am I saying? An individual along with a close member of his family, if they can control the reporting enterprise, that means have a voting power of at least 50% or more than 50%, where they control the decisions of the reporting enterprise, or has a significant influence over the reporting enterprise. That means they can participate or influence the decision making of reporting enterprise, or a person who is a key management personnel. So that means he is a CODM as per your Ind AS 108. He plans, directs and controls the operations of reporting enterprise. I added one more towards the end where I said a key management personnel of the parent of the reporting enterprise can also be considered as a related party to the reporting enterprise. Now, apart from these three, which I have already given, let me tell you one thing. That if these three, a person who controls the reporting enterprise, or a person who has a significant influence over the reporting enterprise, or he is a KMP of the reporting enterprise, if these three individuals either control or have a significant influence or is a KMP of another enterprise, if they control another enterprise or have a significant influence over another enterprise, or they are a KMP of another enterprise, then such another enterprise should also be considered as a related party to reporting enterprise. I'll sum up what I said till now. I said an individual can be considered as a related party to the reporting enterprise if he, along with his close members of family, I'll define what is a close member of family, together control a reporting enterprise. That means have at least 50% of voting power or have a significant influence over the reporting enterprise. That means they participate or influence the decision making, having a voting power of at least 20%. In this case, the voting power that they hold is greater than or equal to 20%. That means they have a significant influence over the reporting enterprise, or such an individual is a KMP of the reporting enterprise. Who is a KMP? A key management personnel is a person who is vested with the responsibility of planning, directing and controlling the operations of the reporting enterprise, is called as a KMP. Generally, your CEOs, CFOs, MDs, these are considered to be related parties to the reporting enterprise because they are considered as KMP, key management personnel. I also added one more relationship towards the end, a KMP of the parent of the reporting enterprise, or if that means I am reporting enterprise, I have a holding company, the KMP of this holding company can also be considered as the related party to the reporting enterprise. Apart from these three individuals, I am saying if these three individuals exercise control or have a significant influence or are a KMP of another enterprise, then you can call them as related parties to reporting enterprise. Then you can call them as related parties of reporting enterprise. Clear? Now, we were talking about close member of family. What is this close member of family, first of all? Think about an individual and tell me what do you think they should be included in the family. If I'm talking about a particular person or an individual, who do you think are his related parties? Who do you think is his close member of family? Number one, father, mother. Number two, I'll come to spouse and children. Wait a second. First, before the spouse and children came up, father and mother was there from the beginning. There's one more relationship which was there from the beginning, which is your brother and sister. Then comes my spouse. Then comes your son and daughter. These are my close members of family. Remember, one more addition that he has done due to Ind AS, which was not there under your earlier standard, that is AS 18, talking about related party relationships, is one extra addition along with spouse. He used the word domestic partner. Westernizing of the Indian tradition. So generally in India we call it as spouse. Okay, so Western word. Obviously it need not be a spouse, it can be a domestic partner as well. Okay. Additionally, he talks about the dependents of the spouse can also be considered as related parties, sorry, close members of family to the person. That means the mother of the spouse, father of the spouse, they're also considered as dependents, and those dependents of the spouse can also be considered as a close member of family to the individual or a person which I'm talking about. So fathers, mothers, lineal ascendants, lineal descendants, son and daughter, laterally brother and sister, along with them has spouse or the domestic partner, which is the new addition, along with their dependents. Clear? These are considered to be my close members of family. Clear? Now, an individual together with his close members of family, if they control a reporting enterprise, have a significant influence over the reporting enterprise, or is a key management personnel of the reporting enterprise, or a key management personnel of the parent of the reporting enterprise, then they can be considered as related parties to reporting enterprise. Apart from that, I added one more. I said an enterprise in which these individuals mentioned above, if they control or have a significant influence or are a key management personnel, then that enterprise will also be called as related party to the reporting enterprise. If an individual who controls or an individual who has significant influence or an individual who is a KMP of the reporting enterprise, if he either controls or has a significant influence or is a KMP of another enterprise, then that other enterprise should also be called as related party. Now, here I will insert a particular exclusion. Let's say I have a person P. Okay. This person P is a KMP to two enterprises. Let's say these two enterprises are X and Y. Then I can say these two enterprises are related parties. I can say that these two enterprises are related party. But if the same person is only a director to X and Y, he is only a director to X and also a director in Y. Then these X and Y are not considered to be related parties. You cannot conclude just saying that I have a common director that these people are related parties. These cannot be considered as related parties. I'll tell you why. Just because I have a common director in two enterprises does not make these enterprises related. Just because they are there is a director in common for two enterprises, I'm saying that they cannot be considered as related parties. Now, why do you say that? I am saying, I'll come out with this statement now, which is a very important statement. I am saying that a director need not be a KMP. A director holds directorship in an enterprise. He need not be a KMP. Who is a KMP? A whole-time director is a KMP. A whole-time director in an enterprise can be considered as a KMP. Just because he's the director, he does not become KMP. He should be vested with the responsibility of planning, directing, and controlling the operations of the reporting enterprise. So a director is not KMP by the nature of his directorship. Just because I have directorship over an enterprise doesn't make me a key management person. I might be only a sitting director who is drawing fees. I might be an independent director on the board, but I cannot be considered as KMP in these situations. A managing director, a whole-time director, these people can be considered as key management personnel. So just because there is a director in common for two enterprises does not make them related parties. Such a director, if he is a KMP of both the enterprise, then they should be considered as related party. If the director is not a KMP of both the enterprises, then they should not be considered as related parties to reporting enterprise. Clear? Clear so far? I am done with my individual's perspective. My individuals are done here. From here, I will start talking about enterprises which are considered as related parties. So what did I say? A person or an individual can be considered as related party if he, together with his close members of family, either control the reporting enterprise or have a significant influence over the reporting enterprise, or they are a KMP of the reporting enterprise, or also they could be a KMP of the parent of the reporting enterprise, to be called as related parties to reporting enterprise. And I said, an enterprise in which these individuals who are mentioned above either control or have a significant influence or is a KMP, then such enterprise, another enterprise, will also be considered as related parties to reporting enterprise. I've seen the definition of close member. I've seen the new addition besides spouse that they have done. But if I look at the exclusion, it is very important exclusion. Just because two enterprises have a director in common does not make them related parties. Such a director, if he is considered as a KMP in both the enterprises, then only these enterprises are considered to be related. A director need not be a KMP. He could be an independent director, or he may not be a whole-time director. They are not considered as key management personnel. To be called as a key management personnel, only such directors who are in whole-time employment with the company should be considered as KMP. Clear? That will bring us to the end of discussion on individuals, where an individual can be considered as a related party to reporting enterprise. Now that we have understood individuals who are related to the reporting enterprise, we have also seen one set of enterprises in which these individuals have either a control or a significant influence or a KMP. But now let's get into enterprise relationships where they can be considered as related parties to reporting enterprise. So let's see. First relationship for enterprises to be considered as related party to reporting enterprise. Enterprises which are considered as related party to reporting enterprise, RE. Now, there are 5 relationships which are explained out here. And our definition of related party should be only limited to these 5. This is not an inclusive list. This is an exclusive list. Only these 5 shall be considered as related party to reporting enterprise. The first relationship is where an enterprise and the reporting enterprise are within the same group enterprise. Where an enterprise and the reporting enterprise RE, they belong to the same group companies. What do you mean by a group company? I'll tell you. When I use the word a group company, that means an enterprise, that is an enterprise which controls the reporting enterprise, which controls the reporting enterprise, or is controlled by reporting enterprise, or is under common control with reporting enterprise. So under the first definition, I've seen 3 parts. What are these 3 parts? Number 1, controls the reporting enterprise, is controlled by reporting enterprise, or under common control with reporting enterprise. Which is an enterprise which controls the reporting enterprise? An enterprise which controls the reporting enterprise can be called as a parent. An enterprise which is controlled by the reporting enterprise is called as a subsidiary. An enterprise which is under common control with the reporting enterprise is called as a co-subsidiary. Is called as co-subsidiary. An enterprise and the reporting enterprise belongs to the same group company. That means an enterprise which controls the reporting enterprise or is controlled by the reporting enterprise or is under common control with the reporting enterprise. So that means if I consider a reporting enterprise, RE, an enterprise which controls the reporting enterprise, holding company, an enterprise which is controlled by the reporting enterprise, its subsidiary, an enterprise which is under common control with the reporting enterprise. That means if this holding company has another enterprise which is a subsidiary to it, then reporting enterprise and this other enterprise are called as co-subsidiaries. So 1, 2 and 3 relationships included under the first one. Look at what I just said. I said an enterprise which and the reporting enterprise are under same control or common control with the reporting enterprise. Just a second, guys. a reporting enterprise and the other enterprise are under same control or under the same group enterprises. An enterprise which controls the reporting enterprise or is controlled by the reporting enterprise or is it common control with the reporting enterprise can be considered as related parties to reporting enterprise. This is the first relationship under which we have seen three categories where three enterprises can be considered as related parties to reporting enterprise. Let's get into the second category then. This is the first one. I said there are five. So first one we have already seen. Let's get into the second one. An associate or a joint venture of reporting enterprise. An associate or joint venture of reporting enterprise. What do you mean by this associate or joint venture of reporting enterprise? If I have a reporting enterprise, which has a significant influence over another enterprise, if I have a significant influence over another enterprise, it is called as my associate. When do you call it as an associate? When I exercise significant influence. Significant influence. When do I say that there is a significant influence? I can say that the reporting enterprise has a significant influence over another enterprise if it holds at least 20% of voting power in another enterprise. Then you can say the other enterprise is an associate on which the reporting enterprise has a significant influence and should be considered as a related party included in the definition as per Ind AS 24. Second, where I have a joint venture. When do you say I have a joint venture? I'll say I have a joint venture if I jointly control the joint venture along with other enterprises. I have a joint control. Guys, whenever I have joint control, I alone am not controlling. That means there is someone else who is controlling this joint venture with me. That someone else is basically called as a co-venturer. A reporting enterprise together with their co-venturer is jointly controlling the joint venture. Then this joint venture is a related party. A reporting enterprise has a significant influence over another enterprise. This other enterprise is called as an associate, which should be considered as a related party. However, this co-venturer is not a related party to the reporting enterprise. The co-venturer or co-venturers with whom or together with whom I exercise joint control over a joint venture, those co-venturers are not considered as related parties. Only the joint venture should be considered as related party to the reporting enterprise. Clear? This is my second part. First one, same group enterprises. Second one, associates and joint ventures. Third one, enterprises to which the reporting enterprise itself is an associate or a joint venture. So what am I saying? If a reporting enterprise has an associate or if a reporting enterprise has a joint venture, they're anyways related party as per part 2. But part 3 is saying enterprises to which reporting enterprise itself is an associate or a joint venture. I'll tell you what it means. That means I have a reporting enterprise, RE. I have another enterprise which significantly influences the reporting enterprise. Another enterprise has a significant influence over reporting enterprise. When do you say that they have a significant influence over reporting enterprise? Only if they have a voting power of at least 20% in the reporting enterprise. These parties or these enterprises are called as investing party. They are called as investing party. An investing party has a significant influence over the reporting enterprise, then such investing party should be considered as a related party to the reporting enterprise. What if the reporting enterprise itself is a joint venture? When do you say the reporting enterprise itself is a joint venture? When there are two or more co-venturers who are jointly controlling my enterprise. Jointly control reporting enterprise. These people are generally called as co-venturers. Let's say I'm having A and B. This A, B are nothing but the co-venturers who are jointly controlling the reporting enterprise. So the two enterprises to which reporting enterprise is a joint venture, those two enterprises should be considered as related parties to reporting enterprise. Or there is an enterprise which has a significant influence over the related party, even that enterprise should be considered as related party to reporting enterprise. When do you say that it is an associate? Only if the other enterprise has a significant influence over the reporting enterprise. That means holds at least 20% of voting power in the reporting enterprise. Clear? Clear till here? Now, the fourth one. Part 4. When a reporting enterprise and another enterprise are under the same joint control. Are under same joint control. What is the same joint control? I'll tell you. Let's say I have co-venturers. My set of co-venturers are basically two enterprises, A and B. They together, A and B together, exercise joint control. They exercise joint control over the reporting enterprise. Okay. Along with that, the same co-venturers are having joint control over another enterprise. Another enterprise, I'm naming it as E, and they have the same joint control. Then this enterprise and the reporting enterprise are said to be under the same joint control. Since they are under the same joint control, these enterprises should also be considered as related party. They should be considered as related party as per Ind AS 24. A and B anyways are related because they are jointly controlling the reporting enterprise. But if they together jointly control another enterprise, then even the other enterprise should be considered to be as a related party as per Ind AS 24. Fourth part. What are the four parts that we have discussed so far? Number one, the enterprise and the reporting enterprise, they belong to the same group companies, associates and joint ventures of the reporting enterprise. Enterprises to which the reporting enterprise itself is an associate or a joint venture. Number 4, two enterprises which are under the same joint control can be called as related parties. Clear? Now I'll come to the last and the fifth one. Post-employment plan. Any post-employment plans that we have discussed as per Ind AS 9, they are being managed by a multi-employer plan. Sorry, post-employer benefits post-employment to my employees are handled through multi-employer plan. Then the multi-employer plan should be considered as my related party. This is my related party. If you remember, this was a part of Ind AS 19. Now, what did we discuss under Ind AS 19 regarding multi-employer plan? I said hiring the fund manager might not be easy for each enterprise individually. So there might be a situation where the reporting enterprise together with other enterprises, let's say A, B, C, have come together and have formed a multi-employer plan. They together have formed a multi-employer plan. Right? They together, ABC together with reporting enterprise, they are participants of multi-employer plan. In such case, this multi-employer plan is a related party to reporting enterprise, but the other participants, they are not related parties. I'll repeat, I said the other participants in the plan are not related parties. And what is related party? Only the multi-employer plan should be considered as related party to reporting enterprise. So the other participants shall not be considered as related party to the reporting enterprise just because they are subscribing to the same multi-employer plan. They are managing their post-employment benefits with the help of multi-employer plan together does not make them related parties. Only the multi-employer plan is related to A, related to B, related to C, and also related to the reporting enterprise. But A, B, C, and reporting enterprise among themselves are not related parties. Among themselves, they cannot be considered as related parties. Clear? So we are done with 5 independent inclusions under the definition of related party. Let's see. What are the 5 things? First one, the reporting enterprise and the other enterprise are a part of the same group enterprises. That means an enterprise which controls the reporting enterprise or is controlled by the reporting enterprise or are within a common control with the reporting enterprise, they should be considered as related parties. An associate or a joint venture of the reporting enterprise should also be considered as a related party, while enterprises to which the reporting enterprise is an associate or a joint venture should also be considered as related party. Number 4, enterprise and the reporting enterprise are under same joint control or a common joint control. Lastly, multi-employer plan to which the reporting enterprise is a participant, while other participants of the multi-employer plan are not supposed to be considered as related parties. Clear? Now, like we have seen earlier, we will also come across here in this situation also an exclusion from related party. What is an exclusion from related party? If in case an enterprise an enterprise has a significant influence over the reporting enterprise. An enterprise has significant influence over the reporting enterprise. If such enterprises which is significantly influencing the reporting enterprise has another enterprise in which they have a joint control or a control, if they jointly control it or they control it, then you can say that these two enterprises are related parties. However, if a common enterprise, if an enterprise has two enterprises in which they have significant influence, just by virtue of significant influence, these two enterprises are not supposed to be considered as related. Let's see what I just said. I was talking about exclusion. One exclusion where we have dealt with under individuals. Here I am talking about another exclusion. What is the exclusion which I am talking about? I say that if enterprise X has a significant influence over reporting enterprise, it has a significant influence over reporting enterprise while it controls the other enterprise or jointly controls the other enterprise. Then in such cases, A and B are considered to be related party. But you said exclusion, no? I'll talk about. If in case, the same way there is X, there is a reporting enterprise and there is another enterprise A. If X has a significant influence over reporting enterprise and has a similar significant influence even over another enterprise, then in such cases, these two parties which are under a common significant influence, they should not be considered as related party. They should not be considered as related party. I'm writing related parties and I'll strike it off. Two enterprises which have a common significant influence are not considered to be related parties. If I give you one more way of writing this down, X, there is a reporting enterprise, another enterprise A. If X has established a control over the reporting enterprise, if X has a control or is jointly controlling the reporting enterprise, then A will be considered as a related party only if X controls or jointly controls or has a significant influence. If in case X in reporting enterprise only has a significant influence, it only has significant influence, it does not have a control or joint control, then I will consider A as my related party only if I can have a control or joint control. Significant influence concept does not come up in the second case, because if I write significant influence, then the reporting enterprise and enterprise A both will be under common significant influence. Common significant influence cannot be considered to be related party. So for me to call it as a related party, if X has a control or a joint control over reporting enterprise, then they can either control or jointly control or have a significant influence over other enterprise. to make this other enterprise related to the reporting enterprise. But if in case X is having a significant influence over reporting enterprise, then another enterprise will be considered as related to reporting enterprise only if X controls or jointly controls the other enterprise. If they have significant influence over both the enterprises, they are not considered to be related parties to reporting enterprise. And this is an exclusion that we have dealt with as far as this particular enterprise is concerned. We also dealt with an exclusion earlier when we were talking about individuals, where I said if two enterprises have a common director, they are not related parties. Only if they have a common KMP, they are a related party. Where I told you whole-time directors are KMP. Just because someone is a director does not mean that they will come under the definition of key management personnel. Clear? Certain relationships are not considered to be related parties as per India's 24. We have seen one such thing where we said common directors in two enterprises does not mean that these two enterprises are related to each other. We've also seen where an enterprise has significant influence over the reporting enterprise and also over another enterprise. The other enterprise and the related party and the reporting enterprise are not related party. We've also seen one more when we were discussing earlier, where I said where the reporting enterprise jointly controls another enterprise, then the joint venture will be considered as my related party, but the other co-venturer will not be considered as my related party. These are three things which I have already seen. Let us once again look at. First one, two enterprises having a common director unless the director is a key management person. This is the first thing that we have discussed when we were talking about exceptions to related parties for individuals. While I was talking about enterprises, I came up with this logic saying that two co-venturers having a joint control over a joint venture, they are not related party among each other. The joint venture is related party to each of the co-venturer, but among themselves they cannot be considered as related parties. Now, providers of finance, trade unions, regulating bodies, and public utilities. Guys, providers of finance, they normally have a significant influence over the reporting enterprise. Today's day, startups are the most happening thing around. You found Paytms, Olas, Flipkarts doing amazingly well coming from a startup level. For them, the providers of finance, they normally provide it in the form of convertible preference shares. These convertible preference shares, whenever they give, they are providers of finance, but they influence the decision making of the reporting enterprise to a major extent. But they cannot be considered as related parties. A bank providing a loan, a significant amount of loan to the reporting enterprise, cannot be considered as a related party. Tata Capital and NBFC providing debt to a related party or providing debt to a reporting enterprise cannot be considered as related party to the reporting enterprise. Trade unions, very strong trade unions. They can actually lock down the factory at any point of time. Even though they are so strong, you cannot consider them as related party to the reporting enterprise, even though they influence the decisions of the reporting enterprise to a certain extent. Regulating bodies, your CBEC, CBDT, your GST Council, so they have a significant influence on the pricing of the product. If a GST rate goes up, automatically the selling price goes up. They are influencing the pricing decisions. If the GST rate goes up, then probably on my raw material input, the cost of the equipment or the cost of raw material also might go up. So these decisions of the regulating bodies have a significant influence on my operations, but they should not be considered as related parties. Public utilities, electricity, water connection, they do influence the operations of the enterprise. If there is a power cut for 2 days, obviously it will affect my manufacturing facility, but they should not be considered as related parties to reporting enterprise. Specific exclusion given under Ind AS 24. I have only one single customer. Whatever I produce is only sold to that customer. Customer is giving me requirement. Based on his requirement, I'm manufacturing goods. Only that is my customer. That's it. Beyond that, I don't have any other customer. Can this single customer be called as your related party? No. I purchase material only from one particular person. I don't buy from anyone else. This is the only supplier which I've got. Can that supplier influence the decisions of the reporting enterprise? Yes. If it does not supply on time, then obviously I'll have a significant effect on my operations of the enterprise. So there is a definite influence, but they cannot be considered as related parties under Ind AS 24. A single distributor, a single agent with whom the enterprise transacts significant volumes, they should not be considered as related parties to reporting enterprise. Government taxes, I paid 30%, sir. Significant amount I paid. Apart from that, 18% GST, I paid 48% government only took. Where am I controlling interest, sir? Government is controlling this enterprise by collecting 48% taxes here. So even in such situation, their transactions with government and transactions with government enterprises cannot be considered as related party transactions. Clear? I cannot say Nirmala Sitharamanji, who is the finance minister, is my related party because her decisions regarding the policy are influencing the operations of my enterprise. Cannot be considered as related party. Clear? Any transaction with the government or with any government enterprise will not be considered as related party by the virtue of their position. Clear? What are the disclosures to be necessary? Whenever I have a related party disclosures, then I'll have to understand the disclosures in two sets. I'll break them down into two parts. Number one, where I talk about related party disclosures when there is no transaction which exists in the previous year. I have no transaction which exists in the previous year. Am I exempted from disclosure just because I don't have transactions? No. Even if I don't transact with a related party in the preceding financial year, I should continue to give certain set of disclosures. But these disclosures will be enhanced, will be increased if there is a transaction which exists with the related party. If I don't have any transaction with a related party of the reporting enterprise, even in such situation, I'll have to disclose two things. What is the name of the enterprise? What is the nature of relationship which the reporting enterprise has with the other enterprise? At least these two things have to be disclosed. But if there is a transaction which exists in the preceding financial year, then you will have enhanced disclosures. What is the increased disclosures? Apart from the name of the related party and the nature of report and the nature of relationship, additional disclosures are: what is the nature of transaction that you had with the related party? What volume did you transact with? I've transacted with the related party for purchase of raw material. During the previous year, I totally purchased 140 crores of raw material from my related party. For this, at the end of the balance sheet date, so and so amount is still outstanding to be paid. They made a provision for write-off during the current year. So even such provision to be written off or the amount written off during the preceding year should also be reported. And any other materials of the material facts of the case or material facts of the transaction, if they are concealed with, might influence the decision making of the user. They would influence the decision making of the user if I don't disclose such a fact. Then such facts are called as material facts. Such material facts should also be disclosed along. So what am I saying? If I have a transaction with the reporting enterprise, with a related party of the reporting enterprise, then the disclosures, apart from the name of the related party and the nature of relationship, I'll have to additionally disclose what is the nature of transaction, what is the volume of the transaction, what is the amount outstanding at the end of the year, what is the amount written off or provided for during the current year, and any other material facts which, if concealed, would have influenced the decision making of the user. They have to be disclosed. If I talk about a key management personnel like a CEO, CFO, MDs, for them, I'll have to disclose what is their short-term benefits, post-employment benefits which are accruing to them, the termination benefits, if any, paid to them, and finally, any ESOPs allowed to them, share-based payments allowed to them, which we discuss as a part of Ind AS 102. Short-term benefits, post-employment benefits, and termination benefits as discussed under Ind AS 19. While share-based payments, point number 4, ESOPs or SAR, discussed as per Ind AS 102. They have to be disclosed. So this is my disclosure requirements whenever I have a transaction or when I don't have a transaction with a related party in the preceding financial year or in the current reporting period. However, when you have a transaction with a related party, they are eligible to be aggregated. That means combined. Let's say I have a related party X. Every 10 days, I procure raw material from X. I purchase raw material from X for every 10 days, or let's say every week. Like that, I perform 52 transactions during the year. If I keep on reporting, number 1, transaction on 1st of April, so and so value, transaction on 8th of April, so and so value for purchase of raw material, transaction on 15th April, purchase of raw material from X, so and so value. If I keep on doing like this, 52 times I have to report. Guys, don't you think too much of volume in your disclosures is also unnecessary? And it defeats the purpose of financial statements, because the financial statement should be reliable and relevant. How is it relevant when it is the same related party and you have the same nature of transactions? If you are reporting it multiple times or disclosing it multiple times, it is no longer relevant. That is the reason why, to enhance the reliability and the relevance of the reporting enterprise, he says you can disclose as an aggregate. You can disclose as a combination, as one single amount, only if it is a transaction of similar nature with the same related party. If it is a transaction of similar nature with the same related party, purchase of raw material from X, which is a related party, purchase of raw material from Y, which is also a related party, purchase of raw material from Z, which is also a related party, cannot be aggregated even though the transaction is of same nature, because it is not with the same enterprise, not supposed to be aggregated. I purchased raw material from X, I purchased fixed assets from X, I took a loan from X. You cannot aggregate. Though it is with the same party, it is not the same nature of transaction. You have multiple natures of transactions involved here. So therefore, whenever you have a transaction which can be aggregated for a related party, then they should be of similar nature and the transaction should be of the same related party. Not sale, guys. Transactions with same related party and transactions of similar nature can be aggregated and disclosed as one single item. Clear? And that will bring us to the end of discussion relating this standard in Ind AS 24.